Good morning. As the Secretary of the Energy and Environmental Markets Advisory Committee, it is my pleasure to call this meeting to order. Welcome to the first EEMAC meet of 2021. Today also marks the sixth meeting with Commissioner Berkovitz as the sponsor of the committee. In light of the global response to COVID-19, we are holding today's meeting by video conference to continue to protect the safety of agency personnel, the EEMAC members, associate EEMAC members, guest panelists, and the public. To ensure that today's virtual meeting goes as smoothly as possible and the recording of the meeting is complete and accurate, please identify yourself before you begin speaking and signal when you are done speaking so we can continue with the next speaker or question. Please ensure that your phone and your WebEx video is unmuted before you speak and mute both once you are done speaking. In the case that your WebEx is disconnected, please close your browser and enter WebEx again using the link previously provided for today's meeting. Please only turn on your camera when you are presenting or engaging in the Q&A at the end of the panel. Panelists, please also be aware that there may be a slight time lag to switch to the next PowerPoint presentation in between panelists. If you would like to be recognized during the discussion for a question or comment or need technical assistance, please message me within the WebEx chat. I will alert EEMAC Chair Dina Riggin that you would like to speak during the Q&A that follows the panelist remarks and presentations. Before we begin this morning's discussion, I would like to turn to Commissioner Berkovitz for his opening remarks.
Abigail. Good morning and good afternoon to our participants in Europe today. And welcome to the Energy and Environmental Markets Advisory Committee. I am pleased that we are able to conduct this meeting by video today and look forward to when the committee can meet in person again. This meeting of the EEMAC will explore the potential role of carbon markets in the transition to a low-carbon economy. Reducing global carbon emissions to net zero by 2050 is a significant global undertaking. To accomplish this goal, the International Energy Agency is calling for a transformation of how we produce, transport, and consume energy. This transformation will affect all sectors of the economy and retail customers in their daily lives. Although decisive action is necessary to protect our environment and society, the path to net zero emissions will have significant costs for market participants. Whether incentives, mandates, voluntary reductions, or other approaches are adopted to cut carbon emissions, financial markets can serve to more efficiently allocate the costs and risks of the transition to a low-carbon economy. At today's meeting, we will examine the ways in which energy companies, financial firms, and other market participants are using carbon markets to meet their emissions compliance obligations and hedge risks associated with climate change and green lending, and how these markets may continue to evolve to meet current challenges. The term carbon markets refers broadly to primary markets, secondary markets, and derivatives markets for carbon emission allowances and offsets. Primary markets are the mechanism by which allowances and offsets are initially distributed, either through direct allocation by governmental authorities, by auction, or through voluntary measures. Entities may purchase or sell these allowances or offsets in the secondary market for a variety of reasons, including to meet emission standards, speculate on price movements, or provide liquidity. Entities that purchase allowances and meet compliance obligations can use the derivatives market to hedge their exposure to potential changes in the cost of these underlying assets and discover prices over longer-term horizons. Speculators, market makers, and intermediaries may also participate in the derivatives market as they do for other types of commodities. In a well-functioning market system, prices in the primary, secondary, and derivative markets are related economically. While they can be an important tool to achieve climate goals, financial markets may also be negatively affected by climate change. Last fall, the Climate Subcommittee of the CFTC's Market Advisory Committee released a landmark report describing how climate change poses a major risk to the U.S. financial system and its ability to sustain the American economy. The report details how climate change could create price shocks in a variety of asset classes, potentially disrupting the functioning of the financial markets and their underlying economy. The subcommittee recommended a variety of actions for financial market participants and regulators to recognize and address these risks. With respect to the CFTC in particular, The subcommittee recommended that the agency conduct research to understand how climate-related risks could impact markets and their participants under CFTC oversight, including central counterparties, futures commission traders, and funds. The subcommittee urged the CFTC to coordinate with other regulators to develop a robust ecosystem of climate-related risk management products. It further the CFTC consider expanding the CFTC's risk management rules and related quarterly risk exposure reports, to cover material climate-related risks. I commend the subcommittee for its work in producing this report and Acting Chair Benham for his leadership of the EEMAC and on the issue of climate change generally here at our agency. I see three principal ways in which the CFTC, the financial market regulator, can support the transition to a carbon-neutral economy. First, the Commission is charged with ensuring the integrity of the market.
You're muted. You can press *6 anytime to unmute yourself.
This requires an understanding of how the various carbon markets interact and how companies use them to meet compliance obligations, manage risks, and discover prices. Second, the CFTC should work with exchanges and market participants on the development of new products that will help companies meet these needs. And third, as a climate risk subcommittee recommended, the CFTC should ensure appropriate management and disclosure of climate-related risks. Market-based mechanisms such as cap-and-trade programs are intended to achieve climate goals at a lower cost and to direct investment to cost-effective projects and technologies for reducing emissions. Increased investment in sustainable technologies can lead to more efficient greenhouse gas reductions, but this requires timely and transparent information, not only for current prices associated with such reductions, but also for future prices. The relationship between the primary and secondary markets and the derivatives markets for carbon can drive more informed decision-making and more effective allocation of resources. The price of carbon allowances also can affect the prices of other commodities such as fossil fuels. Given these linkages and the potential for carbon markets to meaningfully contribute to the reduction of carbon emissions, the CFTC should work with other regulators and stakeholders to optimize the effectiveness and integrity of these interrelated markets. To that end, our first panel will examine the cap-and-trade programs in the United States, European Union, and United Kingdom, as well as lessons learned from these programs and ways in which they may evolve in the future. We are fortunate to be joined today by Benjamin Grumbles, the Secretary of the Maryland Department of the Environment, who is here today on behalf of the Regional Greenhouse Gas Initiative, or RGGI, Rajinder Sahota, Deputy Executive Officer of Climate Change and Research for the California Air Resources Board, Hans Bergman, the head of the Unit for ETS Policy Development and Auctioning within the European Commission's Directorate General for Climate, and Gordon Bennett, Managing Director of Utility Markets for Intercontinental Exchange, which hosts allowance auctions for the UK emissions trading system. Another way in which the CFTC can support the move to a low-carbon economy is through its mandate of promoting responsible innovation in markets and among market participants. In order to meet the goal of zero emissions by 2050, investment in renewable energy infrastructure projects must ramp up rapidly. Investors will need to manage the risks of those investments with appropriate hedging tools, including both exchange-traded and over-the-counter derivatives. Derivatives also allow commercial entities and investors to manage exposure to changes in the price of these assets due to climate change and transition risks caused by the shift to a net zero economy. In addition, entities with emission compliance obligations participate in the physical markets to ensure they have appropriate allowances or offsets to meet those obligations. As energy standards evolve, futures contracts will need to evolve to respond to changes in the physical markets. The Commission should work with exchanges and market participants as they develop climate-related products and services to meet these needs, as well as collaborate with our domestic and international counterparts to develop consistent standards for environmental products. Our second panel today will explore the current state of exchange-listed carbon derivative products. We will hear from Gordon Bennett of ICE, Christian Schneider, Managing Director of Strategy for Nodal Exchange, and Derek Stamen, Senior Managing Director and Global Head of Commodities at CME Group, about the carbon products offered on their exchanges. Our third panel will feature a diverse group of stakeholders who will provide their perspectives on how the derivative markets operate as risk management and price discovery tools, and how they expect these markets to change over time. We welcome Evan Ard, Executive Managing Director of Evolution Markets, who will discuss the over-the-counter carbon markets. Susie Kerr, Chief Economist of the Environmental Defense Fund, who will discuss the economics of carbon pricing and considerations for developing equitable carbon pricing policies. Eric Heinley, Assistant People's Counsel for the Office of the People's Counsel for the District of Columbia, who will share a ratepayer perspective. Annette Nazareth, Senior Counsel at Davis Polk, who will discuss the work of the Task Force on Scaling Voluntary Carbon Markets and its recently issued public consultation report. Dina Wiggins, President and CEO of the Natural Gas Supply Association, who will talk about why NGSA views carbon pricing as the most effective long-term solution to climate change. And Matt Picardi, Vice President of Regulatory Affairs for Shell Energy North America, on behalf of the Commercial Working Energy Group, who will discuss carbon market design. A third area in which the CFTC should play a role in the transition to a low-carbon economy is with respect to the management and disclosure of climate-related risks. For example, the CFTC currently requires commodity pools and advisors to address pool performance and the risks of speculating in derivatives. The CFTC also requires certain registrants, such as swap dealers, to periodically report material risks, such as credit, mark, and operational risks. The Commission should examine how climate-related risks are currently considered and reported by registrants and determine whether additional considerations of climate-related risks or disclosures are appropriate. While this aspect of risk management is not specific to the carbon markets discussion today, it is an issue that requires further exploration and one that the EEMAC could consider in a future meeting. On our final panel of the day, we will hear a presentation from CFTC staff. Raul Varma of the Market Intelligence Branch in the Division of Market Oversight, and Bill Heitner of the Risk Surveillance Branch in the Division of Clearing and Risk. Raul and Bill will discuss the impact on the derivatives markets of the winter storm in Texas in February 2021 that caused widespread power outages and hardship for Texas consumers. I appreciate Raul's and Bill's excellent work in preparing this presentation and the dedication of the CFTC staff in closely monitoring this and other market events. Finally, I would like to conclude by thanking Acting Chair Benham, Commissioner Quintens, and Commissioner Stump for their participation and support in today's meeting. I would also like to thank the EEMAC members and our guest panelists for their contributions to this meeting, Dina Wiggins for her dedicated service as the EEMAC Chair, Lucy Hines in my office for her work in supporting this committee, and specifically Abigail Knopf for her exemplary service as Secretary of the EEMAC and for always making these meetings so informative and seamless and make them look easy. And the fact that these meetings go smoothly is a real testament to Abigail's and Lucy's work. Very much looking forward to today's meeting and to hearing from our very distinguished panelists. With that, I'll turn back to Abigail. Abigail, thank you.
I now recognize Acting Chairman Benham to give his opening remarks.
Thank you, Abigail, and good morning and welcome to the CFTC's Energy Environmental Markets Advisory Committee meeting. First off, I want to thank Commissioner Berkovitz for his leadership and extend a special thanks to Abigail, Lucy, and all of Commissioner Berkovitz's staff who served to put together this EEMAC meeting today. Special thanks, of course, to Abigail and Dina Wiggins as well. I also want to thank and acknowledge the EEMAC members and invited speakers, including our very own CFTC staff who will be participating on the panels today. And of course, a special thanks to all of the CFTC staff who help us bring these meetings together. As Dan pointed out, these are very difficult to run smoothly, but they do, and it's a testament to their hard work, especially in these challenging times. As you can imagine, I am pleased and excited that today's meeting will examine how derivatives markets can facilitate the transition to a low-carbon economy and will include an update on recent events in the energy markets. With panels dedicated to domestic and international cap-and-trade carbon markets, exchange-listed carbon derivatives, and the exploration of the underlying markets, I believe the EEMAC is taking a critical step at a time when anticipation and opportunity are building exponentially. The financial markets, particularly the derivatives markets overseen by the CFTC, are used for hedging a myriad of risks in the traditional commodity, as well as interest rate, foreign exchange, credit, and equity markets. They also serve as powerful information resources for hedgers and investors alike when it comes to price discovery, market transparency, and perhaps most importantly for our purposes today, facilitating the allocation of capital towards sustainable investments into financial, agricultural, and industrial sectors as they manage the impact of physical risks and transition towards a low-carbon economy. Inasmuch as Commissioner Berkovitz and I have prioritized addressing the impact of climate change on the derivatives and larger financial markets, I'd be remiss if I did not take this opportunity to note that this is not the first time that EEMAC examined the promise and transition to a low-carbon economy. And I do not do this to suggest that there is nothing new or repetitive about today's agenda. Rather, I'd like to take the opportunity to honor our past CFTC Commissioner, Bart Chilton. We lost Bart a little over 2 years ago, just as leaders across domestic and international regulators and financial institutions were building the momentum needed for the industry, public, and policymakers to recognize that the impact of climate change can no longer be compartmentalized as an environmental issue. Today's EEMAC could not come at a more appropriate time. We are at an inflection point in the climate discussion, and I'm confident that today's meeting will further advance our understanding of the critical action needed to address climate change. Commissioner Chilton chaired the first meeting of the expanded EEMAC in May of 2009, which featured panelists from our own Division of Market Oversight, providing an overview of environmental markets, CFTC, and a carbon-constrained world. Even before that, in 2008, Commissioner Chilton used his signature flair to deliver statements and speeches lauding efforts by legislators, markets, and market participants to address the increasingly critical need to incorporate climate-related market risk into our financial markets and to protect our environment. He intrigued us with titles such as The Start of Something Green, It's Not Easy Being Green, Markets in the U.S., Banquet of Consequences, Green Cat Markets, and You Gotta Go Show Some Guts. And one that inspires me is The Most Important Thing. In June of 2008, Bart asked his New York City audience, what is the most important thing you have never done? To avoid a cliffhanger and ever the statesman, Bart moved beyond his own life and thought about the U.S. and the world and concluded that, as a nation, we had failed to address climate change. There's now a common understanding that climate change not only presents systemic risk, subsystemic shocks, and wide-ranging ripple effects to the U.S. financial system and larger economy. It presents opportunities as we work to ensure decisive and cohesive leadership over the markets and institutions charged with monitoring and managing risk, capital, and asset allocation, especially as the physical risks of the sudden and extreme weather events associated with climate change have an increasingly profound impact on our most vulnerable communities. Bart would be so pleased that we have convened today almost 13 years later to take steps needed to replace the never with ever. For my part, in support of the Commission and industry efforts, I have spent the last several years as sponsor of the CFTC's Market Risk Advisory Committee, within which is housed the Climate-Related Financial Market Risk Subcommittee. And I appreciate Commissioner Berkovitz for his recognition of their work. Last September, the subcommittee released the report Managing Climate Risk in the U.S. Financial System, the first of its kind effort from a U.S. government entity. I followed its release with testimony before the House Select Committee on the Climate Crisis, and presentations in other venues focused on climate-related market risk and incorporating sustainability resilience into our financial systems. More recently, in March, I announced the establishment of the Climate Risk Unit, or CRU, within the CFTC. The CRU will be comprised entirely of staff across our offices and divisions and will focus on the role of the derivatives markets and the CFTC as a market regulator in understanding pricing and addressing climate-related risk. To the extent that new products and market developments must accurately, uniformly, transparently, and fairly factor climate-related risks into pricing and related market functions, the Commission needs to engage early in order to ensure coordination with the larger financial regulatory space, both domestically and abroad, and to provide other support as well. The CFTC's unique mission, focused on risk mitigation and price discovery, puts us on the front lines as we will increasingly need to use our wide-ranging, flexible authorities to prepare for and address the impact of climate change, and more specifically, the transition to a low-carbon economy. In thinking about the future of the Climate Risk Unit as a resource for the Commission and the current administration's all-of-government approach, the goal is really to dedicate the resources we have, and that includes our advisory committees, towards raising risk management awareness and visibility within our markets and the broader economy so that we can identify where the holes are, where we need to be most vigilant in both our support and leadership as regulators. At the heart of the EEMAC, the MRAC, the Climate Report, the CRU, all the remarks you will hear today and the legacy of Commissioner Bart Chilton is the concept of partnerships. In speaking about climate change in financial markets and market structures and what role policymakers should and could play. As the remit of our new administration supports a firm commitment to full participation in the global effort, I am fully prepared for the CFTC to be an active player, partner, and leader. To that end, I am very much looking forward to today's discussion, and I want to end these remarks again by thanking Commissioner Berkovitz, Abigail Knopf, Dina Wiggins, and the esteemed members and guests of the EEMAC. I look forward to today's discussion. Thank you.
Thank you, Mr. Quinton.
Thank you, Abigail, and thank you to you for your leadership staff level, and to Lucy, and of course to Commissioner Berkovitz for organizing today's meeting and being such a thoughtful leader of this advisory committee over the last number of years. I've always found these discussions and all of the advisory committees to be incredibly informative and fruitful and productive in providing me and the agency with just a lot of wisdom and experience from such an esteemed group of members. And I'd like to thank the members for attending today. Dina Wiggins, of course, for your leadership. These are very important issues that we'll be hearing about today. The derivatives market is going to play an absolutely critical role in managing the financial risks associated with climate change, as well as potential transition risks and impacts from policy decisions. And I've always thought that the impact of commerce on the environment is captured through traditional classical economic theory and the free rider problem, which poses that if an access or use of a good can be done so without cost, then that good could potentially be overused, underproduced, or degraded. And the economic solution to a free rider problem is to not make it free, which is why I think a cap and trade approach has always had some merit to it. And I'm thrilled that we're going to be hearing about the experience of some jurisdictions in trying to implement that. Of course, government-created markets need to be done very carefully and need to be done very thoughtfully. I think we can all look at the RIN market to understand the benefits and the risks of government-created markets, and hopefully learn from all of those examples. I'm thrilled to hear from the rest of the participants around the approach the derivatives markets are currently taking and can take in the future with innovative products in the traditional capitalist economic framework in the United States to continue to address these issues. So thanks again to Commissioner Berkovitz. Thank you, Abigail and Lucy and Dina, and appreciate all the membership, your participation, and for the thoughtful presentations and the work that went in today. Thank you.
Thank you, Commissioner Quinton. I now recognize Commissioner Stump to give her opening remarks.
Thank you, Abigail, and thanks to Commissioner Berkovitz for holding the meeting, and thanks to Dina for facilitating and for her leadership of the EEMAC. I think most everything has been said at this point, so I'll be very, very brief. I think the CFTC often is not overlooked, but I think the public doesn't always recognize the enormous role we play in so many different markets and the folks that we regulate play in facilitating well-functioning markets. And I think this is another example of, like many markets we regulate, oftentimes the investor demand drives the market, and oftentimes the risk mitigation is just driving the market. And so in this case, I think it's worth pointing out that some investors may be focusing on the impact of climate change itself, while others really need these risk mitigation tools, and the policies to address climate change may have a huge impact on their businesses that they need to operate and that we all depend upon. For example, the creation of stranded assets, generating large changes in the asset prices, and the credit risk that may be follow-on effects of various climate-related policies. And so regardless of what or who creates that momentum and my own personal views on the preferred impetus, I think the role of the CFTC remains to preserve the functioning of the consequent risk mitigation tools. And so whether that's driven by government mandates, as it has been in other jurisdictions, or if the consumer or market demand creates new risks, then I think the derivatives will be used to manage that risk, just as they are in many other markets that we regulate. And I'm so pleased that Commissioner Berkovitz has provided the opportunity today to highlight those derivatives products that we already regulate. I think it's worth pointing out we already regulate over 100 products that have a carbon-related component to them, and I think perhaps that's not well understood or publicized, and so I'm very pleased that we have the opportunity today to hear from those who have facilitated the development of those markets. And I'm also interested to hear more about the development of the primary markets that Commissioner Berkovitz mentioned, because the CFTC has a keen interest in the manner in which those markets develop, to recognize as input the various voluntary endeavors already underway. These are important considerations for the development of our markets, the derivatives markets. In order for them to be well-functioning, we need to have a good grasp on what the inputs into those underlying cash markets are. So I'm very pleased that we're having a meeting. I look forward to all of the presentations and appreciate all of the work that has gone into preparing for the meeting. Thank you.
Thank you, Commissioner Stump. I'm going to turn the meeting over to Dina now.
Thank you, Abigail. Commissioner Berkovitz, Mr. Chairman, Commissioner Quintez, and Commissioner Stump, I'm very honored to be a member of this body of EEMAC and to continue to serving as the chair. The committee serves an important vehicle to discuss matters of concern to hedgers, consumers, exchanges, firms, end users within our energy and environmental markets, as well as the Commission's regulation of these markets. Today's meeting serves as a timely opportunity to discuss carbon markets and pricing. This is a topic that's near and dear to our hearts at the Natural Gas Supply Association. I very much appreciate the fact that Commissioner Berkovitz has allowed, as the sponsor of this committee, to focus our attention today on these important topics. I look forward to learning more from my colleagues as the day continues and as we hear from all of the interesting panelists we have coming up. And as chair, I also look forward to facilitating the discussion of the associate members' perspectives of the EEMAC and working with the EEMAC members to provide the Commission with feedback and recommendations that assist the agency in its oversight of our markets. To ensure that today's discussion is consistent with the EEMAC Charter, which prohibits associate members from providing reports and recommendations directly to the Commission, we will first take questions and comments from the EEMAC associate members after the panelists have made their presentations and prepared remarks on the respective panels. And then we will turn to the EEMAC members for their questions and comments on the panelists' presentations, prepared remarks, and any feedback provided by the associate members. As Abigail mentioned earlier, please use the chat function to alert her if you have a question or a comment, and we will recognize you as a speaker after receiving your notification. Before we begin our first panel, we would like to do a roll call of the members, associate members, and guest panelists so that we have your attendance on the record. And Abigail will lead the roll call.
Abigail, I think you're muted. Still muted.
Okay. EEMAC members, after I say your name and organization, please indicate that you're present. Please make sure your phone is not muted. If you are unable to hear your response, please send me a message via the WebEx chat to confirm that you are present on today's call so that I can correct the record. Tribute Bland, ICE Futures US. Rob Kramer, FIA PTG.
Present.
Thank you, Rob. Dimitri Caruso, Nodal Exchange. William McCoy, Morgan Stanley.
Present.
Thank you, Bill. Local Creek, Edison Electric Institute.
Present.
Thank you, Lipa. Jackie Roberts, Public Service Commission of West Virginia. Derek Salmon, CME Group.
Present.
Thank you, Derek. Nathan Slocum, Public Citizen. Okay, and now we're going to turn to the EEMAC associate members. After I say your name, please indicate that you are present. Matt Egan, American Gas Association.
Present.
Thank you, Matt. Susan Burgels, Exelon Corporation. Jessica Bowden, Millennium Management.
Present.
Thank you, Jessica. Paul Siccio, Industrial Engineer, Energy Consumers of America.
Present.
Thank you, Paul. Sean Cota, National Energy and Fuels Institute. Daniel Dunleavy, Ingevity Corporation. Kate Delp, DTCC Data Repository.
Present.
Thank you, Kate. Eric Heinley, Office of the People's Council of the District of Columbia.
Present and good morning.
Thank you, Eric. Paul Hughes, Southern Company. Jeff Hume, Continental Resources.
Present.
Thank you, Jeff. Kaiser Malik, Calpine Corporation.
Present.
Thank you, Kaiser. Dr. John Parsons, Special Government Employee.
Present.
Thank you. Celia Patterson, American Public Power Association. Matt Picardi, Commercial Energy Working Group.
Present.
Thank you, Matt. Sarah Smalty, BP Energy Company.
Present.
Thank you, sir. Melinda Prudencio, the Energy Authority.
Present.
Thank you, Melinda. Dr. Richard Sandor, Environmental Financial Products.
Present.
Thank you, Dr. Sandor. Noha Sidham, Energy Trading Institute.
Present.
Thank you, Noha. Thank you. I will now turn the meeting back over to Dina.
Thank you, Abigail. Our first panel today will discuss domestic and international cap and trade markets. We will hear prepared remarks from Secretary Grumble, speaking on behalf of the Regional Greenhouse Gas Initiative, Rajendra Sohota, California Air Resources Board, Hans Bergman, the European Commission, Gordon Bennett, ICE, and I think with that, we are ready to begin. Secretary Grumble, please go ahead.
Thank you so much. Can everyone hear me okay? Yes? Good? Okay.
Yes, we can. Thank you.
Thank you so much. This is an honor to be part of this discussion, and I have some slides to go through, but in deference to my esteemed panel members, I will try to be quick and give you a broad overview. I want to state at the outset, as the PowerPoint slides are brought up for you to look at, that Reggie, we call it Reggie, the Regional Greenhouse Gas Initiative, has an executive director. It's part of Reggie Inc., and his name is Andrew McKeon, and his staff report to me and other members of the board that oversees the actual initiative, which is not a single program. It's essentially 11 programs within each of the 11 states that participates in this regional greenhouse gas initiative. So Abigail and all commission members, when we have follow-up discussions getting into the derivatives and other aspects, Andrew is a great resource, and I am excited and honored to be part of this discussion. If you could go to the next slide, please. So a little bit more, if you'll bear with me, on what Reggie is and what it is not. Reggie 11 means currently 11 states participate in the effort that puts a price on carbon. And what could be more important right now than a carbon-driven, citizen-centered, market-based approach to deal with this growing threat of carbon pollution and climate change? This collaborative, this partnership of states, as you can see, covers enormous political and geographic diversity and a large chunk of the economy and population for the United States. And the Reggie program is based on the political leadership in each state committing not to be part of an interstate compact, but a partnership where each state has legally enforceable commitments on the regulated entities within its state. And policy is driven by the environmental secretary and the energy or economic secretary of each of the states. So each state has energy and the environment at the helm, shaping policy and future direction. Next slide, please. This is, as you would expect, it is focused on the power sector, coal-fired and natural gas-fired power plants, 25 or greater megawatts, although New York showing flexibility that the Reggie effort has. New York has agreed to modify theirs to 15 or greater megawatt facilities. Each of the states allocates the allowances. We do not give them away. We allocate the proper number based on the amount of emissions coming from the coal-fired or natural gas facilities covered in our programs. And then the regulated entities have quarterly auctions and a secondary market to ensure that at the end of the 3-year control period, they are held accountable and have the proper number of allowances. They are fungible, bankable, tradable. Each state respects the efforts of the other state as part of this. That's what makes them fungible. My real focus as the vice chairman of Reggie is to ensure that our cap and trade program, which we really call a cap and invest program, and it invests because we also want to emphasize the investment part of it, how the proceeds are utilized by each of the states. But the key for us in this environmental program is to ensure that the regional cap is stringent enough to produce real environmental results. So we modify the cap over time. Currently, it's 119.8 million tons. It gets adjusted through a bank adjustment and when we have our periodic revisiting of the stringency of the cap. And the auction proceeds are reinvested, and I'll tell you a little bit more about that. Next slide, please. So the bumper sticker slogan for Reggie is that over the last 13 years, this tracks over the last decade, we have slashed our greenhouse gas emissions in half. Slashed them in half and have enjoyed steady and continued GDP, economic progress. Decoupling GDP and environmental leadership so that we can have both. Next slide, please. This is just to give you a somewhat colored perspective of the energy sector and the trends. And I'll just simply spend less than 30 seconds on this to say, if you look at the gray, you can see that natural gas is increasing, but not dramatically, not as fast as the coal sector at the bottom is decreasing. You know, the state of Maryland, which has 3 coal-fired power plants, when I started as Environment Secretary under Governor Larry Hogan, we had 8. We now have basically 4, but it'll be 3 by later this year. And before 2030, we will not have the coal-fired power plants. They will be running either partly as natural gas or embracing renewables. But this is a picture of the energy generation trends. Next slide, please. One of the success stories and the recipes for continued success of what I believe is not only the first cap and trade program, but the most successful in the U.S. I think other panelists may dispute that, but we have regular, comprehensive, entirely bipartisan and professional review of cap stringency and other safeguards. This program has a tremendous degree of public transparency and scrutiny and engagement on how to set the cap, at what levels to set the cap, what safeguards should be included to reduce the risks of sticker shock or dramatic changes in the price of electricity, which we have not seen based on the very safeguards we have. And 2017 was a critical moment in the history of the program where we, on a completely bipartisan basis, among the 9 states at the time, agreed to reduce our cap by 30% by 2030 and adopt, I hope you get a chance to get into this more in more detail later, but we've always had a cost containment reserve to ensure that the cost of the allowances in the market in the auction do not go above a certain level. Right now, the cost containment reserve, the dollar level is $13. And we added an emissions containment reserve so that if there were too many allowances in the market and the price was getting too low for the allowances, we would take away some of those allowances and put them in the environmentally driven containment reserve. And we look forward to an additional program review and cap adjustment getting in earnest on that next year in the spring. Next slide, please. We have quarterly auctions. In fact, today, today, we are in the process of completing our 52nd quarterly auction. Everyone has been successful. Integrity, accountability, progress on reducing greenhouse gas emissions and increasing proceeds for investments by the states in clean energy and other public interests. You see the prices can vary over time. We are enjoying, as expected, a continued boost in the price the clearing price for the allowances in the market. And tomorrow, we will disclose publicly what the results of the 52nd auction are. $3.9 billion in proceeds, which are invested among the states based on the percentage of regulated entities in each of the states. And we have a tracking system, which is also one of the key recipes for success to ensure RGGI COAT stands for Regional Greenhouse Gas Initiative Carbon Dioxide Allowance Tracking System. And that helps us ensure that there's no funny business, that there's no nothing going on that would put at risk our market-based and steady performing approach to reducing greenhouse gas emissions. The secondary market is robust. It's an additional component that provides great flexibility so that the market continues to trade between these quarterly auctions. Next slide. Only a couple more. A little more detail on the auction structure itself. You can read on the PowerPoint. For those of you who are listening, the platform is that it's electronic, internet-based. We focus on the integrity of the process. We have an independent market monitor. Contractor is currently Potomac Economics. And it's through an awards process. The bids ranked by price, high to low. That's the structure. Next slide, please. There's a reserve price, a hard price floor, which is very low, a couple dollars. We do not set, the governmental entities that run our RGGI efforts do not set the price. The market sets the price, the auctions and the secondary markets. But we do have two very important mechanisms, as I mentioned. The cost containment reserve is to make sure that prices are not unacceptable. The clearing price, the cost of the allowance in the marketplace is not unacceptably high. Rarely has that been used. We also have this new emissions containment reserve to make sure that we don't have too many, that the price isn't too low, which would reduce the stringency of our environmental success, and that would, but this is the first year where that is in place, and that dollar amount has not been triggered yet for taking the allowances away from the marketplace. Next slide, please. Here's a little busy. I apologize for that, but it shows you that the clearing price is on an upward tick, and we're encouraged by that. And one of the most important points to make about the auction and the success of the RGIE program is that it is growing in terms of the number of states that are participating in RGIE. Last year, Virginia, the Commonwealth of Virginia, joined. They participated in the January 2021 auction for the first time. That's a huge increase in the size of RGIE. The year before, New Jersey rejoined the program. Right now, we're in discussions with providing technical information to the Commonwealth of Pennsylvania, which is in the process of attempting to join RGIE. They have been working on this through regulations over the last year and a half. They are heavily engaged with the legislature, and Governor Wolf is pushing hard. But if they are successful in joining RGIE, that will increase the number of allowances, the covered emissions within the PJM power grid by 60 to 80%. A huge game changer by adding Pennsylvania. And North Carolina continues to show interest in joining the RGIE program as well. Next slide. We have an independent market monitor to ensure that integrity is maintained and that public transparency and accountability are provided as well. That is contracted out, and we're proud of that and realize that is a very important component to the success of the Reggie program. Next slide. And this is just a little bit more for your reading enjoyment on our tracking system for the emissions themselves. This is a very important database for each of the states and its governors and the environment and energy secretaries when we revisit the size of the cap and other program review. It's using this information. How many allowances are there? How much more progress do we need to make in reducing greenhouse gas emissions? Next slide. This just shows that, particularly since political elected leaders the governors oversee the state's participation in the Reggie program, this is such a critically important component of the basic. There's a lot of green. There's a lot of green in the investments and the types of projects that benefit energy efficiency, clean energy, renewable energy. The state of Maryland, the legislature has chosen that about 50% of the annual proceeds should go towards direct bill assistance to help on the affordability issue, as well as reliability and resilience. Last slide, I believe. Yeah, I just wanted to say that approximately $3 billion in benefits by an independent review group estimated for the Reggie program over the last decade, based on the investments in energy efficiency, clean energy jobs. Look forward to answering any questions you might have. Thank you again for the opportunity to address you this morning.
Thank you very much. Our next speaker for agenda.
Good morning, Commissioners, everyone. I just want to thank Commissioner Berkowitz for the invitation to be here today. It's been a long time since we've actually had a conversation with CFTC. We had a 4-year break for a while, so it's nice to reconnect with colleagues and reestablish that relationship. Next slide, please. Next slide. Great. So California has made significant progress in reducing its GHG emissions. Our per capita and per GDP emissions have been declining, and we actually met our 2020 target 4 years earlier than mandated by law. So we had to return to 1990 levels by 2020. We actually fell below 1990 levels in 2016 and have remained under that limit. It's important to know what emissions we cover in the program, and the pie chart shows our fossil energy and industrial inventory. We are a huge importer of power, and so we also claim the emissions associated with the power that serves the state. And as with most jurisdictions, transportation is the leading source of GHG emissions. What else is important on that slide is that 80% of everything in that slide is covered by the cap and trade program. So we have a high bar for what can be quantified and priced under a carbon pricing mechanism. Hard to quantify emissions such as fugitives are not regulated by the cap and trade program and left to direct regulation. Next slide. As with most cap and trade programs, we do have the same features. We have a declining set of caps. We have a steadily increasing price signal through a floor price in the auction. And then the market targets the lowest cost reductions across the entire economy. It doesn't matter where those reductions occur for GHGs because they are a global pollutant, not like a local air pollutant. And all of this creates a long-term price signal for investment certainty. So not only is the design of the program important, but also the political support. We have had strong political support through bipartisan actions by our legislature and under both Republican and Democratic governors in the state. Each entity covered by the program has a compliance obligation that is set by its GHG emissions. and entities are required to meet that compliance obligation by surrendering allowances or a limited quantity of offsets equal to that compliance obligation. We create all of the allowances in the system. We issue offsets based on strict criteria for what qualifies as an offset. And over time, the cap declines, and I have a graphic about that. The auction mechanism is very important. It helps to establish that steadily increasing price signal and transparency across the economy. The cap and trade program is not a program in isolation for California. It is one of the policies under our portfolio approach to addressing climate change. So we do have other programs. Some of those other programs target the same sectors under the cap and trade program, but together they have shown the success of reducing emissions towards our target. And many of our programs that are in the portfolio are also leveraged for our air quality targets under the federal programs and the state level programs. So things that target transportation, fossil combustion are going to deliver both air quality and GHG reductions in the economy. Next slide, please. This slide provides some facts about the program. It is economy-wide, so it does cover transportation, industry, electricity, imported electricity, and again, 80% of the state's emissions. We cover large emitters, stationary sources over 25,000. There have been high compliance rates of the program, 100% or near 100% over the last decade. And over the last decade, we've also raised $14 billion that has been invested back into actions to reduce GHGs in California, with more than 50% of those investments going directly to benefit the most impacted communities, the most heavily burdened communities by air pollution in the state. And so we do see the auction revenue as a key part of helping lift our vulnerable communities. Next slide, please. This graphic shows the caps in the program. The program started in 2013. However, it wasn't until 2015 when natural gas and transportation fuels were brought under the program. And when we brought in natural gas for residential, commercial, and we brought in transportation fuels, it doubled the size of the program. But even before those had a compliance obligation, we had allowed those entities to participate in auctions so that they could also start planning and hedging towards a compliance obligation when they would eventually be in the program. What you see in the shaded parts of the bars is how we distribute those allowances over time. The dark spots at the top of the bars are the allowances we take out for the price containment reserve. The yellow is what we put towards our industrial allocation to minimize leakage, and it's an estimate in this graphic. We do have a green portion that is allocated directly to our natural gas and electricity utilities, and that's to benefit and protect ratepayers. And that blue portion that you see there is what goes to auction. So it's about 45 to 50% of the allowances in any given year that are going to auction. Between 2021 and 2030, the caps decline at 4% per year, and that is to reflect our 2030 target of a 40% reduction from 1990 levels by 2030. Next slide, please. It's important to know where this allowance value is going. Like I said, our electric and natural gas utilities do get allowances that are auctioned alongside the allowances that the state auctions. That money is returned back to the utilities. They can use it for rebate programs for efficient appliances, updates for solar panels, insulation programs for homes. And importantly, there is a biannual climate credit on bills that ratepayers get in the state of California. When the pandemic hit last year, that biannual return was split over 2 months to help on 2 months of bills instead of just 1 month, because we did see the impact of job losses on the shelter in place. And so that was one way that we could help mitigate bills in the state of California. And again, 50% of the money is going directly back into communities. Next slide, please. The program is designed with a series of mechanisms for compliance flexibility. There are a limited amount of allowances that are issued under the caps and the regulation. We do also issue the offset credits under very specific protocols that we have adopted. Because the offset credits are subject to a 4% usage limit, there is an infinite amount of offsets that we can issue. We just limit what can be used by any individual entity in the program. There are banking limits with strict holding limits that change each year depending on the size of the overall cap in the program. And there are multi-year compliance periods to help with any annual variability related to hydro, crops, agriculture, et cetera, in the state of California. And things like please. So how does the program work? We have a regulation that actually collects the data, which is verified by a third party, and those accredited third-party entities are subject to oversight and enforcement by us. We do believe that that data is critical to the fundamental strength of the program, and it's essential in setting caps and establishing compliance obligations. And so in our mandatory reporting regulation, we have very high fines that work as deterrent to misreporting or missing your reporting requirements. We have reporting on emissions, production, electricity sales, and purchases, among other data. And everything is reported at the facility level based on electricity imports that are delivered by source to the state of California. Some emissions, for example, biogenic emissions, are reported but do not have a compliance obligation, so we're really talking about the fossil-based emissions. And then one allowance equals one offset credit equals a permit to emit 1 metric ton of carbon dioxide equivalent. Next slide, please. We do have mechanisms specifically designed to ensure market integrity. This includes, again, purchase limits at auctions for allowances, holding limits for entities that can purchase and hold those allowances, registration and disclosure requirements so that we know who's in the market and if they're related to other players in the market. And if there is a certain level of shared control between entities in the market, they do share those purchase and holding limits. We have a central tracking system called KITS, and there are serious financial penalties for violations for regulatory requirements. It's also worth mentioning that not only do we have the regulated entities in the program, but we also have voluntary participants. So we can have hedging funds, we can have banks and brokers participate in the program, and they all have to disclose a similar amount of detail and information about their organizations. We have seen some relationship with FERC and with CFTC in the past. We had a fair amount of engagement with our colleagues at the federal level at the early stages of designing the program. There was that period of lapse, and we're happy to start to re-engage with those agencies and with the CFTC in particular. We have enforcement abilities within the agency, but we also coordinate with our Department of Justice, and in writing the regulation, we were very closely working with our Department of Justice and structuring things related to fuels and energy. Next slide, please. There is a mechanism that has been part of the program since the very beginning. And what this mechanism does is it ratchets out allowances if there is low demand at any given auction. And so if we have an auction where not all the allowances sell, those allowances are removed and no longer brought back to auction until we have 2 consecutive auctions that clear above the reserve price. And that reserve price is going up 5% plus inflation each year. And it's usually about 6 to 7%. Previously unsold allowances are slowly returned to the market if that demand returns at the auction. The maximum number of unsold allowances that can come back is about 25% of what is offered in total, so that we just don't put a glut of allowances back into the market. And then allowances that remain unsold for 24 months are permanently removed and placed into our price containment reserve. This mechanism has removed 40 million allowances in the program so far, so it has been shown to work and has been triggered during 2016 and 17 when we had a period of political uncertainty. But once that political uncertainty was settled through new legislation with bipartisan support, we saw that folks become more confident in the longevity of the market and continue to reinvest back into the market. Next slide, please. There are a fair amount of secondary market activities that we track or engage in. We do have our own dedicated market monitoring section that provides direct program oversight. We also have an independent market monitor that performs analyses of the auctions, similar to what Reggie has. We have data that we get from the commodity exchanges that we look at for price transparency, and I'll show a graph in a little bit that will explain that a little bit further. We have access to reporting services, and then we have a fair amount of detail that must be put into the system when you actually engage in a trade of instruments between accounts in our system. And that includes the number and type of instruments, the agreement date, the price paid, currency type. And at any time, we can call in all contracts related to any transfer within the system. We have used that mechanism to better understand things that didn't look quite what we're expecting to see, and it has resulted in some enforcement action levied within the program. We also put out quarterly and annual market transfer reports so that we are, in addition to the secondary market reports, are providing some information on what we're seeing on prices and transfers. Next slide, please. So this graphic shows a couple of things. What you have there in the gray line is the auction reserve price, and then the green triangles indicate the clearing prices at our auctions, and then that blue line is the secondary market prices. The green diamonds never go below the floor price, the gray line, because we do not sell allowances under that reserve price at any auction. But we have seen periods where the secondary market prices did fall just below the reserve price for the year in our program. I mentioned some political uncertainty in 16 and 17, so that's where you see that initial few periods where the blue line, the secondary market, is below our auction reserve price. And then most notably is early or spring of 2020 when we saw all financial markets start to see huge sell-off, and that also impacted our market, not in the sense that our prices at the auctions dropped, but that interest in the auctions dropped because people in the secondary markets were liquidating allowances that they were holding. And so going into any given auction, we will look at this data to understand if we're seeing patterns that could give some indication of what to expect at an auction. We never share that as the administrator of the market, but it is something that we look at, and we know that it's a product available to some of the entities out there by third-party providers. Next slide, please. And then finally, I do want to flag that, we are linked with Quebec's carbon market. In order to be linked with the market, we have the same market rules, including the unsold allowance mechanism. We have mutual recognition of each other's issued allowances and offsets, and there are no limits on the origin of compliance instruments used for compliance. And in fact, if you're a market participant, you can't tell whether you're trading Quebec or California allowances in the system. All of this program is helped administered through the Western Climate Initiative, Inc. It is a nonprofit, and it provides the administrative services to run the linked program. That includes the single registry system, the same auction platform, and market monitor services. We have been linked with Quebec since 2013, and we've had linked auctions with them since that time as well. We were linked with Ontario, Canada for a little bit, but then they had a change in provincial government, and they were in for about a year and then out for about a year. But what was really telling about the design of the California-Quebec markets is we weathered that. We didn't see pronounced changes in prices or mass exiting of the market, and that really helped to show the resiliency of the design of the program to weather those kinds of actions. And next slide, please. Some additional resources if you want to read more on our program, and I look forward to the conversation with the commissioners after all the panelists are completed. And thank you to the CFTC staff for helping to manage the logistics for today. Thank you.
Thank you very much. We'll turn this over now to Hans and Gordon.
Okay, hello. So I start, and you hear me, I hope? Okay.
Yes.
So if I can get my slides. First of all, thanks a lot for welcoming us from Europe to participate at your event. It's very positive that we have these increased exchanges across the Atlantic, and especially in this important area of climate change. So I will speak a bit about the system as it is, and then I will speak a bit with slides, and then I will speak a bit without slides on a little bit more on this financial aspects. So if I can have the next slide, please. First, a few words about Europe, because maybe some of you don't exactly know how it works. So European Union has 27 member states. It's around 450 million people, and we are working together to have free trade, free movement of people and labor, etc. And we have a lot of common legislation in a large number of areas, and our laws are normally called directives and regulations. The European Commission, where I work, which we often call the Commission, is the executive branch. So we propose legislation, and then we have two co-legislators, which is the European Parliament, and the Council, we call it, which is the sort of group of the national governments of the 27 member states. And when they two agree on legislation, it's our job to implement it. Next slide, please. Yeah, so in this European Commission, we have many departments. We have one on climate change, and that's where I work with the EU ETS. So the EU climate policy has been around since now about 20 years. So we have currently a target, common EU target to reduce emissions by 55% compared to 1990. This is a very new target, only a few months old, and current legislation is based on a 40% reduction. So we are currently right now very actively working on preparing new legislation to step up this 15 percentage points in just in this 10-year period that already started. So it's quite a challenge, both work-wise and time-wise. We have divided the carbon emissions in the EU into groups, basically, around half each, and both are capped by economic instruments. So on the one, which is group, which I talk about mainly, is the large sources, the power plants and the big industry. It's covered with one common cap for the whole EU, which will decline over time, and that's the EU ETS, Emissions Trading System. And then all other emissions, it is capped, but member state by member state. And there's quite a big difference in reduction targets depending if they are rich or poorer member states. But also there is limits on allowances, and the member states can trade between each other if one overachieve and another underachieve. Next slide, please. So EU ETS was put into place in 2005. First, there was an attempt to set up the EU carbon tax, but it didn't work. So in the end, we went for the cap and trade, emissions trading. And it applies to around 11,000 installations, as I said, mainly the power sector and the big heavy industry. It is covered EU 27 member states plus 3 more countries. It's Norway, Iceland, and Liechtenstein, which are part of what we call the European Economic Area. So it's now around 40% of the EU emissions. It was more around 50% when we started, but the emissions have gone down faster in our emission in the ETS area than in the other area, which is road transport and building heating emissions, which is more difficult to reduce. So, like the other colleagues said, two aims of ETS: on the one hand, to cap the emission and set a declining trajectory to ensure that we meet our climate targets in a cost-effective manner. The cost efficiency is very important, and it sets the carbon price to incentivize low-carbon investments. So we have had now we're into the fourth phase. The first phase was 3 years, but more of a test phase, which when it ended, the allowances were worthless. But since 2008, the allowances are a kind of a permanent currency, which can be banked until the future system. And this has created stability, but also some problems, because we had the economic crisis, for example, in 2009, that already led to a certain surplus. But I will come back to that. But we have, since January this year, embarked on phase 4 of EU ETS. Next slide, please. So, like was also mentioned by previous speakers, around the ETS generates a lot of revenues, and we have now in the order of $50 billion generated since 2012. And when you see the price curve soon, you will see, but understand why the large chunk of this amount comes now in the last few years. So last year we were in the order of 17 billion euro only in 1 year. And member states use around 70% of this revenue to tackle climate change. It's also used to finance innovation, and another thing which is perhaps more special to EU than US is that we also have, since we have one common system for the whole EU, despite the very big difference in, let's say, GDP per capita between the more richer income member states and the lower income member states, it's quite an important solidarity element where quite a lot of revenues are transferred from the richer member state to the poorer. We also have quite large special funds to support the modernization of mainly the energy sector in the low-income member states, which often also are more dependent on coal, and we all know their history, so they have more issues to deal with there. Next slide, please. So a little bit more in detail. So 1 ton of the CO2 means 1 allowance, and We have then, of course, the amount of allowances to be issued every year is fixed in legislation. It's one of the most important things that the legislators decide. It was rather rigid in the beginning, but since and that created some problems when we, for example, had an economic crisis when the supply was kind of fixed, but the demand went down very fast. But since 2019, we have a new instrument in place, which we call the Market Stability Reserve, which basically removes allowances from auctioning until we reach a better balance in the market. And it can also work the other way around. If we have a shortage of allowances in the system, it can go from the reserve and out in the market. We have most of the allowances sold on daily auctions. So in fact, we have different studies. We have them very frequently, basically every day, on a platform EX, and the revenues are provided to the member states. So like a typical day, we generate around now $180 million, so quite a lot of money. Another around 43% of allowances are allocated for free to the energy-intensive industries to handle their competitiveness issues. But they use a system where only the most efficient facilities get what they need, more or less. And if you emit twice more per ton of steel, for example, you only get half of the allowances you need. So it's a system that favors the most efficient installations in terms of greenhouse gas efficiency. And the power producers receive no free allocation, so they are the big buyers on the auctions. Next slide, please. And the reason is that they can pass on the cost to their consumers because they're in very little international competition. So our compliance system is that by the end of March every year, each facility operator has to report emissions, which of course have to be verified. And then by the end of April, 1 month later, there is a surrender time. They have to surrender the amount of allowances equivalent to emissions. And we have very high fines for non-compliance, so we have a compliance rate above 99%. So the instrument is very, very well followed. Next, please. So here is basically showing the cap, the full status are the cap as it has been decided. In 2014, 15, 16, we did some temporary reductions of the auctioning because we had a big surplus. And then, so that's the yellow part that was never came to the market. And again, from 2019, we have this amount in yellow, which never came to the market, although that was originally intended. And this is this new Market Stability Reserve. And you can see it has quite a big impact since the rest of the green there, about half is being given out for free. So the amount of auctioning is very significantly reduced. And the system will continue. So we've already calculated it ahead of time how it will impact supply. And the line there shows the emissions, and it has gone down quite a lot. In last year, 13.3%. Of course, it was a COVID year, but the year before it was also around 9%, out of which the power sector reduced almost 15%. So for them, it's very much a matter of switching from coal to gas and from gas to renewable. That has a big impact. But we also see industry is now making more and more efforts. Next slide, please. So this is our price curve. It's a bit more dramatic than what I've seen before, and you can see it just now. We were almost touching 60. This is euro, so you should multiply by 20% or by 1.2 to get US dollars. So we are now around 50 euro, which means around $60. And of course, this is created a little bit of concern on the market and why is this happening right now, etc. But what is quite clear in our view, or in many market analysts, is that earlier this year or late last year, there was this announcement that we should go from 40 to 55% reduction 2030, and that means also the amount of allowances coming out to the market in ETS will also reduce. It took some time maybe for the market to realize it, but suddenly everybody started to believe in this, and then the price has started to skyrocket. And now we are a bit down again, as I said, on around 60, so let's see where it stays. But it's become a very interesting market. Next slide. But you can see in the past we had a lot of around 5 euro for many years, so we had some difficulties to get this market going. Also to generate the incentive for reinvestment that we also want. Next slide, please. So as I said, we will update our legislation, and we will also look at the possibility to introduce an emissions trading for emissions for building, heating, and road transport, and also maritime transport. So the legislative proposal will come on the 14th of July, so very soon. So that's the end of my overall presentation. Then I thought if I may just say a little bit more about the financial aspects, since this is also what you are a specialist in. So according to the European, we have the European Securities and Market Authority, which is the sort of the mother association above the national authorities. We have calculated that the value of the carbon market in the EU is around 840 billion euro per year, so it's quite a lot for us at least. A very large part of this is the derivative market, and most of it are traded on exchanges, a little bit also on over-the-counter. In our view, derivatives are useful because they help the ETS operators, the industry, and the power sector to make contracts where they don't have to put up so much cash, but they can get certainty that they can get their allowances in time for compliance and pay at that time. So this, you all know how this works. And the contracts are offered by exchanges and financial firms, which are free to offer the product and develop their business within the limits of the regulatory framework. So far, most of this secondary market took place in ICE Futures Europe in London. I'm sure Mr. Bennett will talk more about this later. As far as you know, it will move to the Netherlands very, very soon, linked to Brexit, presumably. And when it comes to the oversight, like my colleague said, it's very important to keep now, since we have such a big financial instrument, to have a safe and efficient trading environment to keep credibility for the ETS, both as a climate instrument but also a financial instrument. So the derivatives of emission allowances were classified as financial instruments already from the beginning in 2005. And in 2018, also spot emission allowances were on the list of financial instruments. So basically now all parts of the European carbon market are subject to the same regime applicable to the EU financial markets. And we have this legislation of markets in financial instruments and market abuse regulation and anti-money laundering directive. So maybe I will not go into all the details. I can send some written statement later. But basically we have regulation and supervision of the auction platforms and the secondary market trading venues. We have regulation of the financial intermediaries and rules to prevent and sanction market abuse. For example, market manipulation, insider dealing, and unlawful disclosure of non-public information. And also, of course, against money laundering and terrorist financing. So all of this is well legislated. We also have rules about transparency and position reporting. So on a daily basis, this has to be reported to the authorities, and also every week it has to be given a little bit more details. So we can follow if something strange is happening on the market. Finally, on the cooperation between competent authorities, so in the EU we have 27 national authorities and then the European one. And they also can exchange information with countries outside of the EU. So all EU national authorities are members of the International Organization of Securities Commissioners, and they also cooperate with the SEC and this EU, as you said, CFTC. And since transactions in emission allowances can happen both in the EU and outside of the EU, it's important to have a good cooperation in place between the relevant authorities. Following the increased interest in carbon trading because of this increased price, we have some entities that might be associated with speculation that also increase their interest in the carbon and activity in the carbon market. So, although the information we have on total open position show that we hold a relatively small share of the market. It's important to follow this development. And the political pressure on us increases also to kind of do something about it. But so far we are keeping thinking that this market is healthy as it is. We also look forward to having more cooperation with the U.S. So thank you very much.
Thank you. Gordon?
Hi there. Good morning, and thank you for the opportunity to present on not one but two panels today. I feel honoured. My name is Gordon Bennett. I'm Managing Director of Utility Markets at ICE, which means I'm responsible for ICE's natural gas and electricity portfolio outside of North America, together with our global coal portfolio, and most importantly, for the purpose of today, our global environmental portfolio. In today's first panel, I'm clearly the odd one out, as the previous presenters are all important policymakers for cap-and-trade programs, whilst I represent an operator of a network of financial markets. However, I'm more than happy to provide an overview of ICE's newest market in carbon cap-and-trade, which is the UK allowance. But before I do provide some details on the UK ETS, I would like to briefly introduce some macro themes around finance and the energy transition, and in particular, carbonomics. Arguably, the UK, as part of and along with the EU, witnessed the birth of carbonomics 15 years ago with the introduction of the EU ETS in 2005. If we could go to the next, yes, one more slide, please. So the purpose of financial markets is to allocate capital and manage risk, and valuation is at the core of this. If I go back to my accountancy roots, there's a three-tiered fair value hierarchy with quoted markets sitting at the top, such as ICE's New York Stock Exchange equity markets and ICE's derivative exchanges. Why do they sit at the top of the fair value hierarchy? It's because these prices are executable and can transfer risk, and therefore are the most precise form of valuation. And this risk management function is integral to the growth of the real economy because they allow corporates to smooth their earnings and, importantly, provide access to more forms of capital and cheaper forms of capital. So we're now entering an era of sustainable finance where different valuation methodologies are required to value externalities such as pollution. This is the era of carbonomics. Next slide, please. The energy transition, or the latest energy transition, because energy has been transitioning since the dawn of civilization, is changing the current merit order of energy use to meet the goals of the Paris Agreement. We use energy for heating and cooling, electricity, mobility, and a feedstock for products. In order to meet the goals of the Paris Agreement, this merit order will need to adapt towards less carbon-intensive energy, and one of the keys to enabling this transition is the application of carbonomics. Next slide, please. And so here we come to the UK, and in particular the UK electricity sector. As Hans said in his presentation, the electricity market does not get any free allocation, and so the UK electricity and the European electricity sector have been living with carbonomics for 15 years now, and so it's the best example of carbonomics in practice. So the application of carbon pricing through cap-and-trade programs, and in the UK's case with some unilateral policy support, has successfully removed coal from the merit order of electricity generation. The application of carbon pricing effectively addresses the green premium issues that Bill Gates refers to in his book, How to Avoid a Climate Disaster. Carbon pricing erodes the green premiums. And so, when we refer to the electricity generation sector under a traditional economic model, the gross profit margin of a coal-fired power station is referred to as the dark spread, is higher than the gross profit margin of a natural gas-fired power station, referred to as the spark spread. And so coal is the highest in the merit order based on a traditional economic model. However, if we apply the cost of carbon, as coal is twice as carbon intensive as natural gas, carbonomics changes the merit order so that natural gas is more profitable. This is called the clean spark spread, and it appears higher in the merit order than the clean dark spread. And in this graph, you can see the line at the bottom is the clean dark spread, and it's important to know not only is coal less profitable, coal is actually loss-making. So for every megawatt hour of electricity produced, you're losing money, and therefore this moves coal out of the merit order. It is important to note that carbon pricing doesn't work on its own. So when I refer to dark spreads and spark spreads, the values of the other parts of the equation are important to generate the desired outcome. So whatever your view is on different types of fuels and their carbon content, knowing the value of these fuels is integral to carbonomics. Next slide, please. And this is the outcome. This is the electricity generation by fuel source since 1998. And effectively, today coal is all but removed from the electricity generation merit order in the UK. Next slide, please. So the next slide shows the transition that has been made in the UK over the last decade, which has now resulted in emissions being reduced by approximately 40% from 1990 levels. We're now looking to see how this further develops in the future and under the UK ETS rather than the EU ETS. The next slide, please. And one more, please. So the UK ETS, this should be relatively brief because we're really at the very beginning of this program, although it came into force at the beginning of this year. The first auction and the opening of the secondary market was actually only 2 weeks ago, so we're witnessing the birth of the UK ETS. So my objective is really twofold: to benchmark the UK ETS versus the other cap and trade programs that the panelists have discussed before me, and to give some insight into how the commencement of trading has behaved since the 19th of May. Next slide, please. Oh, sorry. So the UK ETS is very much a lookalike of the EU ETS. There are some minor differences in the operation of the auction. So the UK auction actually looks a bit more like California and Reggie, as there is an auction floor price. It's £22. And the auction can clear with partial allocation. So there's some minor differences between the UK and the ETS, but they're largely the same. There are also there's a little bit of difference in cost containment measures in the first 2 years for the UK ETS, but after the third year, I believe these align also with the EU ETS. So the slide shows the current cap for the Greenhouse Gas Emissions Trading Scheme Order 2020, and in the dark teal, and then in the light teal, we have the provisional emissions for 2020. However, it's important to note that the cap here is before the recent government announcement to reduce emissions to 78% of 1990 levels by 2035. And so there is going to be a cap consultation due later this year. The government indicated that it would consult on the cap's trajectory within 9 months of the National Climate Change Committee's advice on cost-effective pathway to net zero emissions. This advice was published in December 2020 and included recommended levels of emissions from covered sectors to be 106 million tonnes in 2023 and 61 million tonnes in 2030. And those are shown in the red lines in the graph. Next slide, please. What does the UK ETS look like versus the other cap and trade programs? No surprise, really, that the EU, given that it's covering 30 countries, is by far the largest in terms of installations. The UK does, however, rank second in installations and also in terms of the cap. California is the most ambitious in terms of emissions covered. So I think we saw earlier that it was 80% of emissions were covered under the Californian program. And this is really driven by the inclusion of transportation and heating fuels, whereas the EU and the UK is focused on electricity generation and heavy industry, and as spoken earlier, Reggie is solely on electricity generation. And the bottom graph on the right-hand side shows the cost of carbon, and the UK is leading in terms of the cost of carbon at nearly $70 per tonne. Next slide, please. So how have the auctions and secondary market performed in the first two auctions? The auction performance has shown very strong cover ratios, and the first two auctions have raised over £500 million for the UK government. The secondary market is approximately 500 lots a day, or 500,000 tonnes. In the graphs, I've shown how the UKA benchmarks against the other cap-and-trade programs we operate. The top row shows on a lot basis, and the bottom row is on a notional basis. As the EUA is so clearly the largest, I've also stripped out the EU numbers in the right-hand column to get a better comparison of the relative size of California, Reggie, and UKA together. So the UKA at 500 lots a day is about half the size of Reggie on a sort of annual moving average basis. But in terms of notional value, has already overtaken Reggie. The UK ADV would need to rise to approximately 2,000 lots a day to become the second largest cap-and-trade program by notional value, overtaking California. In the 2 weeks since we have operated, however, if you compare Reggie ADV and UKA ADV, they are both coming in at around the 500 lot ADV mark. So they're quite similar in cap sizes. They're also quite similar in ADVs currently as well. Next slide, please. This just shows the daily breakdown since launch and the growth of the open interest. And I can report as of this morning, the open interest was reaching nearly 3,000 lots or 3 million tonnes. And then lastly, next slide, please. My last slide shows how emissions have been reduced in the UK since 2010, showing the emission reduction has largely been targeted at the fuel combustion sector, electricity generation. As per the earlier slide, the UK has already transitioned away from coal to natural gas and electricity generation. And so the UK ETS is really a test of policy post-coal to gas switching. So it's going to be very interesting to see how policy develops in the UK carbon cap and trade market, because those easier wins in the electricity generation fuel sector have largely been won now. So how is electricity generation going to continue to decarbonize, and how will the industrial sector, who have largely been allowed to get free allocation, how is the industrial sector going to start to decarbonize more under the UK ETS program? And then finally, what happens with those sectors not covered by the cap-and-trade program? Will we see more ambition in terms of, will it look more like California in also addressing heating fuels and transportation fuels? Thank you very much.
I think I may have been on mute there. Let me try this again. I'm going to open the floor now to questions and comments from the associate members on the prepared remarks. And Abigail, I think we have one question in the queue from Paul Ciccio. Is that correct?
Yes, that is correct. Thank you.
Okay, thank you. Paul, please go ahead.
Sure. Hey, thank you very much. I can't think of anything more important than addressing climate and succeeding to reduce greenhouse gas emissions domestically and internationally. And so this is an extremely timely target. As a Reminder, though, my organization represents energy-intensive trade-exposed companies. These are steel, aluminum, cement, chemicals, plastics, glass, paper, food processing. And these industries in the United States consumes about 80% of all the energy of the entire U.S. manufacturing sector. And the manufacturing sector in the United States is very large. We are 11% of GDP, and we employ around 13 million really well-paying jobs. So my primary comment here is this assumes a carbon tax will be placed on domestic industries such as mine, and we are unique in that we do compete with the likes of producers of these products from places like China. And in fact, our carbon footprint is a lot less per output than China by quite a large measure. So if we're going to talk about carbon pricing, we have to talk about a border adjustment. Because without a border adjustment provision, then these manufacturers, these energy-intensive manufacturers, will shift their production offshore. That's called greenhouse gas leakage. And so you shift these greenhouse gas emissions offshore without, and the jobs for that matter. And we don't want that. Nobody wants that. And so one of the things I would recommend, Mr. Chairman, for maybe the next Commission Advisory Committee is that we have a session on border adjustment. To finalize my comment before I ask a question is, a border adjustment may sound easy, but it's not. A border adjustment requires our competitors in foreign countries like China to third-party validate the embodied carbon in the product that they import into the United States. Getting them to do that is hard. And you have to have that country support to enforce that third-party validation. And as we all know, the weak spot of the Paris Climate Accord is enforcement. And so this kind of really gets to the heart of it. If we're going to do it, we have to do it right and not gloss over this very important issue of greenhouse gas leakage. We need manufacturing jobs. In fact, we need more manufacturing to produce the products for the clean evolution going forward. So my question to the EU especially is we understand that there are efforts on the part of the EU to establish a border adjustment provision, and I'd like to hear from that. Thank you.
Am I supposed to reply now, or?
Yes, please go ahead.
Okay. Thank you for that question. Yes, well, to take one step back, from when ETS was created from the very start, the competitiveness of the energy-intensive industries was, of course, a key issue to deal with, and therefore we already from the start created a system with free allocation to industry so that they would get most of their costs covered by this free allocation, but still have a marginal cost for increasing emission and marginal benefit for reducing emissions. In the beginning, the system was a bit crude, and it was more based on past historical emissions. So the more facility emitted, the more free allocation they got. Then we changed from 2013 to this benchmark-based system, as I said. So basically, the most efficient installation gets more or less what they need in a certain sector. We have around 50 different product benchmarks. So, for example, a ton of steel, a ton of certain chemical or something gets this amount of allowances, and then if you emit more per ton, you have to buy the rest. It has worked quite fine so far. I mean, we haven't seen much proof of this carbon leakage, which is indeed a problem, because if we move emissions abroad, we didn't gain anything, and we lost jobs on the way, as you say. Now, with increased ambition and as has been announced, increased carbon prices, there has been a political statement that we should even more think about this issue. And the carbon border adjustment mechanism, as we call it, has been promised to be part of the proposal on the 14th of July. And so you can imagine it's a little bit difficult for me to go into details because it's one of the issues that is being discussed, I think, until the last day of that 14th of July, how that exactly will look like. But there will be, it's because of ETS that there is this potential, competitiveness problem, so that will be somehow the link to it. Then we have the issue, as we all know, it's difficult with how to know the data from outside the rest of the world and possibly political issue, etc. So there are many issues to deal with, and I think it's a bit difficult for me to go into more details than that. You will have to be a bit patient until the 14th of July. Hopefully that day we will have our proposal, and then that can be studied and surely very much discussed. The good thing, I think, about this is that many countries around the world have been contacting us in the European Commission and say, what do we have to do to not be covered by this border adjustment for our industry? So put a little bit of speed behind some slow-acting countries, but nevertheless, it will not come without a lot of discussions for sure. But until then, we will continue with the free allocation. I understand this is what also our colleagues are using often as a system. Thank you.
I believe Matt Picardi has a question. Matt, please go ahead.
Yes, thank you. Thank you, Dina. Quick question for Hans and Gordon. In the U.S., I would say that our carbon emission programs that or market-based ones that have been developed so far focus on, compliance and efforts to reduce emissions at sources. And they're run in conjunction with programs such as renewable portfolio standard programs or state-type programs that provide incentives for the development of renewable resources. I was just curious, how big a role do the carbon markets that exist in the EU play in supporting the development of renewable resources at this point in time?
I don't know. Maybe I can start if you want. But okay, I think when the renewable power production mainly was in its infancy, if I took away the hydro, which has been there for 100 years, of the wind, etc., there was a lot of let's say state support for that. And but when ETS was coming in more and more, the need for, let's say, subsidies has really vanished. I would say for the most of the renewable electricity, the more, let's say, standard, and the carbon price creates that incentive by itself. So now what we and member states more give support to is what we call newer technology, renewable energy, and also say infrastructure, etc. While so certainly the carbon pricing has very much helped in the power sector, and I think that was Mr. Bennett just showing in with his slides. Maybe he can show it. But we have the subsidy schemes that were created for the renewable energy are sometimes, of course, they were sometimes given for 10 years or so. So some of the producers are now probably getting quite a good benefit because they have the low cost because of the subsidies, because it was thought to be very expensive. And now the electricity price is somehow going up a bit because of ETS, and that gives an extra benefit to this renewable electricity, which has basically zero cost in operating costs. But maybe Gordon Bennett can fill in a bit.
I would agree with all of that. So, in the beginning, when renewables were more expensive, then there were certain incentives in place, whether those were feed-in tariffs to de-risk renewable investment, and those were complemented by the carbon pricing. But as Hans said, now we live in a world where really renewables is merchant and doesn't need the feed-in tariffs or tax incentives, and coal has come out of the merit order, and increasingly renewables has come into the merit order solely because of carbon pricing. I think that the question is now, what policy support is required for whatever the next renewables is going to be. So whether that be hydrogen or carbon capture, because as I said in my presentation, that that first win of coal to natural gas switching is largely being done in the UK, and it's increasingly being done in the EU. So how does hydrogen and things like carbon capture get into the merit order? Is it solely through carbon pricing, or is it also going to require some sort of policy intervention, incentivization to de-risk the investment required in those markets?
I think we have at least one more question from Sean Cota. Sean?
Good morning. Can you hear me, Deanna?
Yes.
Thank you. I have a couple of questions. One's for Gianna Reginder from Carbon. I apologize if I've mispronounced your name. In a CARB allocation system like that California has developed, is that workable in a regional setting like has been proposed in the Northeast with New York and expanding, and how would they handle the leakages? So that's one question for Gordon. How does the UK measure carbon with the ICE program? Is it everything abiogenic and biogenic emissions, and how do they allocate that? Thank you.
Hi, and you got my name right at the end, so no apologies needed there. For the allocation system in California, it's important to recognize the role of allocation to the players in the market, and we give it to energy-intensive, trade-exposed companies. So it's really manufacturing. It's not our transportation fuel suppliers. It's not our electricity generation plants, because they are able to pass the cost of compliance in the market on to consumers. And so in California, we have a unique situation with our transportation fuels that it's kind of an isolated market because of the specs for our fuels to address air quality issues. And on the electricity markets, we've been pushing on renewables for a very long time, and we've actually pushed out coal over the last 10 years almost entirely out of our portfolio in the state. So when I think about the regional programs such as the Transportation Climate Initiative, and we're talking about transportation fuels, we would not give transportation fuels free allowances. And so if the TCI state decided that was something that they wanted to do, then a new methodology would have to be developed for that. Like, what is the basis? What is the potential for leakage? And people are going to go buy gasoline. It's not like people are going to stop selling it, because there's going to remain a demand for it until there's an alternative for it. So the potential for leakage is very low in those sectors. And with the industry, we have a process that we look at global markets, global trade exposure, and regional trade exposure to understand how much we need to, quote unquote, protect industry from leakage. And that process has been modeled after work that was done in Australia, work that was done in the EU ETS. And so there's some very basic features in all allocation schemes for industry that you'll find from program to program, and with little tweaks here and there for that specific region of the world. I hope that helps.
Sean, did you have another question?
Yeah, hi there. Sean, I think you had a question for me. So the cap and trade program only covers electricity generation and heavy industry. So agriculture and land use don't come under the cap and trade program, but those emissions are counted. So the UK's emissions include agriculture and land use, but they're not covered under the cap and trade program. And I'm not sure if any cap and trade programs cover those markets. Thank you.
Okay. I believe that Dr. Standor has a comment and a question. Dr. Standor, please proceed.
Thank you. I'm 700 years old, so I couldn't be more pleased to have some comments. It's hard doing this from Geneva 30 years ago, going into the Rio summit when people would say, oh, carbon markets will never work, they're silly, price is not important, they'll get it all wrong. And listening to each and every one of the presenters, I think would make anybody who had skeptical doubts about carbon markets would turn their heads. And this presentation would make Ronald Coase and J.P. Dale's very, very happy to see that their ideas have been implemented so well. So from Rio to Kyoto to now, what a journey and a brilliant presentations by everybody. There is a point and an observation and a question. So I have the privilege of being at the opening of the Chinese carbon market this month and to make a presentation at Fudan and you have all armed me with great evidence. So my question quickly to each of the participants, what, if any, arrangements are you making to integrate the Chinese cap-and-trade system into Reggie, California, or Europe?
Who wants to jump in and tackle that first?
I'm happy to try and go first. So in our program, the linkage we have with Quebec is very unique. We started from the same place. We built our programs up together. They have very similar features. More recently, maybe about 4 years ago, we added provisions into our regulation that would let us do other kinds of linkages. So linkages where you send your instruments to another market, or linkages where you are now able to accept linkages from another market. And so we foresee that there are options out there for the different kinds of integration with programs that are not exactly the same as ours. And we've had discussions with the different jurisdictions about what that could look like and what that could mean. The challenge is always going to be that any linkage has the potential to reduce the ambition of your program. And so there are certain requirements in legislation in California where we have to analyze if any kind of linkage would in any way reduce our ambition. And so that test is really critical, and that's going to depend on the design of the other program. So the potential is there. It's going to depend on the type of program, the ambition of the other program, and the kind of linkage they're looking for.
This has been in Maryland, and on behalf of Reggie, I just wanted to say that a couple of years ago, we entered into a formal MOU with Chinese energy markets to help inform them on lessons learned from Reggie over the last decade, and also to provide technical advice or support. World Wildlife Fund and EDF were involved in that too. So I would just add that it's a very important point, and we're in the intentional learning and sharing mode with the Chinese. They attempt to make historic progress on this front.
Maybe on our side also to say, on the one hand, with China, we have also been working a lot closely with them for many years to provide our at least advice or knowledge sharing with them. When it comes to, we think it's of course good that they are going in this direction. When it comes to linking itself, we have our main experiences that we made a linking with Switzerland, which had it's a very tiny ETF compared to the EU, but it was a good learning exercise in that it's relatively complicated, more than we thought perhaps. And I think like colleagues from California said, what is in principle a good idea and attractive is also a little bit risky, because on the one hand, once you link to systems, you have to be sure that you don't water down your own system. But what is also perhaps even more difficult, you don't know what will happen, what kind of government will operate in that country a few years later. And if they turn 180 degrees and you have things linked, you have to be very careful. So I think you need to write a lot of sort of very good lawyers involved, because this is now not just kind of nice cooperation, but it's really $1 billion, as I said, every day being traded. So if something goes wrong, we can have a lot of problems. We were trying to make a very strong cooperation with Australia. We worked, and they came over to Europe on a weekly basis almost, and then the election, and then the whole thing was thrown in the bin. So, that can happen. That was before we were linked, but I'm just saying that it's good to link, to cooperate, but it's also a little bit of risk.
Abigail, do we have any other comments or questions from the associate members?
We do not. We do have a question, 2 questions from Tyson Slocum for the members.
Okay, well, we will move to the members then. Thank you very much for the associate members for your questions and comments. So, Tyson, we're opening up the floor to the EEMAC members on prepared remarks. I think you've indicated you have a question or a comment, so please go ahead.
Great. Thank you so much. First, I just really appreciate the presentations by the panelists. It was excellent. And my question was sort of addressed by elements of Gordon's presentation and by Matthew Picardi's question that the carbon pricing initiatives that we've seen, particularly in the United States with Reggie in California, are not happening in isolation. They are part of a package of policies and market developments, other policies like renewable energy mandates, market developments like declining cost of natural gas replacing coal, and significantly cheaper renewable energy, and flatlining energy demand. I think one of the big benefits of carbon pricing as a part of other policies and initiatives to address emission reductions is the fact that it provides revenue that can be invested for a number of useful emission reduction initiatives. Like in Reggie, there's a lot of money dedicated to energy efficiency. California has a number of very successful, robust investment initiatives. But I just think it's important to note that it doesn't appear that the carbon pricing policies in the United States, anyway, are the driving force in the emission reductions that we've seen. We've seen emission reductions from the power sector in all parts of the United States, regardless of whether or not there is an active carbon pricing mechanism or not. So I think it's an important tool, but it is not the only tool to address greenhouse gas emissions. Thank you very much.
I don't think we have any other questions from the EEMAC members. Is that correct, Abigail?
Tyson, did you have a second question?
No, I'd put it in the chat and people could see it. So it was just on the role of offsets in carbon pricing plans and whether or not they are effective at resulting in real emission reductions, or whether or not there are compliance challenges associated with them. And so I don't know if anyone wants to, comment or respond to that.
If you want, I can say a few words. Just from the European perspective, that I think around 10 years ago there was a lot of the general view was that it's very good to have these credits, and it doesn't matter where emissions are reduced as long as they're reduced and cheap as possible and all of that. So we allowed quite a lot of this kind of clean development mechanism credits in the EU ETS. And it led for us to, on the one hand, the surplus, but maybe that was our fault that we allowed too many, but also quite a lot of discussion, were they really genuine emission reductions? And in the end, we have now, from 21, we have our target is what we call domestic, so everything has to be reduced in the EU. Then we can help by, development aid, money, and all kinds of money to support poorer countries in the work, but not to take their credits. It could be that this discussion comes back when there will be even more tighter targets coming ahead, post 2030 and all of that. But in that case, it would be very strict, I think, and very limited and very well controlled. Yeah. So It's at least for us, it's something that we try now to clean up our own backyard and not do it elsewhere.
And I can speak to the California program because instead of trying to model after the clean development mechanism or leverage some of the international program work that had been done previously, we created our own domestic offset program because there were concerns about the validity of offset programs and credits that had come before our program. And our design took 4 years through a robust public process. It was litigated by critics of offsets in California who think that offsets are just a free pass to emit. But we always had limits on the amount of offsets you could use because we wanted to make sure that the regulated facilities actually still face a pressure or an incentive to reduce on-site. The other value of offsets is they help with cost containment because they sell for slightly less than the allowance prices. And they allow you to fund activities where you can't necessarily directly regulate. Maybe, we have a lot of land in California that is privately owned. Landowners, like forestry landowners, are very protective of their rights to manage their property the way that they want to manage it. And so offsets offer an opportunity to act as a carrot to help people come along and do the sustainable management practices that you need to help those lands actually be part of the climate solution and managed in a productive way that helps on the overall picture. So we do think that they are important. We've had a program designed specifically for California. It's been litigated, and limits on offsets are also important.
Hi, it's Gordon. If I may add a little bit as well. So I think that offsets are certainly difficult. There's inherent issues around permanence and additionality and measuring quantity. The great thing about cap and trade programs is it's really the only way to control the quantity of emissions. But I think there are real benefits to compliance programs allowing offsets because it creates a demand pool. And it links it to a transparent compliance ton. And so you do get that linkage, So Rajinder said that California allowed them ICE a California carbon offset, and it trades as a spread to a California carbon allowance. So I think that despite all of the challenges that are inherent in the offset market, I think that compliance markets have a real role to play to help set what that high bar of an offset is with environmental integrity. Thank you.
I know that time is limited, but I just wanted to add on the offset point. I hope the Commission continues to pursue and look at the opportunities for offsets with respect to carbon markets. The political challenge of environmental justice, toxic accountability. So Reggie has not vigorously implemented. It does have the opportunity on a very limited basis, the use of offsets. The Transportation and Climate Initiative also in the draft approach on that emerging program also would have a very limited opportunity for offsets. As someone who also represents the Chesapeake Bay, the nation's largest estuary that is in the U.S., the possibility for carbon markets for water quality and carbon sequestration throughout the watershed is very important, and the states that are part of Reggie and that are part of the Chesapeake Bay Agreement with the EPA are discussing the possibility of offsets and carbon markets for the future. But it is there's a significant challenge, a real challenge of accountability and political acceptance to use offsets more often. So I hope the Commission continues to look at that possibility. I think it's the future with appropriate controls. Thank you.
Thank you all. And now we will turn to questions from the commissioners. And I believe Commissioner Berkovich has a question to ask. Please go ahead.
Yes, thank you, Dina, and thank all the panelists for really excellent presentations. I just have a really basic question so I understand, for example, the California and the Reggie program. So, for example, in Reggie, a regional program that the states issue the allowances. So there's Secretary Grumbles, if there's a 30% reduction, or if Reggie as a whole decides on a certain percentage of reduction, but the states issue the allowances, does that 30% flow down to everybody, or and each state has 30%, and then the states do 30% across the board to everybody? And is that how it works? And similarly for California, when California issues a certain target, does it flow down equally to everybody? And then the participants amongst themselves, that's the whole point of cap and trade, essentially, that everybody can decide who best how to get to that 30%. Secretary Grumbles, maybe you want to take that first.
It does slow down, but it's also the 30% component of our regional cap has to be implemented under state law in each of the states. So there is some flexibility on how each of the states gets there, but the goal is to get to 30%. And of course, when we couple our renewable portfolio standard and other complementary programs, we're trying to get to 56%, half as dirty by 2030, 56% reduction in greenhouse gas emissions in our state. So it's a regional cap, and each of the states commits to try to put in place to do their part to ensure that region-wide we get to at least a 30% reduction.
And that commitment has Reggie was started. When was Reggie started?
Back in 13 years ago is when we had our first auction, 2009. But there were formal agreements among governors dating back a few years prior to that.
And that regional agreement, and that's withstood. You've described the new states that want to come in, but in terms of the existing states, that's pretty much survived the various. There have been various political changes in governorships and in legislatures.
It survived political changes. There have been a few legal challenges that have not succeeded, trying to say it was an interstate compact. So flexibility is very important for each of the states, and political leadership and use of the market to set the prices and not give the allowances to the regulated entities, but direct them to use the market, the auction and the secondary market, to make sure they have the requisite number of allowances each time the control period, the compliance period occurs.
Okay, thank you. And then California, when you set over these overall goals, is it then that's the point of cap and trade, that the entities figure out how to best some industries have more need or less need. Can trade them.
That's correct. Yeah, that's correct, Commissioner. So it's an aggregate cap set at the state level for GHGs. There's no sub-cap for individual facilities under the program, because these are not like traditional air pollutants that have a localized impact. They're a global emission. And so if the state is achieving that jurisdictional-wide target, we believe that is the right approach. We did look at an option in 2017 in response to some of our environmental justice advocates who wanted us to take that aggregate cap at the state level and apply it at every individual facility. So every individual facility would have to reduce by 40% by 2030. What we quickly realized is that some industry that was high leakage exposed, and that was there was very limited technology known of right now to get them to that 40%. We just had to turn those off in the modeling because there was no option for them to get to that 40%. And so the cost for doing that individual cap per facility versus the aggregate cap was almost an order of magnitude higher to the economy by 2030 and to jobs and household income, just because of the fact that you applied that aggregate level at the individual facility level. And so we did the exercise because our environmental justice community wanted to look at it, and it became quickly apparent that it was something that would just wreak a lot of havoc on the economy for the state.
Okay, thank you.
I don't think we have any other questions from commissioners. Is that correct? Any commissioners have any questions?
We don't have any questions at this time. Thank you, Dina.
No further questions, right? Abigail, I'm sorry, I couldn't hear you.
Yes, no additional questions at this time.
Okay, all right. Well, thank you all for the participation and the presentations on the first panel. We will go ahead and move to the second panel today, which will provide a survey of carbon derivatives products listed on 3 designated contract markets. We're going to hear, again, Gordon's joining us for the second panel as well as the first panel. We'll hear from Gordon Bennett, the Managing Director of Utility Markets at the Intercontinental Exchange, Christian Scheider, the Managing Director of Strategy at Nodal Exchange, and Derek Salmon, the Senior Managing Director, Global Head of Commodities and Option Products at CME Group. Gordon, we'll take it back to you.
Hi there. Thank you. Hello again, everybody. My objective for this panel is to give an overview of the ICE environmental portfolio and an update on performance and any new initiatives since my colleagues Mike Kierstead and Stephen Hamilton presented to you previously. First of all, as discussed in the first panel, ICE offers solutions, whether quoted markets or complemented by data services, access to being able to fair value products and to drive sustainable finance decision making. If you could turn to the next slide, please. Sorry. And the next slide, please. Importantly, ICE entered the environmental markets at a very early stage of its development, going back to 2003 with its collaboration with the Climate Exchange, and Mr. Sanders is here, and it's great to hear from him. And then the subsequent purchase in 2010. So we have a long history in operating environmental markets. The New York Stock Exchange hosts sustainable ETFs of over $5 billion in value, and Stephen Hamilton would have introduced you to our ESG equity futures portfolio at the last meeting. Our ESG data offering is expanding rapidly to help customers attribute value as we grapple with the transition to a sustainable finance business model. Next slide, please. However, for the purpose of this meeting, I will focus on our environmental portfolio. And next slide, please. And one more. So this slide gives an overview of our environmental portfolio, which we split into carbon and green products. Our carbon products are further split between allowances and offsets. Allowances are issued by regulators in cap-and-trade programs and are highly standardized. And importantly, as I said earlier, it's the only mechanism available to control the quantity of emissions. And so from a net zero perspective, the cap, the quantity of emissions, can therefore be aligned with a net zero roadmap and commitments. Offsets are created when a project reduces emissions and where emission reductions are only economical if there is additional revenue from the selling of the offset. This is otherwise known as additionality. Most offsets today avoid new emissions rather than reduce emissions, with the exception of carbon removals, whether nature-based or technology-based. And in contrast to a carbon allowance, does not control the overall quantity of emissions. Our allowance markets of EUA, UKA, CCA, and Reggie were all covered in the first panel session. And until recently, we offered 2 offset contracts, the CER, the Certified Emission Reduction, and the CCO. These were effectively compliance offsets because both the EU and California allowed the percentage of covered entities' compliance obligation to utilize offsets. And as I said in my answer to a previous question, this created a demand pool for offsets and also led to the pricing of an offset being anchored to a transparent liquid allowance market. Under Phase 4 of the EU ETS, offsets are no longer allowed to be used, and therefore we've recently delisted our CER contract. And so for the moment, the CCO is our only offset contract in the environmental portfolio. Our green products include both renewable fuels such as biodiesel and ethanol and renewable attributes such as renewable electricity certificates. These attributes are sometimes referred to as guarantees of origin, and in the electricity sector, for instance, allows participants to green their electricity consumption. The renewable electricity portfolio is perhaps less well known than our carbon portfolio. covers a number of power markets in the U.S., and it surprises many people when they find out that the most liquid renewable electricity markets in the world are in North America. Like the carbon cap and trade programs in the U.S., these are also state-driven initiatives. Next slide, please. So to get an idea of the size of ICE's carbon markets, on this slide we show the tons that are traded in ICE's carbon markets in aggregate, but also under each cap and trade program, and almost 14 gigatons or 14 billion tons of carbon trades on ICE each year. That's equivalent to 40% of the world's energy-related carbon footprint. In 2021, approximately 60 million tons and $3 billion of notional value is traded each day in our markets, and approximately 95% of all traded environmental futures and options are traded on ICE. The open interest of our carbon portfolio in Europe and USA is approximately $100 billion and $10 billion, respectively. Next slide, please. Some other 2020 highlights include strong year-on-year growth of 14% in our environmental portfolio open interest. The EUA market, in particular, has seen very strong growth in ADV, and EUA options have hit an open interest record of over 800,000 lots, or 800 million tons. In the USA, Reggie has seen the strongest growth, with ADV up 75%, and our US REC open interest is up 15% as well. And in fact, leading up to 2021, the U.S. portfolio was actually our fastest growing portfolio within the environmental complex. Next slide, please. I will touch briefly on the offset market. Clearly, there's an increasing focus on the role of the offset markets, with many working groups being set up, including the Task Force for Scaling Voluntary Carbon Markets, which we sit on, and I think you'll hear from Annette later. As you will see in the next slide, the offset market is not new. It's been around for many years, and ideally will play a complementary role to allowance markets in achieving net zero targets. Importantly, if we are to meet net zero targets, we probably need a way to value natural capital in such a way that there are economic incentives to preserve rather than extract natural capital, and offsets could play a key role in creating value in preservation. Next slide, please. This slide shows the relative size of the offset market. On the left-hand side, the voluntary market is benchmarked along with the compliance markets of EUAs and CCA. And like I did in the first panel, I've stripped out EUAs because it's so much bigger than all of the other markets. It's difficult to distinguish other markets. But the offset market today is small in comparison to the compliance market. However, the period between 2008 and 2012, there was actually a fairly robust tradable offset market in the ICE specified emission reduction. Over this period, approximately 3 billion tons of CERs traded. These CERs were allowed to be utilized for compliance purposes under the EU ETS, and therefore traded as a spread to the EUA. It effectively created an international price of carbon denominated in euros. In the table at the bottom, it shows that there are many different types of offsets and quite a wide range of values between those offsets. I'd also add that the largest component of offsets today are renewables, and there's quite a large swathe of opinion now that the discussion around whether renewables continue to meet the additionality test. So perhaps when we're thinking about offsets, the mix of offsets that we have today may look very different in the future and to help sort of meeting our net zero targets. Last slide, please. So my last slide covers our most recent offering in the carbon space, which is our Global Carbon Futures Index. We launched this approximately a year ago. This is our volume-weighted aggregate index of ICE carbon allowances, the contracts being EUA, CCA, and Reggie. We'll hopefully be adding UKA in the course of the next year or so. The purpose of this index is to bring transparency to carbon pricing of the most liquid carbon allowance markets in the world, really trying to create a proxy for a global price of carbon. And as carbon evolves into its own separate asset class, the index can serve many purposes, but initially we think it's a useful benchmark for corporates regardless of whether they are subject to carbon cap and trade mandates or not, to be able to benchmark their own shadow or internal price of carbon assumptions in their business models. And so finally, this is the era of carbonomics, and as I always start my presentations at ICG Europe board meetings, carbon will become the most important asset class in the world. Thank you very much.
Thank you, Gordon. Christian?
Yeah, good morning. My name is Christian Schneider. I'm representing Nodal Exchange and EX Group today. First of all, I'd like to thank Commissioner Berkowitz, Chairman Benham, and the Commissioners for giving me the opportunity to speak and to share my perspective on carbon markets. Also, special thanks goes to Abigail for the excellent preparation of this meeting. If you could go to the next slide, please. So let me start here with a very quick intro of EEX Group. We are a specialized commodity exchange group. We operate energy, environmental, agricultural, and trade markets. And apart from commodity derivatives, we also run physical spot markets. We're active in environmental markets since about 16 years now. And the companies belonging to the group, which you can find in the lower part of the slide, they all specialize in different markets and provide local support for the local customers. So, for example, Nodal Exchange covers all the U.S. markets, and they belong to the group since about 4 years now. We are present in 17 locations worldwide and are part of the Deutsche Börse Group. Next slide, please. So, when talking about carbon markets, I thought it's important to first take a step back and look at the bigger picture, because carbon emissions are a real global challenge, and it can only be addressed collectively by all countries. So where do carbon markets exist as of now, and where not? And the map you see here is borrowed from the ICAP, International Carbon Action Partnership, which shows the state of emission trading schemes in the world. It's the most recent one, and you can see in blue those ETS which are already active, in dark green those that are under development, and light green these are at least under consideration. And I hope it gives you a little impression about global coverage and the state and the roadmap of carbon markets worldwide. So far we covered 16% of greenhouse gas emissions with emission trading schemes. The Europeans went first with the EU ETS in 2005. The US is present with the two regional schemes for California, Quebec, and Reggie. So these are the two largest carbon markets today. But also let's keep an eye on China, which announced to go fully operational with their carbon trading on national level this year, which will become the largest market by cap at least. Without mentioning all the carbon markets, I think in the end, no matter how big or small an initiative is, everything counts towards our common goal, which is limiting the global warming by eliminating carbon emissions. Please go to the next slide. And eliminating carbon emissions is a big target in itself because we have to reduce more than 50 billion tons of man-made CO2 equivalent greenhouse gases, which we emit every year to zero, or achieve net zero carbon neutrality, to be more precise. And carbon pricing through carbon cap and trade schemes is an important mechanism to support that. Not the only one, that's true, but a very important one, because through the market we can determine the most cost-efficient way for a transition to a low-carbon economy. And we as energy and environmental exchanges, and I'm speaking for all of us here on this panel, we can contribute to that. We build communities, we build markets, we determine fair prices, provide non-discriminatory access, provide price transparency, provide risk management tool. In other words, we apply all these proven mechanisms from financial markets to create trust amongst market participants for transacting efficiently in a safe and reliable regulated environment for carbon as well. Next slide, please. So this is an overview of all the environmental products listed and all the services offered by EX Group in this area. As you can see, it includes more than 20 different carbon contracts across North America, Europe, and since this year also New Zealand. We listed all the major contracts there, California Carbon, Reggie, UAs, and so on. We are active in primary markets as well as secondary markets, in spot and the derivatives. I'll show you an example for that in a minute. But we also didn't stop here. We also went into other emission allowances like sulfur dioxide or NOx emissions under the EPA cross-state air pollution rule, for example. Actually, this part has actually been expanded this week by a new contract. We listed various renewable energy certificates, guarantees of origin, renewable fuel credits like LCFS and WIN. And we did so in order to accommodate other environmental programs which are supplemental to carbon markets and further help to decarbonize our world. In the end, it's a big puzzle of different components which contribute to the same target. As you can see, we have a very granular set of contracts, and we're very proud to offer such a very granular set of contracts because it helps our clients to achieve their sustainability targets and ultimately also our sustainability targets. And all these contracts have been launched based on customer demand. The large majority of them has traded, some sporadically, some on a regular basis. This is always a process. And clients come from different industries. They are utilities, banks, industry players, carbon funds, intermediaries, different kind of clients being active. And of course, we will not stop here. We will continuously enhance our portfolio and develop the carbon market and the wider environmental market in the US and also worldwide. Next slide, please. So here we are digging a little bit more into carbon. I just wanted to show you the main parameters of the contract spec of a typical carbon futures contract. Usually this comprises 1,000 allowances, each representing 1 ton of CO2 equivalent greenhouse gases, depending on the program it covers. It's listed in dollars or euros. It's usually monthly contracts. Mainly has a main expiry in December, and they are physically settled via registries. We at EX Group engaged 2005 for the first time in this market, started in Europe with EX, expanded to the US markets with Nodal in 2018. Since 2017, we are successfully cooperating with Incubex, which is a business development and marketing organization founded by the ex-Climate Exchange guys. And worth mentioning is also that we operate large-scale primary market auctions for the EU commissions and the governments of all the European member states, almost on a daily basis. And in these primary market auctions, we have sold more than 4 billion EUAs so far on behalf of the member states in the common auction platform and the states which opted out of the common auction platform. In more than 2,000 auctions so far, which resulted in more than 60 billion euros of proceeds, which went into climate and energy-related purposes. We also listed the global offset contracts under the Kyoto Protocol, like CR and ERU contracts. They're project-based, however, they're not eligible anymore in trading phase 4 in Europe, so you cannot count them anymore to reduce your emission reduction target. EX will also enter the UK emissions market in the next few weeks. We will organize the sale of allowances in the new German fuel ETS, which is a separate emission trading scheme that covers additional sectors that are currently not covered by the EU ETS, transportation and heating. And we cooperate with NZX in the New Zealand primary market auction. One important aspect as to why we are engaged on so many levels is that we always aim to create an ecosystem of services for our clients, combining the primary market auctions, where allowances are first distributed to the market, to daily asset optimization, spot markets, to hedging, to trading of futures and options, all cleared and settled by our clearinghouse. On the next slide, we'll have a look at the development of carbon market activities. So next slide, please. So what you see here is an overview of the market development in the past 5 years. It shows the total market volumes, January 2016 to March 2021 by calendar month. North America on the upper part of the slide, and Europe on the lower part. Futures in blue, options in green. As said, these are industry volumes, not just EX Group. We are not the market leader in this space, but still our EUA carbon futures in Europe traded at an ADV of 2.2 million tons or 2,200 lots in 2020, and our OI stands at about 250,000 lots by the end of May, which represents about $15 billion. I just wanted to show you the development of the whole industry in order to illustrate the overarching trends on a full scale. So clearly, we see interest in carbon markets has accelerated over the past 5 years. We saw roughly 2 million contracts traded in the US. That's about a third up from the previous year. And open interest doubled in the past 2 years, and is now at about 1.1 million contracts. In Europe, which is much larger by cap, we also saw increasing trading volumes to about 11.7 million contracts and an open interest of 1.7 million lots. Maybe noteworthy here is the price development of 1 ton of carbon dioxide in Europe. We saw that previously in the presentation by Hans Bergman, which rose more than sixfold over the past 5 years to more than $60 per ton today. If you look into the graph, there's a spike in volumes in March 2020. This is related to the price drop of the first COVID lockdown. Please move on to the next slide, which will also be my last slide in the presentation. So while I already gave you an impression about the development of carbon markets in the recent past, let's also look into some trends for the future. I believe carbon markets are still in the development stage, and they will become a major economic factor even more than today. Just in the recent months, we have observed states reinforcing and even improving their commitments. We saw the UK launching their own ETS, connected also with a higher ambition to tighten carbon emissions, where they will sign into law a 78% reduction until 2035. And also Germany plans to achieve more ambitious carbon targets. So they want to go to net zero by 2045, so 5 years earlier than initially planned and committed in the Paris Agreement. We'll also see new ETS. Regional coverage will increase over time. We hear that Virginia is now part of Reggie, and others are in the process to join the Reggie scheme, as we heard from Ben Grumbles this morning, which is very encouraging in my point of view. We also see new countries setting up ETS. Remember the map I showed you in the second slide. Then the potential linkage of carbon trading schemes is discussed and is certainly an option in the future. You'll see new sectors to be included: maritime sector, aviation sector, transportation. All this is relevant to increase the coverage of greenhouse gas emission schemes. A very important work can also be attributed to the voluntary carbon market, a segment which is complementary to the compliance market. It's not based on governmental policies, but on a consensus among corporate entities to reduce carbon emissions in order to combat climate change. So all of these trends, and certainly there are many more, I would expect to shape the environmental markets of tomorrow, globally as well as domestically. And I think ultimately it's every effort that counts. So we at EX Group are committed to support that development with even more products and services. And with that, I'd like to conclude my presentation. Thank you very much for your time.
Thank you, Christian. Derek?
Great, thank you. I'd like to thank Commissioner Berkowitz for convening this EEMAC committee, and certainly the breadth of participation across market participants and the industry in this important conversation is critical at a point in time when this has become more than just a political conversation. This is an economic reality for all of us. So really appreciate the opportunity to be part of this conversation. Acting Chairman Benham, Commissioner Berkowitz, Commissioner Quintez, Commissioner Stump, thank you for having us and giving us the opportunity to talk about what CME Group is doing in the space. My name is Derek Salmon. I'm Senior Managing Director at CME Group. I oversee our global commodity portfolio, which is the combination of our energy business, our agricultural products business, and our metals business, and I also oversee our cross-asset class options business. I'm very pleased to be here this morning to talk through and update the committee and market participants here on CME Group's voluntary emissions offset initiative. We've heard a lot about the difference between cap and trade. We just heard some conversation about the voluntary program. Want to share a little bit about what we're doing in this space and some markets we've just launched earlier this year. Starting to put this, if you can just go back to the previous slide for me, please. I think you're on the very last. There we go. Thank you. To put this in a broader context, environmental, social, and governance issues are increasingly important to our clients at CME Group, as they are to our investors and our employees. As a global corporate citizen, CME Group has responsibilities to all of these stakeholders, especially in challenging the unpredictable times that we just experienced in this past year. We aspire to transform the industry while always adhering to our values. Ultimately, it's about earning and strengthening our stakeholders' trust and positively making a difference. We're focused on partnering with our customers to develop and introduce risk management products that address the growing and changing environmental interest and needs of clients across financial and commodity markets, and to help advance a more sustainable economy. We are constantly in conversation with our clients regarding products and services to meet their evolving risk management needs. And as a global business operating in a complex environment, we understand the importance of developing both innovative and sustainable business solutions. Specific to the energy space, our contracts are designed to help global customers manage price risk in today's energy and agricultural ecosystem as these industries develop new technologies and other initiatives to meet market movement towards alternative sources of cleaner energy and sustainable agriculture. Next slide, please. Turning now to emissions, exchange-cleared emissions contracts have primarily focused on the mandatory or regulated markets. We've heard a lot about that so far today in the earlier presentations. These markets make a lot of sense for the cleared space since they have clearly defined rules on how transactions are structured, who's subject to emissions cap, and specifics about what allowances can be used when. However, the disparity in the various frameworks results in a lack of transferability or fungibility between different schemes. There's no way I can swap my California carbon allowance, for example, against the European Union allowance. So this has inhibited exchanges and market structure from structuring a more global carbon market and contracts off of these underlying fragmented markets. Historically, voluntary offset markets had the opposite problem. Emissions reduction projects that generate offset credits can be located in any country in the world. While reputable offset registries have been verified issuing credits for decades, there was no overall framework to tie in the various regions, registries, and project types together to create a standardized price and set of common attributes, which are necessary to list an exchange-cleared futures contract. Offsets are sourced today in the OTC market on a project-by-project basis. The decentralized and opaque nature of these markets has caused frustration and confusion from both buyers and sellers. Next slide, please. Meanwhile, demand for emissions offset credits has soared. The number of entities who have pledged to meet carbon neutral goals by 2050 through the UN Race to Zero campaign doubled in 2020. There are now more than 120 countries, 2,000 businesses, and 700 cities that have made this pledge, which account for over 50% of global GDP. As institutions and governments make these net zero commitments, they need time to determine how to shift to low or zero carbon business practices. Known solutions may not be economically viable or scalable from a technology perspective in the near term. Offsets play a key role in making meaningful action while longer-term solutions are developed. CME Group participates in the Task Force on Scaling Voluntary Carbon Markets, which has outlined that the offset market could increase 15-fold by 2030, based with overall carbon credits worth up to $50 billion by 2030. In order to scale in an efficient and transparent manner, the task force has called for standardized exchange-traded instruments. Next slide, please. The International Civil Aviation Organization, ICAO, the UN specialized agency, adopted the Carbon Offset and Reduction Scheme for International Aviation, known as CORSIA, as a market-based mechanism to meet the ambitious goals of carbon-neutral growth from an international aviation beyond 2020. This is important as emissions from international aviation is higher than all but 5 countries in the world. The ICAO relies on guidance from an internal group of experts called the Technical Advisory Board, which is composed of experts from 19 different countries. While the framework was adopted in 2016, the ICAO only started to approve registries in March of 2020. The agency has approved 8 voluntary carbon offset registries and subsets of protocols within these registries, which airlines can use to comply with CORSIA. CORSIA's rigorous screening process, international recognition, and adoption by the private sector, even beyond just airlines, makes it one of the best frameworks for voluntary emissions markets today. Next slide, please. Based on the widespread demand for offsets and the approval of registries and protocols under CORSIA, CME Group has worked with the expansive market CDL to launch the Global Emissions Offset Futures Contract that we call a GEO contract. The contract allows buyers and sellers to make or take delivery of offset credits that meet the CORSIA standards from 3 of the approved registries. Since launching in March of this year, there have been more than 200,000 offsets traded through this mechanism by a broad array of customers in both Europe and the United States. The contract has already enabled better price transparency out across the curve for voluntary emissions credits. Equally as important, it has jump-started conversations around the world about how to develop better environmental hedging instruments. While the voluntary emission market is relatively new in the cleared commodity space, there's nothing especially unique about the GEO futures contract. The GEO contract carries the same regulatory oversight, options for trade execution, counterparty risk protections, and delivery mechanisms as any other physically delivered exchange-cleared contract. There's also no obligation to make or take delivery offsets through the GEO futures contract. Like any other commodity markets, many firms can either roll their position, exit, close out that position, or undertake an EFP, or an exchange for physical, prior to expiration. There are a variety of reasons why firms plan to use the GEO futures contract to make or take delivery. As mentioned earlier, there's a substantial demand for entities to meet emissions reduction goals. A standardized contract that delivers defensible offset credits and is in high demand, especially for firms navigating the space for the first time. Some firms may even take a hybrid approach of acquiring and retiring a mix of standardized offsets, like GEO, and project-specific offsets. Many firms have come to the CME Group for other reasons to take delivery, often exchange-cleared emissions contract, structured carbon-neutral transactions. Next slide, please. Just as CORSIA has a phased approach where airlines use offsets in the near term as they transition to low-carbon aviation fuels and more efficient technologies, producers and marketers are also looking at carbon-neutral commodities as a bridge to more sustainable, differentiating commodities. Whether it's in oil, corn, natural gas, aluminum, or steel, firms can act today by pairing offset contracts with traditional commodities. This involves calculating the emissions associated with the production and transport of the traditional commodity, purchasing the corresponding offset credit, and then selling it as a structured carbon-neutral deal. There are many examples of these transactions in the cargo space, whether it's carbon-neutral LNG, carbon-neutral crude, condensate, or naphtha. GEO futures make it easier to acquire the offset component in the short term and facilitate more effective long-dated hedging of bundled transactions. Next slide, please. Similar to other commodities markets, we expect differential or basis markets to emerge over time, which are anchored to a few benchmark offsets contracts. Offset basis markets can be focused on specific regions, product types, or community benefits. This will also allow firms to concentrate liquidity in the prevailing benchmarks while securing a more precise hedge either in the spot market or by using exchange-cleared differential contracts. This is common practice now in our crude oil markets today, for example, where WTI futures trade over 1 million contracts a day, and grades such as Western Canadian Select, Mars, West Texas Sour, and the Louisiana Light Sweet all trade as differentials to the WTI benchmark. From an exchange perspective, there's no silver bullet for the voluntary emissions market. GEO futures utilize the best available international framework with CORSIA, but it's only the first step in providing more efficient and transparent markets in this space. We will continue to work with the leading industry associations, governments, customers, and environmental organizations to determine which pricing instruments are most useful for the market to adopt for the long term. The pace at which industry and government is moving to address climate concerns is unprecedented. This market will look far different in a few years' time than it does today. As a global marketplace, CME Group will facilitate conversations, aggregate and synthesize feedback, and advise on lessons learned through the development of thousands of commodities contracts over the past 160 years. Once industry consensus surfaces and liquidity strengthens, CME Group will provide a venue where firms can execute voluntary emissions contracts in a transparent and efficient way. Ultimately, this will provide more certainty and better risk management practices as customers move forward in this global energy transition. With that, again, I'd like to thank Commissioner Berkovich for convening this important conversation, bringing this group together. And with that, I will turn the meeting back to the Commission.
Thank you very much, Derek. At this time, I'd like to open the floor to questions and comments from the associate members on the presentation. Do we have anyone, Abigail, who has indicated a wish to comment?
No one has indicated that they wish to comment, but if anyone's on the line that would like to ask a question, please go ahead.
This is John Parsons. I thought I put into the chat a request to ask questions.
Go ahead, please. Go ahead.
Sure. So I think my question is most likely for Mr. Salmon about the offsets. Certainly, there have been a lot of challenges, as we discussed in the first panel, to the quality of offsets, whether or not you're truly getting to carbon neutral when you when you talk about carbon neutral LNG, it's not clear that these offsets are really producing actual reductions in emissions. But my question has to do more with the exchange and the quality of the futures. We have experience, and I guess the label I would put on this is self-dealing. There's an organization deciding what counts as an offset, allowing various registries, allowing various emissions to be, or types of projects to be included. We have experience with this before with the credit default swap market, where there's a private organization deciding about credit events and perhaps making decisions about credit events that serve their interests and are not the right decisions, so to speak, not a fair or unbiased choice about credit events. And I'm wondering, how do you assure the quality of an offset market when the people who are establishing this market are the companies who need the offsets, and in the event of various things happening, may choose to change what qualifies as an offset? How do we avoid self-dealing?
Yeah, it's a great question, and I think there's a pretty significant difference between the example you gave in terms of credit default swaps versus how this framework has come together. I think one of the most important things to note is that the overall framework is overlaid and actually fits inside both UN regulation, and the whole UN framework has set the infrastructure for how these registries get set, how they get oversighted. And so the registries themselves, and we actually, for our contract, we've got 3 individual registries of the 8 accepted by CORSIA. These are within and approved and mandated and regulated by the United Nations themselves. We've accepted 3 of those registries right now. Now, as that market evolves, we'll be looking at potentially adding additional registries over time. The 3 registries that we accept right now are the Verified Carbon Standards, the VCS registry, the Climate Action Reserve, CAR, and we've got a 3rd one, American Carbon Registry. So I think that the difference is, and I think you make an excellent point, you've got to be careful who's doing the oversighting and as who's actually participated in the market. So in this particular case, the framework is a UN framework, fits inside that oversight mechanism. Those registries are mandated there. We then look at those from our prudential regulatory point of view and determine which of those registries we feel comfortable that are most consistent with the kinds of needs that the products that we're developing suit our customer needs. So we're not in a situation where the self-dealing argument that I think you raised very rightly so is not a concern in this particular case. So we've separated, by definition, those who are managing and oversight in the registries themselves versus those that are doing the trading. So hopefully that provides some detail. I've got lots of detail we can provide on the individual registries themselves if you want to follow up on that, but I'm certainly happy to take any further questions on that.
Are there any further questions from associate members of EMAC? Hearing none, let's move to the members of EMAC. Anyone who is a member of EMAC have a question for the panel? Abigail, do you have any indication that we have any questions from the EMAC members?
And we don't have any members, but if we could just go back, I see now one from Sarah Smalty, who's an associate member.
Okay. Sarah, please go ahead.
Sure. Thank you very much for these presentations. These markets are extremely important for us to be able to manage our risks. So we really appreciate the fact that they're growing and interest is growing in them. But given the global nature of the primary markets that underlie the futures products, how do we ensure that the quality of the credits that make up those markets? How do we ensure the quality of the credits that make up those markets, and that those credits are not later invalidated?
So maybe I'll pick up the first piece. It's very similar to the comments provided by Dr. Parsons. When we look at that, the International Civil Aviation Organization, the ICAO, which is that UN specialized agency, they've adopted the carbon offset. They've adopted the CORSIA framework overall. And there's a market-based mechanism to meet that ambitious goal of carbon neutral growth. So when you look at the ICAO, that's got the approval of those underlying markets and actually oversight those markets. So I think I'm probably going to replicate what I just said a moment or two ago. All of the products, all the offsets have to be applied into the registries. Those registries themselves look and validate those, and those then go out to be potentially traded on different markets. We look at those under the UN framework and to determine which of those registries we accept those into. And we've accepted these first three because we feel those are the most robust of the 8 that have already been approved under the UN framework. And we'll look to continue to adapt and potentially add more registries over time. But I think that it's the robustness of the registry oversight itself that's important. We feel confident that working and accepting the 3 that we have is the right direction. We'll be looking to add to that as this market evolves. But we rely on the registries themselves and then their oversight of those registries to be confident in the offsets that are granted and the stability of that offset regime over time.
Any other questions from associate members?
Not seeing any from any associate members.
Okay, I see we have one from Rob Kramer as a EEMAC member. Rob, please go ahead.
Rob, you're on mute.
Rob, we're not hearing you.
I'm sorry. Can you hear me now?
Yes, we can. Please.
Okay. Sorry about that. I was on mute on my phone as a duplicate precaution. So sorry about that. I forgot I had to hit it. I was curious if the panelists might speak to their own views regarding the liquidity present in these markets. And really thinking about kind of how the market is evolving. Certainly it's interesting to me, and I'm wondering if there are any constraints in the underlying market that are holding back liquidity from entering, maybe more participation, but just wondering kind of everyone's views on that. Thank you.
Does anyone on the panel wish to jump in to answer that question?
I didn't get the first, I don't know about anyone else, but I didn't get the first part of it. Apologies.
I was asking about the liquidity, how you evaluate liquidity within your markets, and whether you're pleased with the current state of liquidity, whether it's at a healthy level, just kind of how you think about it and any constraints that may be limiting the desired level of liquidity that you'd like to achieve.
So that covers any of our markets, so carbon allowances and so forth. So
I'm thinking more about the exchange listed derivatives, allowances.
Yeah, sure. Yeah, of course. So liquidity means different things to different people. How do we look at it? We look at it in terms of a combination of bid-offer spread and depth of market. Clearly, each of these cap and trade programs are on different stages of their evolution, and the EUA is the largest and the most advanced, and has the most liquidity. It has the tightest bid-offer spread, and it has the deepest markets. We probably trade 40 to 50 million tons a day in EUAs in a tight bid-offer spread. And the reason why EUAs has the tightest market and the deepest is because it's got the most diverse liquidity pool. So it's EUA as the first contract is really developed into a benchmark in its own right. So it attracts a lot more diverse participation and therefore a diverse view of valuation, and that tends to encourage more liquidity.
And Rob, I'll jump in from our side. We just launched our GEO futures contract in March, and it's based on the underlying spot market that's traded on expansive CBL platform. That's a market that just started about 15 months ago. Now, what's interesting is we all know the beneficial relationship that exists between spot markets or underlying physical markets and derivatives markets. And in this particular case, we've seen an extremely beneficial impact in that we saw a real big jump in the underlying spot turnover in expansive CBL market, in the underlying offsets market, literally the same week that we launched our futures contract. And why is that? Well, it's bringing all the benefits of a regulated, standardized, well-organized, centralized market to connect to the underlying spot market. There's very much going to be a beneficial two-way impact there. So we think that the futures market has already brought more folks into the market looking more closely. I will tell this group that next to probably Bitcoin, our single most client-engaged sales campaign we've had has been on the GEO contract. We have had interest across the entire financial player spectrum, from asset managers, hedge funds, pension funds, liability managers, banks, market makers, folks that aren't necessarily directly involved in this market, yet a lot of producers that are not even energy producers looking at ways they can use and adopt these GEO contracts to offset their risk. So we think over time, we're at early stages of development of this market. Liquidity, I think we'd probably define it as you would. What's the entry-exit cost? How deep is that market? What's the top of the book look like? How easily can you move size? How effectively are price fluctuations managed? Those are all things that we look very closely at across all of our markets. I think we're at the early stage in the development of this rapidly evolving space. I think the important part is bringing in a fully regulated market infrastructure and ecosystem to expand participation, bring in some more natural sellers, and bring in some more natural buyers as well. And I think that's where we're going to see the beneficial impact of building futures markets on the back of an evolving spot market, but that actually bringing benefits to both of those. So it's early days in our contract for sure, and it's a different approach from the cap and trade programs that you've heard from the other panelists here. And I think there's a lot of interest that I think is going to still evolve, and that's what brings people into the market. So we're excited about the feedback we've gotten so far. This market's got a long ways to go, but there's no shortage of interest for what this can mean to folks that are directly in the industry and those that are looking to use an offset like this to manage the global footprint, carbon footprint they have, whether they're an aluminum producer or a farmer. We're having all of those conversations with commercial customers right now. So the extensibility of a product like this is what's most exciting to our customers.
Yeah, and this is Christian. Let me just add to what Gordon and Derek shared with us, and I surely second that. So also on EEX, in particular for the EUA contract, which is the most liquid contract in the carbon space for us as well, we see more participants pouring in, liquidity in terms of depth of book and bid-ask spread improving. But it's also the way the market trades. It's not only outright trades. We see increasingly more time spreads traded, carry trades between spot markets and futures markets, rolling of contracts, and structured trades coming in. So this is for me also a sign for a maturing market going its way towards a really liquid contract. Thank you.
Thank you. Are there any other questions from our EMAC members?
We do not have any other questions from the members, but we do have a question from Commissioner Barkovitz.
Okay, Commissioner, please go ahead.
Thank you, Dina and Abigail. Thanks, panelists. I just want to follow up on the discussion that was just occurring in response to Ralph Kramer's question on liquidity. And two questions, actually. One is, and Derek, you talked about this in your mentioned your interaction with the stock market. The first question is, for derivative contracts, for all these derivative contracts, you need a well-functioning spot market with price integrity in those underlying spot markets. So I'd ask each of the panelists your work or your interactions, collaboration, or how to describe it, with the markets themselves and the primary and secondary markets, the authorities that allocate the allocations or the assets to ensure price integrity of the underlying product derivatives settled to. And then the second question relates to the liquidity issue. Is there, and maybe Derek, you were alluding to this, but if you could expand, to what extent are these markets being used just by the participants, buyers and sellers, entities that need allowances or desire offsets, or are there liquidity providers such as banks, dealers, traditional folks entities that would participate as market makers and other commodity markets like oil and energy and agricultural products, for example, the banks, the dealers, crop traders? Is the liquidity at a sufficient level that they would be coming in? Would ultimately this be an asset class like so I guess those two questions. One is underlying spot market, and then the second question is what type of liquidity? Are we just having hedgers, or are we actually having speculators and market makers? So thank you.
Hi there. So, yeah, it depends on which contract we're talking about, but as per my previous answer, the EUA market looks like any other benchmark contract, whether it's our TTF, European natural gas contract, or some other key commodity benchmarks, whether Brent or so forth. It has a very diverse group of participants. The interesting the uniqueness of a cap and trade program is that it is a market that is set through policy, and you have naturals who have to participate in the program. So there's a great source of natural liquidity because people have to buy allowances if they're short. But there's a whole host of participants in the EUA contract, whether it's banks or non-bank financials. So I would say it's as diverse as any benchmark contract that we have. And what we saw in sort of post 2018 in anticipation of the introduction of the MSR, the Market Stability Reserve, we saw this gradual increase in pricing in the EUA, and the performance of EUAs was in the financial press, but even the mainstream press, and so carbon as an asset class really started to take its head above the parapet and became a bit more mainstream, and that's had a trickle-down approach whereby, where people are saying, okay, this EUA contract is performing strongly, what is it, and what else is there out there? So then you get this trickle-down effect into things like CCA and Reggie off the back of it. They're not as diverse as an EUA, but certainly CCA, I'd say, is catching up. And Reggie's probably the least diverse of those three contracts. And we're seeing it in the UK allowances as well. We're only 2 weeks in, and so it's at the beginning it seems very much natural focus. So people that have to buy allowances or who have extra to sell. But I'm sure that will evolve like our other carbon contracts. And in terms of spot versus futures, it's sort of the same thing in terms of carbon. So the thing about carbon markets, the allowance markets, is you're complying once a year. So the contract basically is named after the current compliance year. So let's call it 2021. In Europe, it tends to trade at December 2021, but that is being delivered for the compliance period 2021, and is being delivered in April 2022. So you don't need to buy a spot contract necessarily here and now because you're only complying in the future. But some people do buy the spot. It's called a daily future, and you pay for full contract value and you get delivery of your allowance, whereas the future is margined as you would expect a normal futures contract. And I think, as Christian said, that you do see a carry trade in most carbon markets where people are buying the spot and selling the future and generating a yield. So that's where you tend to see a lot of spot activity. And then finally, in terms of primary markets, both EEX and ourselves operate auctions for governments, and that's another great price discoveries tool. But that's also the spot market, because the government is selling their allowances and they're being paid for today, and they're being delivered today. Thank you.
And maybe I'll jump in on some of the other pieces. So, Commissioner Berkovich, you were asking about the spot market. So, in the case of the voluntary offset market and the GEO contract, think about that market that is run by CBL as a spot market. That's just a transactional venue. So the way to think about this is the carbon credit registries are actually the verification agents themselves for the physical credits. They get approved by the UN agency that sets the standards. So as you talked about, the standards are approved by the registries that are in turn approved and managed by the United Nations entity that oversees that. So think about the underlying transactional volume that's flowing through CBL on the spot side, and then our future product is based on that. So we know that as you track back the validity of the registration and the underlying credits themselves, that rolls up to that UN framework. So that's kind of how that market operates. We've seen that. They've been operating for 15 or 18 months right now, and I said their growth has been substantial. You asked a really good question in terms of the market participants. There was a slide in my materials, and Abigail, if you wouldn't mind throwing it up, and the title of the slide is, "What is a carbon neutral cargo?" And when you look on there, these are all public announcements, so we're not providing anything that has not been announced by these underlying entities themselves. But there's a table there under the title, "What is a carbon neutral cargo?" that lists the eventual buyer and the eventual seller of that underlying contract. And you'll see for 90+% of those right now, those are the underlying commercial entities themselves. There's Shell, there's Mitsui, Total, Chinese entities in there, Toho Gas, et cetera. So right now, but remember, this is a futures contract. So the initial buyer and the initial seller, when it goes to physical delivery, you don't know how many transactions and maybe a financial players that took place in between there as well. Our goal is to have started with the most robust UN-enabled framework at the outset, the one that the industry is coalescing around, making sure those products most effectively represent the underlying risks and actually the opportunities to monetize some of these offsets that are out there, and under the UN framework that makes that the right global framework for being able to have fungibility, transferability between regions across jurisdictions, state, national, local, and otherwise. The participant pool over time, we fully expect, as we've been doing for 160 years, expand that ecosystem of participants. That's where the best possible outcome for everybody is, where you have commercial end user, open interest holders alongside financial participants and players. And that's where we've actually seen the most interest from asset managers and hedge funds saying, hey, we've long thought about this. We haven't really found a way in. We're not part of cap and trade program because we're not the underlying entities themselves. But how do we participate in this market in a way that's well regulated and has all the safeguards of the CFTC jurisdiction? So those are the feedback pieces we're getting from customers on the client side saying, how do we become a part of this? So that table, and if it doesn't come up on screen, that's fine. It's in my materials under the heading, what is a carbon neutral cargo? There's an opportunity to see what today's participant pool looks like. In our experience, that's going to look very different in 3 to 5 years' time. You're going to see more intervening financial players participate along that chain, you might end up with still largely the original seller and the final buyer might end up being financial or commercial participants, but that's a function of how well we can scale the community and participant pool.
I think we have questions from the chairman and from Commissioner Stump.
Correct.
Chairman, would you?
Commissioner Stump can go first, please. After
Okay.
her.
All right. All right, Commissioner.
Thank you. My question is for Derek. I know the focus of today's meeting is energy, but I have heard from various agricultural interests who themselves are designing voluntary solutions in the primary space, and some of them actually may be offset issuers based upon the manners in which they're able to capture and contribute to carbon reduction. I'd just be curious, when we talk about UN recognized standard setting bodies such as CORSIA, has there been interest or discussion with agricultural end users as to what types of things should be recognized in that space? And perhaps not, given that agriculture hasn't been the focus of the mandatory programs. But I'm just curious more than anything as to if we know if those conversations are ongoing with agricultural end users or anyone who's interested in the agricultural markets from that perspective.
Yeah, no, Commissioner Stump, that's a great point, and I kind of alluded to this in my prepared remarks. Given the fact that we run the world's largest agricultural market and actually in the metals market as well, we have a lot of natural interest in the commercial participants in both of those markets. I'll give you two examples. All of the ABCBs, right, the biggest agri-food business entities on the planet, have been deeply engaged with us on this because they're pretty far down their own path, whereas carbon sequestration efforts or other ways in which they either are emitters or in some cases are the natural the owners of these offsets themselves. We said, what can we do with these things? Or we have, in some cases, the ABCDs themselves have access to or made purchases in the space that create those offsets and want to know how they can go about using those not only for their own business, but maybe to be a participant and provide an offset against, say, an energy producer. So the short answer is yes, and there are a handful within that group of 4 or 5 in that group. There's 2 or 3 that are most aggressively pursuing this because they'd like to be involved earlier, sooner rather than later in this market as it evolves. There's another set of participants from the mining side, mostly from the base metal side, less on the precious metal side, because you know how energy-intensive mining is for things like copper and aluminum. And they've said, listen, this directly helps us down the path to our own carbon-neutral commitments because what we do is a very energy-intensive business. How can we find a way to use these products to offset? In the same way that we use the example in the materials for a carbon-neutral cargo, there's carbon-neutral aluminum, there's carbon-neutral corn. There can be carbon-neutral copper, and those are the conversations we're having. Since we run the benchmark markets in those asset classes, that's why this has been such a deep and deeply engaged sales campaign over these last 3 months, because customers can see a potential immediate need in their own business to meet their own commitments in carbon neutrality, and they see being able to do that on the same exchange where they're doing their primary hedging for their natural underlying exposure. So the opportunities, and we all talk about ecosystems and the most efficient way to bring networks of market participants together, that's the conversation that we're having right now. So I gave you the long answer. The short answer is yes, both from the agricultural side and from the industrial metal side of our own customer base, saying how can we use these products, and they're both pursuing and getting engaged in the markets right now, but also would like to see these markets continue to evolve with more liquidity, more term open interest out along the curve, and that's just the market maturation process, and that's what we do. We build markets and bring communities together. So we think we'll see more of that over time.
But are there international bodies that are recognizing or focusing on recognizing or validating perhaps the types of things that would qualify as offsets in those spaces? And Derek, this may not be a fair question for you. That's not your job, but I'm assuming that you're looking to those folks as you would in the energy space to help develop the market.
Yeah, and again, the answer comes back to the registry. So what happens is if somebody has something they think is an offset, they actually go through an application process to one of the registries themselves. The registries themselves look at that, they review the application, they determine yay or nay. Those registries, those 8 that I referred to under CORSIA that fall under UN mandate, so that is that kind of uber supranational entity that provides the overall frameworks for the oversight of the registries. Individuals like I'll pick up, can't think of an individual name. A large agricultural company would say, hey, I think I've got this part of my business that I think qualifies as an offset. They would go to one of the registries and apply for that, and they would run through that process. And that's a very thorough vetting process up within the registry itself, oversighted by the UN. So I think the answer that you're looking for is yes, those are globally accepted standards. Now that it was birthed originally out of the aviation industry, but those standards are looking applicable to across all industries. An offset is determined to be an offset by the entity that the UN approves it to be. So that's the process I think that we're pursuing right now.
Thank you.
Apologies.
No problem. Thank you very much.
Chairman Bowman?
Thanks, Dina. I won't. This has been a good Q&A session, so in the interest of time, because I know we're way over, I'll just make a short thought because my questions have largely been asked and answered. But I think the points about the underlying market are really interesting and difficult. And you know, as was mentioned, the fact that you have non-end user, non-speculators trying to get exposure through the futures, it's not unlike what we're seeing in the Bitcoin and the crypto space because of that trust, because of that regulated space. And I think given the scope and the scale and the ambition with the carbon markets and the offset markets and what everyone's trying to achieve in terms of climate change, it's going to be important to really make sure that these registries are valid and credible. And I know certainly CME does its homework to ensure that the futures are based off of credible underlying cash markets. But, you know, these cash markets are essentially OTC derivatives markets, and I think it's going to be interesting as time goes on that we as the CFTC and other government regulators, as this public-private partnership evolves, play a good role, because we've learned a lot of lessons in the crypto space. We've learned lessons in the RIN space. Given the ambition and the scale, we have to make sure we get this right, because the outcome and the deliverables are really what we're trying to achieve. So I'll end there. Great panel, and back to you, Dina.
Thank you very much. And I am now going to turn this over to Abigail. Abigail?
Thank you, Dina. At this time, the EMAC is going to take a brief break. EMAC members, associate members, guest panelists, and the commissioners, please keep your phone on mute. Make sure your WebEx is on mute and turn off your video during the break to expedite return at 12:35 to begin the next panel. Thank you.
Thank you, Abigail. Our third panel today is going to provide a survey of perspectives on carbon derivatives and the underlying markets. We're going to hear from Evan Ard, who's an Executive Managing Director at Evolution Markets, Inc., Susie Kura, the Chief Economist of the Environmental Defense Fund, Eric Heinley, the Assistant People's Counsel at the Office of the People's Counsel for the District of Columbia, and I will also participate on this panel as the CEO of the Natural Gas Supply Association, along with Annette Nazareth, the Senior Counsel at Davis Polk, who's representing today on behalf of the Task Force for Scaling Voluntary Carbon Markets. And then finally, Matthew Picardi, the Vice President of Regulatory Affairs with Shell Energy North America, who is speaking on behalf of the Commercial Energy Working Group. So with that, I'll turn it over to Evan.
Great. Thanks, Dina. And also thanks to Commissioner Berkowitz for inviting me to speak, Acting Chairman Benham, Commissioner Quintez, Commissioner Stump, as well as the EMAC members and associate members for convening this discussion. It's been a great discussion so far. I will try to not go over some of the same ground that was covered by the panels before me, particularly the last panel with the great discussion from the different exchanges. Just quickly, Evolution Markets is an introducing broker in global energy and environmental markets. We've been involved in carbon markets since our founding in 2000 and through the different iterations of the markets. And you've heard a lot of the history from the previous speakers. We are facilitating transactions on behalf of our clients in futures, but as well as in the OTC market. For the presentation today, I wanted to focus strictly just on the OTC market perspective, give the committee and the commission a few ideas in terms of how the carbon market has evolved, will continue to evolve, and some of the overlapping issues that you might want to think about going forward. So next slide, please. Thank you. So again, I think it's important to, when we talk about the OTC market, to give all the participants in the meeting today an idea of kind of where the market's going, and also present some ideas on what the commission might want to think about as it looks at future regulatory action or oversight, in particular in carbon markets. In a lot of ways, the OTC market and carbon has evolved like many of the other environmental or energy markets, and it is a precursor to, what goes on in some of the regulated environments, but there's a lot of differences as well, so I figured we could go over some of that. Obviously the carbon market in the OTC market has always been an incubator. The market has traded, the different regulated markets have traded OTC well in advance of them trading through the regulated exchanges. It's no different today than it was when we first traded the European Union allowances. I think we facilitated the first trade maybe 18 months before the program even started. It allowed counterparties to understand what the potential trading mechanism was going to be, how the delivery was going to be managed. Obviously, price discovery was part of that as well. And even just some of the taxonomy and the vernacular about how the market operates was, is kind of worked out in advance in the OTC market. We also facilitated some of the first transactions in California, as well as in Reggie. Again, those were well in advance of the markets starting, as well as in advance of them, trading on the regulated exchanges. And the market participants that you would see early on were compliance entities, but also a lot of, dealers, other financial entities that were providing risk management services. The OTC market has also been a tool for innovation and risk management. They have, participants have used the OTC market to tackle a lot of the difficult, risk challenges that carbon markets present. Options obviously started OTC, well in advance of them trading on the exchange, and you had a lot of dealers who were looking to help companies manage their compliance risk, and then the associated price risk and volumetric risk that are associated with those positions. In addition, the offset market presented some unique challenges, particularly as it relates to the structure of the underlying entity, the underlying product, what is being sold. In some cases, you wanted participants to guarantee the delivery, and you saw a lot of these structures that were created in the OTC market, eventually adopted for exchanges when they listed contracts. CCOs in particular were a market that the OTC market was particularly helpful in developing, in part because of the authority of California to invalidate credits, carbon offset credits that were generated and used by entities for compliance. So the OTC market created, different structures and different tiering of risk that was associated with the CCOs, and those markets traded for years OTC before there was an exchange-traded contract. Gives you a good idea of how the OTC market can create some innovation and ultimately gets adopted by the wider, regulated market environment. Next slide, please. So currently there is an active OTC derivative market for carbon. We heard from the previous speakers with the exchanges, obviously there's a robust, futures market as well as a robust options market. The market, both those markets started OTC. Most of the liquidity migrated over to the exchanges, but there's still a great pool of liquidity underlying these markets, particularly in the established compliance program. Largely they're dealer-to-customer transactions that are happening. The structure of those trades largely mirror the exchange-cleared market, but you'll see some very specific and bespoke transactions that take place for to address specific client needs. And obviously, the exchange-listed contracts provide a venue for hedging of the OTC positions that these dealers or some of the other market participants might take in the OTC market. There's also a very mature OTC market for spot and forward delivery. Because of the nature of carbon allowances and carbon offsets, delivery is easy. It's effectively electronic delivery. If you take physical delivery, it's just the movement either in a tracking system or in a registry, from one counterparty to the next. So you'll see a lot of, OTC forward transactions that take place, with the netting of positions, sometimes under ISDA agreements and other type of EFED agreements and other type of agreements between counterparties. There's also new carbon trading platforms, some of which have been alluded to already, including expansive CBL markets. There's also carbon trade exchange, as well as the air carbon exchange, different venues for effectively spot delivery, and they provide, a great pool of underlying liquidity for trading for, obviously for, immediate delivery, sometimes for forward transactions, and good venue for price transparency. And for the, like I said, there's an incubator for the development of products, before they migrate into an exchange environment. Next slide, please. So we've had a fair amount of discussion already this morning about the carbon offset market. This market is tailor-made for the OTC. There's just a lot of moving parts, in particular, and a lot of unique risks that are associated with not only the market but also with individual projects. And the ecosystem that's built up around it is diverse. And so, the OTC market is, has done a good job in terms of, bringing all these disparate parties together and all these disparate risks together to allow for transactions. Largely, we're seeing in the carbon offset market spot trades for physical delivery. There is a fair amount of forward purchases, of long-term strips of credits. And then, obviously, you have exchange-listed products, particularly in California, for offsets as well. The one thing I think is important to note is that despite the fact that there are common methodologies and that there are registries that are internationally recognized that, essentially write the rules for how you reduce carbon emissions, and then the rules for how those are verified, validated, and then potentially issued, and when they're issued, how they move between one counterparty and another. There's still a lack of standardization, particularly for anyone who's on the buy side of that transaction, who's buying carbon offsets to potentially offset their own carbon emissions, meet net zero or carbon neutral commitments. It's truly like the art market. The beauty is in the eye of the beholder. Transactions occur with wide price disparities because of carbon offsets one party may desire a certain geography or a product type, or may want products or projects that have additional ancillary benefits for the environment or for social good, and may pay more for those than another party would. At the same time, you can see a landfill gas project in Latin America potentially trading to a discount to a landfill gas project in Africa, for instance, just because the buyer sees more value or wants to tell the story of investing in a particular geographic area or in a particular project type. And because of that, a lot of the managing of the risk occurs through through contracting. There's optionality built into contracts which relate to volume as well as price. And, a lot of times you'll have unit contingent, transactions where, the buyer will buy up to a certain amount or all the credits coming from a project if and when those credits are created to kind of manage the risk associated with the performance of a particular carbon offset project. And because of that, you see a lot of counterparties managing their risk, in large part through diversity. So they're going to invest in carbon portfolios that are going to have, be in different methodologies, be across different geographies, be in different vintages, and vintage being the year in which the carbon emission was achieved. And then you'll also see further kind of out the chain, you'll see counterparties who are sharing the risk associated and also sharing the upside with the seller by co-marketing. Some might buy offsets at a future delivery at a set price, and then sharing any future upside of an on sale of those credits with the issuer or with the project owner, which is becoming more common these days. And you'll also see for new project development that there's a certain continuum in the way that these projects are developed that is indicative of some of the risks that are out there and where the market itself has stepped in to address these risks and where there's more work to be done. So the offtake agreement would be, the purchase of multiple year streams of offsets from a project that's going to reduce carbon emissions wherever it is in the world, in whichever registry it happens to register on. And that offtake agreement, similar to what happens in renewable energy markets, can then be turned around from the project developer to a bank or to some other financial entity to achieve project financing if necessary, to put the steel in the ground, the capital expenditures necessary to start the project. And then naturally off of that, whoever is involved from a financial point of view is going to want to engage in hedging. And this is where the market is still evolving. The managing risk through contracting takes you to a certain point, and then beyond that, there's obviously hedging instruments that are necessary out there. And right now, especially for carbon offsets, there's currently few viable products out there to do that, although they're being developed as we've talked about from the CME and from some other venues. Can we go to the next slide, please? So in terms of what this committee and the commission should think about for carbon markets going forward, I think it's important, and this has been alluded to, previously, to try to take a step back and look at the holistic impacts of climate change on energy and environmental markets, not just the carbon markets. And this is something that the Climate-Related Risk Subcommittee, of the Commission has already started to address. I mean, extreme weather events, can obviously lead to price volatility. They can raise some market structure issues. And I think more importantly, in the long term, is they are leading to shifts in liquidity. The shift to carbon neutrality in some cases, net zero commitments is leading to a shift in terms of where liquidity is based in a lot of energy and environmental markets. And that includes not only the underlying commodities, but also the venues and risk management products that come off the back of that. A good example is the shift in liquidity in power and natural gas markets in the States, because of the shift in generation mix away from coal to natural gas and with more renewables on the grid. There's more liquidity and more in the basis markets than there was previously, especially relative to the major hubs. And then we're also seeing an emergence of global LNG markets, which is, a direct response to the climate challenge as people use natural gas as a transition fuel to a true low carbon and net zero economy. And you're also seeing the emergence of renewable energy certificate markets, which are regulatory tools to enhance to make renewables more competitive as they continue to develop and get scale here in the United States, and you're also seeing it abroad. There's also emerging trading strategies that different counterparties are putting on relative to climate change that's going to kind of amplify these trends going forward. We have conversations with clients daily, be they banks, companies with natural positions, hedge funds that are looking at climate impacts on a global basis and how it impacts, and they're putting trades on that are relative to those impacts, both short-term and long-term. And I think it's important to note that carbon pricing is going to play an important role going forward, in all the global commodity, energy markets, certainly some of the other global commodity markets, as carbon gets priced in either from a regulatory perspective or just simply from end user consumers pricing in carbon as part of their the externalities of using the fossil fuels. Next slide, please. So for my last slide, I wanted to highlight a bit if we're kind of forward thinking from the Commission's point of view, and encouraging everyone to look at this. And this has been discussed a little bit previously, more of an intersectional approach in terms of how we look at energy and environmental markets. There is, a robust carbon market, as we've discussed. Obviously, energy markets are robust as well. But now we're seeing how there's an interplay between these, and there's new products that are being developed that are addressing a lot of the underlying environmental issues that we're talking about with climate change, whether it be on a voluntary basis, companies taking on net zero commitments and turning to their scope 1, 2, and 3 emissions in order to manage that and meet net zero or carbon neutral commitments, or if it's on a policy level as well. So from the carbon market, which we've already talked, there's compliance markets. There's new compliance markets being proposed on a global level, almost on a monthly basis at this point. You also have different U.S. states that are looking at taking approaches, and they may join in regional approaches in California or in Reggie, or they may take on their own carbon pricing regimes that are outside of those particular approaches. And increasingly, all these policymakers, as was discussed in that first panel, are looking at potential linkages as a way to create, efficiencies and to promote, carbon emission reduction targets, across different sectors or across different geographies. The global carbon offset market is growing, as we've all discussed. We anticipate that we're going to see significant amount of growth over the next 5 years in that market. And policymakers are starting to look to the carbon offset market again as a way not only to reach carbon goals, but do it on a cost-efficient basis. And you're seeing now a discussion within the EU about potentially, again, bringing carbon offsets back into the program, potentially in future years when the carbon offset targets in the EU get more strict. California already has a robust program with carbon offset usage limits, and that will continue going forward. And then lastly, on the international level, there's discussion of, potentially global carbon markets coalescing around the Paris agreements and different mechanisms under the Paris agreements to provide for increased ambition as well as meeting, globally, nationally determined climate goals. So particularly, you'll hear people refer to Article 6 of the Paris Agreement, which allows for this international carbon market to formulate. And also there is a fledgling market that's starting from a carbon offset, from a sustainable development point of view. You're also seeing, as people have talked about, bundling of carbon offsets with fuels. And lastly, there's this separate market that's coming together that's differentiating fuels that are produced with less carbon intensity than others. And again, this is all going to have an impact on the underlying energy commodity as well as the environmental market itself. So with that, I appreciate the time, and that's it for my presentation. Thanks, Dina.
Thank you, Evan. Susie, we'll turn this over to you.
Thank you very much. So the interaction between cap and trade markets and financial markets is a critical one to enable the efficient flow of capital to low emissions investments in response to policy. And as they grow in size and value, cap and trade markets can also create some risks. I'm really grateful for the opportunity to discuss these issues today with such a knowledgeable group. For those of you who are less familiar with us, Environmental Defence Fund is very proud of basing all of its advocacy on strong economics and science, and we work closely with many private companies. Next slide, please. I want to touch on 4 issues, stepping back to really the fundamentals. So first, thinking about what really drives cap and trade prices, and particularly focusing on the extent to which those are actually driven by policy. Second, I want to discuss how cap-and-trade prices lead to clean investment and some of the challenges in that connection. Third, I want to touch on a very big issue recently around environmental justice and equity concerns and what that can mean for risks around cap-and-trade prices and markets. And finally, discuss three big changes that are coming where there's a lot of uncertainty, but they could have really enormous impacts on the acceptability of particular types of units and on the prices of those units. Next slide, please. So going back absolutely to basics, what's driving carbon prices is, of course, a mixture of the demand and the supply. So the demand for reductions or the demand for allowances in a compliance market is essentially the mirror of a marginal abatement cost curve. And it depends very much on how much emissions would have been in the business as usual case or when there is no regulatory pressure to reduce. That's a very highly uncertain thing, but that's a critical input. Next slide, please. So the second piece of the puzzle is the cap, and that is the supply of the allowances set entirely by a regulator. And for the price in the market, because these units are bankable across periods, you can trade across time periods, it's not only the current cap that matters, but also the expected future stringency of the cap. If you expect the cap to become tighter in future, you'll hold back now and save some of those units. And because you can bank those units, unanticipated changes in expectations about the future can have quite dramatic short-term impacts on prices. The next slide. So the stringency of that cap is dependent on political will. That political will in turn depends in part on perceived feasibility of reductions and costs. It also depends on international diplomacy. So it depends on what's happening in international agreements, but also what's happening more generally in international climate negotiations and culture among companies even. And sometimes it's not only the stringency of the program that is at stake politically, but even the existence of the program. And of course, that would have a very dramatic effect on the value of the units. So if the cap either becomes or is expected to become more stringent, that's going to push up the prices. Third slide. Next slide, sorry. The other really important driver, which is unusual relative to purely private markets, is that other climate mitigation policies are very important in terms of the demand for allowances in the market. If there are other climate mitigation policies, such as requirement for clean cars or innovation support or building of critical low emissions infrastructure, that will reduce the emissions even irrespective of the cap-and-trade program, and it may reduce the cost of further reduction. So it shifts that marginal abatement cost curve, and that shifts the demand for allowances, lowering the price of allowances in the cap-and-trade market. So when you're thinking about the prices in cap-and-trade, you need to be considering the whole portfolio of policies. Next slide. So the fact that there's a lot of uncertainty in this demand means that there's a lot of uncertainty in the cap-and-trade prices. And that uncertainty comes from the policy, but also from the normal sort of market activities and changes in technology, demand for fuel, etc. Next slide, please. In part, in concern about dealing with that uncertainty, because we find it so hard to predict what those marginal abatement cost curves would be, nearly every cap-and-trade program now has some sort of price management. So I've sort of drawn one possibility, which is a price band, a floor in the auction, and a price ceiling, so that prices can't get too low and they can't get too high. And this provides some protection also against speculation that a market might actually be about to collapse when the regulators don't want that speculation to come true. So altogether, there's a number of policy instruments that are seriously driving the prices in these markets. Next slide, please. So as well as normal market factors, policy politics and even international diplomacy are driving these prices, which means they are creating a very specific form of risk for asset prices in these markets. Next slide. So just to look at the EU experience, this is their experience over their first pilot period and then the EU system since then. There's been enormous variation in these prices. There's a lot of short-run volatility, but those long-term changes are to do with changes not only in the global economy, but also very much in expectations of policy stringency. Other carbon markets, such as the New Zealand one, which I was heavily involved in creating, show a very similar pattern of prices over that long period in time. So what does this mean for investment? Next slide, please. The key purpose of cap-and-trade programs is to influence investment, low-emissions investment, avoid the high-emissions investment. We want investors to be able to share and lay off risk so that they can invest efficiently and so they can invest as fast as we need them to do. Essentially, our cap-and-trade allowances are a form of currency that is created by the regulators. And what we're wanting to do is to be able to trade that currency, hedge that currency, etc., in such a way that people can seamlessly make these trades. So I think there are some fundamental questions here about who has the best ability to trade risks. And I wonder, I'm not an expert in financial markets, but in some aspects this is a little more like foreign exchange markets than some other product markets. I also think that policy uncertainty is a little different from concerns about volatility in markets, and the ultimate goal is to reduce the policy uncertainty or manage the policy uncertainty, and maybe like monetary markets, that involves some changes in the way that we govern the creation of the currency of cap-and-trade allowance units. Next slide, please. So another issue that has become very important recently is environmental justice and equity concerns. And this takes a number of different forms. It can create policy risk, and that policy risk then creates price risk. So the first type of concern is around the use of market solutions in general for dealing with climate policy. And those concerns are several. So there's concern about procedural approaches, loss of local control when we use markets to address problems. There are distributional concerns that carbon pricing will have impacts on workers, on consumers. Of course, it also has impacts on asset owners. And there are concerns about market manipulation and poor management of markets. It isn't clear that these concerns and challenges are unique to cap-and-trade, but they are coming out very strongly in that context. There are some solutions to this that are being demonstrated by some of the people on this call, more inclusive governance, some simultaneous policies to manage local benefits, but we're still experimenting with those approaches. The Washington cap-and-trade system is an interesting one where they've got some new approaches to deal with this that may make cap-and-trade more acceptable. We also learned a lot about guardrails to avoid the market manipulation, so price protection, auction purchase limits, strong registries, etc. Next slide, please. The other concern that can arise around equity, and this is something that we have seen in New Zealand markets, which involve some very small forestry players who are part of our cap-and-trade market, is that when you have small sellers, they can be exposed to unnecessary risk. And because these markets are complex, not many people understand them, it's very easy for people to fall prey to snake oil merchants. This is particularly true in the nature-based solution space. So as we move more into that space with either offset or regulatory programs, we might need to pay more attention to this. One of the unusual things about nature-based solutions is that you can create liabilities because you're storing carbon in soil or in forests, and if that carbon gets released, there can be a liability associated with that. There are, again, approaches to dealing with that are developing, but those are still an area where I think more development is needed. So in summary, on the equity issues, they still pose real risk to the existence of and the reliance on cap-and-trade markets, particularly in the United States, and therefore I think they constitute potentially a major source of price risk. Next slide, please. So going forward, there are three main areas where I think we're going to see very big changes. The first is that we really hope that prices are going to rise. We've seen dramatic rises in the EU and New Zealand markets recently. If we're not successful at getting these markets working with more realistic prices, we're likely not to be solving the problem. The second is that international carbon markets are evolving. This has been happening for 25 years. I've been working on it for 25 years. It's still a space that is not particularly clear, but as they do evolve and we have to make them work, that's going to affect domestic cap and trade prices, but it's not clear how that's going to happen, and that will need to be watched closely. The third is the surge in voluntary markets and how those are going to operate alongside cap and trade markets. And as cap and trade markets expand, which they are doing rapidly across countries, expanding their scope, that's going to really impact on the role for the voluntary market. And just to give a couple of examples, there's a new initiative in the US called the Climate Vault, where voluntary markets are buying allowances out of compliance markets because they are buying out of a very strongly credible system with a real limit at a statewide level. That's an option that could be attractive for voluntary markets. They've done very similar things for the last 10 years in New Zealand, buying out of the compliance market to meet voluntary market needs. So that's a direction that could evolve further. And what we may see is that if the compliance markets really get established, the voluntary ones will shrink because the corporate actors will have these very strong compliance options to use instead. And that could conceivably happen very rapidly. Also, the desire for standardization, which is really critical, could invalidate many of the current credits that are coming out on the market. Not the really strong ones in the short term from people like VCS and so on who've been discussed earlier, but from some other smaller suppliers who are springing up very, very rapidly. So I think there will be a lot of risks as we have the transition from voluntary to compliance markets and from domestic to larger scale markets. This could lead some types of credit to lose all their value, and it could lead prices to be driven by new political forces. A particularly critical issue we do need to watch is the problem of integrating compliance and voluntary markets, because you can't count emission reductions twice in a way that suggests that you are creating climate benefit twice. You could use the same reduction to meet a US target and a company target, but you can't claim that both of those are independent reductions. They're happening in the same activities in the same jurisdiction. And we still don't have models for how those are going to fit together as more and more countries have really solid nationally determined contributions and commitments under Paris that they begin to comply with. Last slide, please. So in summary, cap and trade markets are created by regulation. They're a regulatory phenomenon. So the politics behind those creates price risk. The second, supporting clean investment is a central goal, and that makes managing that policy-driven risk really key. And if market processes and initiatives like this can help with that process, that would be very helpful. Third, equity and avoidance and manipulation are possible and very important, but they do require more attention than we've given them in the past. And finally, I think these markets are really growing fast and prices are likely to rise, and also the shape of the markets is evolving fast. So this will need to be an ongoing engagement to make sure that the way that the derivatives markets are handled keeps pace with those underlying changes. Thank you very much.
Thank you, Susie. Eric?
Thank you, Dina. My name is Eric Heinley. I'm with the Office of People's Counsel for the District of Columbia. I want to start just by thanking Commissioner Berkowitz, the Commission, Dina, Abigail, for including me in today's excellent discussion, and more importantly, making sure consumers have a seat at the table as these important issues are addressed. My office represents ratepayers in the District of Columbia with a focus on retail ratepayers such as individual residential consumers and small businesses, folks who otherwise would not have a seat at the table in discussions regarding energy policy either at the retail or wholesale level. In addition to ensuring affordable rates and reliable service for district ratepayers, my office is charged with evaluating how certain energy policies impact the district's ambitious climate and clean energy goals. Thus, when we consider market constructs like carbon markets, it's with the goal of most cost-effectively facilitating the energy transition to clean, carbon-free, reliable electric service. With that framework, I'd like to speak to you about how our office, DCOPC, approaches carbon pricing, while noting that many other consumer advocate offices, the primary focus remains on ensuring the lowest possible rates for their consumers, regardless of resource type. Finally, the usual disclaimer that the comments shared here are for discussion and purposes only and don't necessarily reflect the policies or positions of the People's Council on any specific issue. If we could jump to slide 3, that would be great. Go back one, please, actually. Great. So, appreciate it. Thank you. So the old sort of consumer advocate adage used to be reliability at least cost. And under that, price is king as long as it did not impact service reliability. However, as states and jurisdictions like the district have enacted clean energy and decarbonization goals aimed at limiting and mitigating the impact of climate change, it may be time to rethink this perspective to cost-effective reliability and sustainability. Here, cost is still critical. However, resources with attributes that help reach reliability and sustainability targets have value outside the immediate energy and capacity they generate. Importantly, and this was, I think Susie Kirk did a great job of highlighting the environmental justice concerns, but we must always be mindful of the impact on low and moderate ratepayers of all these policies. In an economically diverse jurisdiction like the district, we have ratepayers who desire and can afford clean energy at almost any cost, and ratepayers for whom any increase in cost would impact their ability to afford life's other essentials, including food, medicine, and shelter. So all of these factors must be weighed as states and jurisdictions consider energy solutions that are reliable even during the hottest and coldest months, that are resilient against extreme weather and cyber and physical security threats, that consider issues of immediate environment and environmental justice, that address economic concerns and opportunities, that achieve decarbonization goals, and of course, that ensure that rates are just and reasonable. Finally, I want to note that all the items I just mentioned fall squarely within the state's jurisdictional bailiwick under the cooperative federalism framework created by the Federal Power Act and the Natural Gas Act. We could advance to the next slide, please. As I mentioned, the district has robust decarbonization goals, including reducing carbon emissions by 50% by 2032 and carbon neutrality by 2050. These align with our goals and commitments under the Paris Climate Agreement. However, it's worth noting the district is not alone, and other jurisdictions have enacted similar goals. According to the National Conference of State Legislatures, more than half of the states have established renewable energy targets. 30 states, including Washington, and as well as Washington, three territories have adopted renewable portfolio standards, or RPSs. 14 states, Washington, Puerto Rico, and the Virgin Islands, have an RPS requirement that exceeds 50% or more. As I said before, offices like mine are charged really with the responsibility of making sure that as state and jurisdictions and other jurisdictions set these clean energy goals, we can do so in a cost-effective, reliable way. Advance to the next slide. Great. So while I mentioned that many states have clean energy and decarbonization requirements, they differ both in the target numbers. So, for example, whether it's 50%, 35%, 40%, whatever the number might be, as well as the pace. It's 2030, 2050, 2070. And it's also worth pointing out that some states, as is their right, do not have any clean energy or decarbonization requirements or goals. Additionally, states may define clean or renewable energy resources differently. Almost all states that have RPS requirements include traditional resources like solar, wind, and hydro, but several states include nuclear power under a zero-emissions resource and credited accordingly. Others include thermal generation that uses renewable resources like ethanol, waste, or pulp. And as carbon capture and sequestration technology develops, thermal resources that have this capability may also be included under the umbrella of clean or low-emissions resources. This diversity, of course, can be a strength, particularly as we consider the range of resources necessary to reliably and sustainably meet the targets of the energy transition. But it also complicates policymaking at the regional and national level. For example, PJM Interconnection, which manages the wholesale grid for 13 states in the District of Columbia, has a carbon pricing task force that has been going for the past 2 years. While discussions among stakeholders, including DCOPC, have been informative and robust, issues like border adjustments between the different states that make up PJM and their different decarbonization goals makes progress difficult. And we talked a little bit earlier today about the difficulty with border adjustments internationally, but those same issues arise, and they're just as politically thorny domestically when we have different goals and different carbon and energy goals among states. That's not to say there haven't been successful multi-state programs, and Secretary Grumbles talked to us earlier today about Reggie, but they are limited and often encompass states that have very similar generation portfolios and climate targets. If we could jump to the next slide, please. Okay, the slide that we're looking at here is courtesy of PJM's 2020 Maryland and District of Columbia State Infrastructure Report. And I think the big takeaway from this slide is that the PJM region has seen significant reductions in carbon over the last 15 years, largely due to the transition from coal to natural gas-based generation. And I think one great thing we can say about this is that the existing market constructs, the energy market, the capacity market, which is the forward energy market in PJM, do work, and they are helpful in reducing carbon. And I want to sort of provide some late-breaking news. So yesterday, PJM announced the results of its latest capacity auction, and it, again, showed a continued decline in high-carbon resources like coal, while with an increased use of zero or low-carbon resources like solar, wind, and nuclear. I think the question here is has all the low-hanging fruit from the coal to gas transition already been harvested? We started out at about 1,300 pounds per megawatt hour, and now we're down to just below 800 pounds per megawatt hour. But there may still be some room for lower carbon emissions simply through the market retirements of the existing inefficient high-carbon resources. Second, so assuming that we can't get to deep decarbonization with the existing market constructs alone, we need to consider whether the carbon pricing, can help us achieve that. And that's really the discussion that's important here today, and whether decarbonization can help us get to that next level of, whether carbon pricing can help us get to that next level of deep decarbonization that the science tells us is necessary to avoid the most severe impacts of climate change. You could jump to the next slide, please. And actually, one more. This is kind of some of the points that we talked about with the last graph on the PJM market. So as we look at carbon pricing from a consumer perspective, there are several positive attributes that stand out. As we look to transition the grid into a reliable and resilient manner, we have to evaluate resources based on common factors. Common factors help us recognize that each resource brings strengths and weaknesses, and that no resource runs 24/7, 365. So every resource has outages. Every resource has weaknesses, whether it's fuel supply, whether it's the intermittency of other resources, such as with solar and wind, whether it's the impacts of extreme heat or extreme cold on the ability of the thermal resource to light. And so we need to create a framework that considers those, and carbon pricing can help us do that. Carbon pricing can also help create a uniform value for all resources, both carbon-free and thermal. And this, again, allows us to value resources on the attributes they can offer, including the attribute of low or zero carbon emissions. So, again, it's a way to sort of levelize the playing field, allow resources to participate based on the attributes they have, and allow the market to recognize those attributes and attributes that are important to consumers, like reduced carbon or zero carbon that contribute to sustainability, those attributes should be included in cost to consumers, and consumers should pay for them. But again, we need to make sure that that there's a levelized playing field for that. Pricing across the region may address some of the border adjustment issues that we've talked about. Obviously, a bigger market or a more flexible market may address some of those border adjustment issues that are often very thorny and prevent the development of large-scale carbon markets. Carbon markets may reduce the need for individual state policies. I described the patchwork of state policies, and different states have different policies. I can't say that if we develop a national carbon market or even a regional carbon market that the states would give up their authorities, but I think there would be less incentive to develop some of those policies. And I think that would have a benefit because as we lower barriers to entry, we increase competition, we lower prices. Those are all good things for consumers. So again, I think in that respect, carbon pricing may help create a more open and competitive market, and that's obviously something that is in consumers' favor. It may also address perceived concerns regarding state policies and organized markets. These concerns particularly address the ways that state policies may incent certain resources, including low-carbon resources, and have become a particularly tough issue or flashpoint in the capacity markets at PJM and ISO New England. Well, DCOPC believes that at most the impact of these state policies has been minimal. Carbon pricing across all resources is one tool to address this political concern. We jump to the next slide, please. So there's a lot of strong attributes of carbon pricing, but I would want to say that consumers and consumer advocates are not quite ready to dive right in. Most importantly, of course, the details matter. We want demonstrated cost benefits to consumers. Higher costs, which carbon pricing will likely involve, must come with clear benefits to sustainability. And again, when we look at all these different market mechanisms as consumer advocates, it's really important to understand what we're incenting and making sure that if consumers are asked to pay additional money, that they're getting the good bang for their buck, and that we're getting the right incentives that we want. There are questions, of course, about equitable and just distribution of revenue from carbon pricing. It's critical that some of the revenue from carbon pricing be used to help ease the burden of the energy transition for those moderate and low-income ratepayers who are really at the most vulnerable end of the scale, and we need to be concerned about. Questions about the appropriate scope of a carbon market. So obviously we talked a little bit about Reggie. And Reggie's an interesting focus because, of course, it covers three organized markets, PJM, New York ISO, and New England ISO. We also talked about the California Air Resources Board, and that's more focused on a single market. But the question is, does carbon pricing work across a smaller sort of organized market? Does it work across an organized market, an RTO? Should it go in a multi-market situation? So again, something like New York ISO, New England ISO, or ISO New England, and PJM. Or do we want to go for a nationwide carbon market? And there are strengths and weaknesses to each approach. Bigger markets, of course, bring economies of scale and the benefits of broad market participation and competition, which lowers prices and probably gets us our most resilient and robust grid. However, diversity of resources across states and across regions, and the topology of the transmission system may limit some of those efficiencies. So again, different regions that use different sets of resources. Transmission system is different across the country and in different organized markets. And so, again, that may limit some of the resources, some of the efficiencies that we would get from a large, multi-region or even national market. So it's something to consider as we move forward with this. We want to, of course, match the incentives with goals. Markets work best when incentives are clearly tied to goals. We want to incent the right resources to dispatch at the right time in the right place for the right cost. And again, getting those incentives is always critical. And when you're asking ratepayers to pay more and to incent certain activities, you want to make sure those incentives work. Questions about the forward-looking nature of the market. Many energy products are forward-looking, so capacity, financial transmission rights. Does it make sense for this market to also be forward-looking? What's sort of the appropriate time frame? what will incent, again, the right resources to do so in a cost-effective manner. So those are all considerations to that, from a consumer advocate perspective and from my office's perspective, if a carbon pricing proposal came forward for, say, the PJM region, which the district is part of, those are some of the questions that we would ask in terms of whether this makes sense for ratepayers in the District of Columbia. Last but not least, last slide, please. We want to recognize what can the Commission, the CFTC, do to help us, make sure that if we go down the road of carbon pricing and a carbon market, we do so in a cost-effective, efficient, and equitable manner. And recognizing, of course, obviously the CFTC would not be the body that would set up the market because all of these markets have derivatives. It will play an important part in making sure that the market works for market participants and for ratepayers. So sort of recognition of use of carbon pricing as a hedging tool. Commissioner Berkowitz this morning noted the way that the Commission the role the Commission can play in incenting certain products that will help with the energy transition. That's certainly an incredibly important part of this. Ensuring transparency in market liquidity. Consumers always want to make sure that the market is transparent, that we understand the transactions that are going on, and then of course that there's liquidity, so that prevents the market from market power abuses, those types of things. And then finally, and this is also something that I was really glad to hear Commissioner Berkowitz mention, market integrity and ensuring that consumers are protected from market manipulation and failure. And that's obviously a key regulatory function of the Commission. So with that, I'm happy to conclude and look forward to any questions. But again, I think carbon markets certainly offer potential for consumers, but we need to balance that potential with the details as they develop. So thank you very much, and I appreciate the time.
Thank you, Eric. Mr. Chairman, Commissioners, the Natural Gas Supply Association is a trade association of natural gas producer, marketer, suppliers. Markets Matter has been our tagline for well over a decade. If we were all there at the CFTC and I handed you my business card, it would say clearly on there, Markets Matter. But for us, it really is more than a tagline. It's really fundamental to what we believe, that markets do matter. We also recognize that there is a national, really an international conversation going on about the need to reach a lower carbon energy future. And while markets may never be perfect, really whatever perfect means in that context, we do fundamentally believe that a market-based approach is the best approach to reach the goal of a lower carbon energy future. We're very proud of the fact that 2 years ago, NGSA publicly announced its support for a national economy-wide price on carbon, and that made us the first National Gas Trade Association to take that position. As we said then, and as we continue to believe, an effective, well-designed carbon price policy, whether it takes the form of a tax or a cap and trade or other forms of pricing, is really critical to decarbonizing the world's energy system. Such an approach, we believe, would provide a level playing field for different fuels and technologies. We're not against any other fuel. We just want an opportunity to compete. We know that it's going to take a lot of hard work to build a lower carbon energy future, and we know that nothing is easy when it comes to tackling the issues around climate policy. So why should this be any different? The details, and some of them have been talked about here today, about border adjustments, leakage, the price of carbon, how to allocate the revenues, those are just a few of the really many complicated issues that agencies, states, regions, governments are going to have to sort out. But in our view, it's well worth the effort. And it's well worth the effort to develop a sustainable long-term solution and also instill market confidence in the future. But regardless of how it's done, our members see natural gas as an important building block in reaching important climate goals, a building block that is in partnership with renewables. It's also abundant here in the United States, and it's affordable, which is also something that's been discussed quite a bit today. We've seen some success in the discussions of carbon policy. particularly at FERC in an effort that began under Chairman Chatterjee's leadership. FERC recently issued a policy statement that makes it clear that FERC will consider carbon pricing proposals that are brought to it from the organized market, from the state, while confirming also that FERC does not intend to step on states' rights. Recognizing that there are lots of obstacles, we still think that a carbon price policy is the best and most sustainable long-term solution for several following reasons. First, we believe that if it's properly implemented, it will allow us to effectively achieve carbon reductions without compromising competitive wholesale markets. For instance, some resources in the regional transmission organizations, the RTOs, are subsidized by their states, which allows them to bid lower prices in the market and outbid those that are not subsidized. Second, carbon prices allows all resources to compete and allows the natural gas renewable partnership to address intermittency and resource adequacy. Keeping the lights on is one goal that we all share. And in some of the conversations that have gone on in some of the states and the cities and the localities, I'm not sure that keeping the lights on is really something that has been fully considered the way that we think it should. We've got to keep the lights on. We've got to continue to power this country. And that's a promise that I think we've all made and that we need to keep to maintain the public's trust and confidence. Third, carbon pricing incents innovation. One of the reasons that we have such an abundant supply of natural gas in this country right now is because of the shale revolution. The shale revolution came out of technological innovation. So those same smart people and more smart people who have devoted so much time, effort, and energy in the innovation that led to the shale revolution, I'm sure will continue to work on things that can lead to newer, cleaner technologies. Carbon capture, utilization, and storage is one. But all of these new technologies will hopefully reduce the cost of carbon for businesses. And finally, allowing the market to select the most economical resources has never been more important. We're hopefully coming out of the pandemic. Hopefully it won't be that much longer before we'll be able to gather at the CFTC and other places to discuss all of these important issues. But there's a recovery in this country going on. People are trying to get back to work. People are trying to get back to their jobs. States, households, businesses are invested and are investing in this economic recovery. And the revenue generated by carbon pricing can be used to help those who have been impacted. We're not in favor of government policies that pick and choose the resource mix through REC funding. That's why we believe that markets matter and that markets work. As a key federal regulator of markets, the CFTC is as well aware as we are that markets do matter. Given the broad support for carbon pricing and what we think is a general recognition that it's one solution that really can effectively balance meeting climate carbon targets and selecting the lowest cost resources, encouraging investment, and ensuring energy reliability, sometimes we're a little puzzled as to why it doesn't get more traction. But we're really thankful that today this conversation is happening at the CFTC. We think that the CFTC is an important convening authority to continue to bring market participants and stakeholders and really everyone who has a stake in this and the outcome of this conversation, but to bring people together and to continue to get ideas and thoughts and proposals about how we can move this forward. Thank you very much for your time. And with that, I will turn this over to our next panelist, Annette. Thank you.
Thank you. And thank you. Did you hear me? Thank you very much for inviting me to speak today on the Task Force on Scaling Voluntary Carbon Markets. I very much appreciate the invitation of the Commission and the Market Advisory Committee to have the opportunity to speak here today. The task force, I know, has been mentioned several times in the proceedings today, which is very gratifying. It's also, I think, symptomatic of the fact that we were a very open group, and I think many of the folks who are listening and participating today have probably either participated or had input into our process. So the Task Force on Scaling Voluntary Carbon Markets is a private sector-led initiative. It's working to scale an effective and efficient voluntary carbon market to help meet the goals of the Paris Agreement. The task force was initiated by Mark Carney, who many of you know is the UN Special Envoy for Climate Action and Finance, and he also, you'll recall, was the former governor of the Bank of England and former governor of the Bank of Canada. The group is chaired by Bill Winters, who is Group Chief Executive of Standard Chartered, and it's sponsored by the IIF, which under the leadership of Tim Adams. And I am here today because I served as operating lead for the task force, I suspect because of my background at the Securities and Exchange Commission with respect to markets, both as the head of the Division of Trading and Markets and then as a commissioner. Our group also has a tremendous amount of knowledge and advisory support from McKinsey. So the task force, as I said, very broad group, over 250 member institutions and over 400 individuals, and I can attest to the fact that they have been very active participants, and they represent really the whole value chain for the carbon markets. They represent buyers and sellers of carbon credits, standard setters, the financial sector, market infrastructure providers, civil society, international organizations, and even a number of academics. We also, in the second phase of our efforts, formed an advisory group of 20 environmental NGOs and investor alliances and academics to run by them, what the results of our working groups were in order to get their views and make sure that we were sort of aligned with current thinking. The task force's unique value proposition, as I said, is that we brought together so many members of the value chain to work together and to provide recommendations on such a critical issue facing our countries and the world. And that was really one of the main focuses of ours, was that this is a global issue, and we have to address it imminently. As others have said today, in order to achieve the Paris ambition of limiting the average temperature rise to 1.5 degrees Celsius, everyone in the global community has to reach net zero emissions by no later than 2050. And to credibly reach that target, you have to start well before 2050, and we believe well before 2040. So, we have been advocating that every participant in the economy, every country, every bank, every investor, has got to start adjusting their models now and developing, credible plans for their transition and to implement them as rapidly as possible. Many countries and companies, as we've said today, are rising to that challenge. But more needs to be done. We think that in order to, in addition to addressing, the primary obligation that corporates have, for instance, to decarbonize, additional compensation and neutralization efforts are also very important. So more has to be done than, and the reason it is important to have these carbon markets is that it is impossible for some market participants to reduce their carbon emissions as quickly as necessary, given either the state of technology or the excessive cost of doing so at this point, which is why having carbon offsets and having carbon credits is an important supplement to that effort. Others talked, I thought, very eloquently about the difficulties in the markets today. Derek, among others, talked about from CME, I thought described it well. I mean, what we have today are markets that don't have, I don't think, the kind of robustness, the integrity, the transparency, frankly, the standardization that we think is necessary to build these markets up quickly enough to make a real difference in our carbon goals. We need, as I said, more standardization. I think what we have today, we have carbon markets. We've heard about them in today's call, and I think there's been a lot of progress made, and those who've been involved in that, should be, credited with that. But the fact of the matter is we still face a lot of uncertainty in these markets. There's still concerns about the integrity of the underlying carbon credits. There are concerns, some raised concerns about the registries. I think with a lack of standardization, pricing is difficult. And in addition, I mean, if you just think about market structure in general, I mean, if you build robust, standardized markets, you would expect more liquidity to aggregate around these products, and therefore liquidity would beget liquidity. And going back to one of the questions I think that Commissioner Berkovitz raised, I think you'd also see more intermediaries coming into the market. In other words, this is something that we want to really scale up like a very well-functioning, legitimate, well-recognized market as quickly as possible. So to give you a little background, the task force was initially convened in September of 2020, and at that time we came up with a report of 20 recommendations identifying solutions that were necessary to scale the voluntary carbon markets. And those things that were discussed really went to market integrity, product integrity. Again, as I mentioned, coming up with a standardized product, something that I'll talk about later, which was a core carbon principles. What is the core underlying, and also additional attributes, which are additional attributes to the carbon contract that are important to some people, whether it's whether it's the type of, whether it is a natural-based solution or the technology project or things of that nature, so that people could have a limited number of additional attributes as well. The membership, the report was issued on January 27th at the virtual World Economic Forum, among other places. But since then, the membership has grown. And as I said, we now have a huge number of members, over 250 organizations, 20 sectors of the economy represented, and membership over 6 continents. And as I said, to ensure the highest level of integrity, we also added an advisory board. But the work isn't done. We recommenced the project, so Phase 2 began in March of this year, and we've done a lot of work that I'd like to briefly describe to you, and also commend to you our report, because we have issued the draft report of this Phase 2. It was issued on May 21st, and we are looking for June 21st for folks to get back to us with comments. But the work for the Phase 2 focused on 3 primary core working groups, working topics. One was governance, the second was legal principles and contracts, and the third is credit level integrity, and I'll describe those in a bit more detail. Now, other areas that were also part of the recommendations from Phase 1 they're not forgotten, but we're dividing and conquering. There are other groups and other independent efforts that are underway to address the issues that we did not undertake. are participating today have been part of those efforts, and I know that there are lots of efforts underway, both for, how are we going to clear these trades, what kinds of futures products might be created, a focus on meta registries and the like. So lots of work underway there, and with some of the other issues. But as I said, we focused on three primary issues: governance, legal principles and contracts, and credit level integrity. We also had a fourth working group that was done primarily by the operating team, and that was stakeholder engagement. Because one of the very important issues here is that there be sort of a common public understanding and narrative around the value and objectives of what we're doing and the value of an offset market. So we've spent lots of time on that as well. But for our three working groups, I'll focus on them rapid order. Our first goal in governance was to create a future umbrella body with a mandate to implement, host, and curate a set of core carbon principles, provide oversight of the standard setters, and to coordinate interlinkages between individual groupings. And so the task force did create a blueprint for a future governance body, specifying its mandate, its organizational structure, sources, potential sources of funding, and a process for its setup. We did find that a large majority of our participants emphasized, and I heard this sentiment on today's proceedings as well, that we need to really increase the quality of credits. We need to ensure integrity, liquidity in these markets. And so the feeling was that to have trading at scale and to ensure that that happened, we needed to propose an oversight group. Obviously, it's challenging to do that from scratch, where we've got several recommendations on how to do it that, again, we're looking for reviews on. But as I said, the base issues with this group are that they really have to establish, host, and curate the core carbon principles, and what is the eligibility for those. This committee that we formed, this working group, did not come up with what those standards were, but rather is leaving it, to the governance body to come up to establish what those core principles are, and then establish an assessment framework, and then establish eligibility principles for suppliers and verifiers. They also would provide oversight for the standard-setting organizations on adherence to the core carbon principles. I keep wanting to call them CCPs, but I know everyone on this call, like me, thinks of CCPs as something other than core carbon principles. And then they will also work on coordinating with other groups that are involved in voluntary carbon markets to ensure that there's consistency across those efforts. The second working group, again, was legal principles and contracts. And our goal there was to standardize the legal framework underpinning credit issuance and trading contracts with a common language, common understanding on things like liability, ownership, delivery, et cetera. Again, one of the issues that we have today with the carbon markets is a lack of really taxonomy, a lack of consistency of provisions. We have buyers and sellers who find each other and do trades, but a lack of standardization is certainly a friction in preventing a rapid scaling of these markets. So we defined use cases to drive awareness of the potential ways to use the market. We developed operational requirements for terms of use and standards, and then we worked on developing general trading term clauses. So we, again, it's something that the governance group can ultimately act upon, but we thought that it would be helpful to give them a head start by coming up with, what would key terms be such as rules on dispute resolution, limitations on liability, indemnity clauses, things of that nature, so that, again, we would be furthering the goal of having, standardization and consistency in the market. Finally, the third working group is on credit level integrity, and our goal there was to create the core carbon principles that I've described. I should be clear that while we describe what would be a core carbon principle and therefore what would be eligible for these carbon trades that we're recommending, the bottom line is there's nothing that precludes trades from being done that don't meet those standards. They just obviously would not come within our framework. We're not regulators. We can't prevent trading in other ways. So we achieved, we think, our goals by drafting an assessment framework for the standards and an analysis of credit eligibility criteria and a proposed taxonomy for additional attributes. This one is going to be the biggest amount of work for the governance group because, obviously there's a lot that goes into developing what is a core carbon principle. We've done, you'll see in the report, a lot of work on sort of all of the literature that's out so far, extant on what makes a good, credible carbon contract, and so that will be a starting point for the governance body's work. But again, the core carbon principle at base is designed to create a high-quality standard for carbon. And as I mentioned earlier, we also have proposed a limited number of additional attributes that we think are likely to be of interest to buyers and sellers, but that we think by limiting the number, again, it will hopefully encourage greater standardization. So the additional attributes today, these are attributes that exist today. I think some of our panelists even discussed them, but they're not often, specified, and they're not. If you look to the registries today, they're not classified in the registries as having these attributes. So, for example, was the contract for removal versus avoidance or reduction credit? Going forward, these attributes would be specified for each contract. Other types of things, as I mentioned earlier, such as what was the removal or reduction method, such as was it technology or nature-based, or what was the storage method. Those are the kinds of things that we are proposing as additional attributes. And we think, again, having the core contract and with the additional attributes the limited number of additional attributes would enhance the ability to create reference contracts based on those actions. So, needless to say, we think this has been a really historic effort. It's been very gratifying. It's been tremendous to have the cooperation of so many people who, you always say leave your, special interests at the door and just give it your best effort. And I really think largely that was the case. People are very similarly, very like-minded in trying to do the right thing for the planet. And so, again, just to remind you, the report was, the draft report was made public. We are looking for comments that anyone might have by June 21st. I think you could find the report on the IIF website, among other places. We plan to issue our final report mid-July. And from there, our hope is that it does not become a very heavy doorstop, but rather something that really makes a difference. We're very optimistic that we'll be able to stand up a governance group as quickly as possible late summer, early fall would be our goal. We also are hoping that we would see some pilot trades done before the end of the year. And we're also very heartened to see all the activity, as I said, that's already happening, particularly in the capital markets in this area. I think we've seen some carbon exchanges already being formed and being ready to announcing their formation. IHS Markit announced that they've created a meta registry that can bring data together from all the registries across the globe. The wonderful thing about this, these kinds of efforts is that you do get to see, how the capital markets can work at their best if you come up with the right structure. And finally, I think, as others have said, it's quite clear that what we'll see from all this is futures contracts in this area, and that's why we're here today. And I know that the CFTC has been, very encouraging of efforts in this space, and we really forward to working with you over time to the way that you can to assist us in having robust and credible and markets for carbon.
Thank you, Annette. Matt, we'll turn this over to you now.
Thank you, Dina. Good afternoon, Mr. Chairman, Commissioners, EMAC participants. First, I want to start out by thanking Commissioner Berkowitz and Abigail Knopf and Lucy Hines for developing this timely program and giving the Commercial Energy Working Group an opportunity today to present on what our activity is a little bit in these markets, but more importantly, offer a proposal that we think going forward will help the Commission understand both the underlying markets and maybe the way the secondary and derivative markets can develop around what we call environmental products, which have a little bit broader scope maybe than just carbon emission credits, because they're part of the energy market complex. But let me begin by congratulating all the previous participants today and panelists on their extraordinary presentations. They were very informative and really framed a lot of what's going on today. Then I want to provide some background on our proposal or on our efforts and what our proposal involves. So the members of the working group participate in many different energy markets and markets that have government programs that are directed at reducing carbon emissions. For example, we've heard a lot of discussion today about transportation sector efforts, utility sector efforts, voluntary markets, programs that are generated by government agencies. Overall, we support an economy-wide, market-oriented approach that explicitly adds the price of carbon to energy markets as a means of reducing carbon emissions. We believe this is the most efficient way of reducing carbon in the sector. At the federal level, at least with respect to the development of underlying markets, there have been recent legislative proposals to address carbon emissions that include some market-oriented approaches. It's hard to tell, though, where those proposals will go and if they'll gain traction. So at present, we kind of view the world in the way we've heard a lot of it today, which is around state and regional programs in the U.S. That are conducted at those levels and at different sectors of the economy that are directed to reduce carbon emissions. But more importantly, like we heard today, they're also designed to support the development of renewable resources that will help the overall reduction of carbon emissions in our economy. Members of the working group face compliance obligations with a lot of these programs. For example, we could look at Reggie, and members would be operating fossil fuel-based carbon electric generation plants that emit carbon and have to participate in those markets and do so in order to meet compliance obligations. And they also participate in renewable energy credit markets under renewable portfolio standard programs that we see across the different states. And those programs are more directed at developing specific renewable resources. And we can discuss whether or not those programs are within scope or without a scope of what I'm talking about today. But they're certainly related because as we look at those programs and the renewable energy credit markets that evolve around them, we know that they are a part of the revenue stream and the support that's needed to develop a lot of these resources we want to do going forward. So we will believe that the near future, at least, will include a smorgasbord of policies, as we call it, and environmental products that will be used to address carbon emission reductions. And since their physical markets and derivative markets for these products are closely related, we think it's important for the CFTC to have a background on these, how they developed, and the parameters for these products. As I mentioned, it's well established that the carbon markets and the markets for allowances and related derivatives are closely linked. In financial derivatives play an important role or function in enhancing liquidity and facilitating price discovery to help market participants hedge and meet their compliance obligations, as well as consider the way they want to develop particular resources. This linkage means it's important for the CFTC to provide guidance on principles that it would consider in its role as regulator of certainly the secondary markets and derivative markets for environmental products. And again, when I talk about environmental products, a little bit broader, not just including some of the markets we talked about directly dealing with carbon emissions, but also maybe renewable energy credit markets. By having this understanding and a strong regulatory insight and oversight of these markets, it will lend confidence to market participants and policymakers considering developing new environmental products going forward. And it'll also help market participants comply and hedge their obligations going forward and support efficient market-based solutions. The working group is proposing the establishment of a subcommittee charged with the assignment of preparing a report for setting forth guiding principles for the design of markets for the independent trading of carbon allowances and offsets, basically focusing on the secondary markets and derivative markets. This effort would complement work that has been done under the Market Risk Advisory Committee, as well as what's going on in the newly created Climate Risk Unit. Also, it's worth noting that some of this effort is probably not plowing new ground, and that is because in 2011, an interagency report was developed under the leadership of then Chairman Gensler, looking at the oversight of proposed carbon markets. This report that was developed on an interagency basis was required under Dodd-Frank when that was implemented, and it provided analysis of the then current and complex web of regulatory oversight of carbon markets and the markets that existed at the time. The scope and intent of the proposed, what we're proposing today, developing these subcommittee to look at, develop a report that would have guiding principles around how these markets should function, would be different from those efforts that have taken place in the past. It's intended to facilitate fair and orderly trading in carbon markets by promoting uniform and consistency between the design of the secondary, cash, and related derivative markets for carbon allowances and offsets. It is not intended to replace efforts that other regulators will undertake and that have jurisdiction over the development of the primary markets for these products. And much of the discussion we heard today has focused on the development of some of these what we call the primary or underlying markets. So at a high level, we see kind of two tracks here. One, there would be structural elements that we would discuss with this committee and develop guideposts around that would address things like a clear statement of jurisdiction, identification of policy objectives, the recognized need to facilitate continued market development and liquidity, and benchmark setting. Some of the key market design features would also be developed in this report. And some of those items were touched on today. For example, we talked about market integrity and customer protection. That would be an element we'd like to see seen, cross-border considerations and transaction monitoring, to name a few of a long list of elements that we think would be part of or should be considered as part of a carbon market design. How do we intend to deliver this? Well, we're proposing that we've developed a proposed statement of purpose, which we hope that would be considered by the committee, and it addresses some of the items I just went over in more detail, and that statement of purpose would be considered by the committee pursuant to whatever procedures that the commissioners and Abigail seem would say are appropriate for considering this type of thing. So again, we're trying to push forward here an approach that would help the development of these markets, and we look forward to working with others to do that. And thank you for your attention. And I'm free to answer any questions about the proposal if anybody has any.
Thank you very much, Matt. Abigail, do we have any questions and comments from associate members at this time? I have not seen any in the chat, but if any associate members have a question, please speak up. If not, I will move to the EEMAC members. Do any members of the EEMAC have a question or comment?
This is Sean Cota. Sorry for not unmuting quickly enough. I just have a general comment on everything. The potential for leakages in these markets, as we're talking about commodities that are global, right? Air is everywhere. So these things are going to go everywhere. And the diligence that's going to be required in all of these programs are going to be severe. So as these markets increase in size, the challenge for the CFTC and other regulators, I think, are going to be challenging. God bless you guys for working as hard as you are on all of these. It will be a huge challenge, and thank you for putting this together.
Thank you, Sean. Are there any other questions or comments? I'll try the associate members again before we move back to the members. I don't think so. Any questions or comments from the EEMAC members? Yes, Bill McCoy. Bill, go ahead, please.
Yes, thank you. And I'd like to thank all of the commissioners and all the panelists today for excellent presentations. Matt, I think your proposal is very intriguing. And you did mention cross-border considerations. I guess I was wondering whether you would envision that the scope of this proposal, of this report, would have potentially recommendations regarding how the CFTC, which has had such a great history in terms of coordinating internationally with other regulatory bodies, how, given that this is truly a global product, how it can be engaged in further coordination as these markets are developing and coming up with the standards, the policies, the approach, so that there's perhaps a greater chance of liquidity across the markets globally. Thanks.
I think that as I take Bill's question is how that effort could occur under the proposal I outlined, and certainly the CFTC probably has more experience than any agency I can think of, or certainly tremendous experience in addressing cross-border type issues. And the participants on this committee and the presentations we've heard from the various folks also have a tremendous experience in that area. So I think it would be a great opportunity through this subcommittee, that we're proposing and a report that could be developed to focus on how to do that, because it is a worldwide problem, and in terms of how these markets are formulated and how they could intersect would be a great effort.
Dina, it's Richard Sandor. I wondered if I could just make a shout out to Annette and Mark Carney, who gave a presentation at the American Financial Exchange at the University of Chicago on the task force for scaling voluntarian. And that you would have been really pleased. He was fantastic, great academic, joining from France, from England, from the University of Chicago. And he spurred tremendous interest in regional small and mid-size and community banks. So let's keep in mind that there's $11 trillion in assets held by people outside the money center banks, and there is a grassroots interest. And for the CFTC, and particularly for Don and other people, so these folks like Zions bank farmers. And there's really a big interest in agricultural offsets, or as they're known in the University of Chicago, negative emissions. And I prefer that than offsets. And just a shout out to Dan Berkovitz, who intellectually gets the whole history. And thank you so much for organizing this. What a fantastic day. And to all of the other commissioners for supporting it. But just a great event and a real privilege to listen to all of these experts.
We don't have any other comments from the members. I can't hear you. Do you have any other questions from the commissioners?
Are there any commissioners? Commissioner Berkovitz?
Yes, I'd like to hear Annette's Annette, you commented on barriers to liquidity and issues, and in light of the discussion about we work together on many of these same issues in the context of Dodd-Frank, and as Bill McCoy mentioned, reducing barriers to globalization and harmonization. And harmonization was a key objective of the Congress and the Dodd-Frank Act, international harmonization, and the G20 met, and there were some basic common standards that the G20 all agreed on that markets should have, and we have comparability. And there's a number of mechanisms that are built into, for example, the Dodd-Frank regime to promote global liquidity and harmonization. The climate is just a very different political structure that we're dealing with. So there's not quite the same global commitment to all proceed along the same lines and harmonization. And so we do have these regional markets and what in the Dodd-Frank context would be considered fragmentation. And I take it that part of what your effort is to maybe develop some common standards to maybe help reduce that. But to what extent do you see the regionalization and the separate markets is this a barrier that can be surmounted, or is this just something, this type of fragmentation? Is it going to result in separate liquidity pools of necessity? So maybe you could, and any other panelists too. But I think, Annette, you were addressing.
It's a very good question. Look, I think the issue is that here regionalization is even more problematic in a sense, right? Because we are looking for to basically have carbon contracts based on projects in the global south that folks in the U.S. could invest in. I mean, there's going to be a lot of cross-border transactions, and therefore I think the issues of cross-border are even greater here, I would think. And of course our challenge is that we don't, in a sense, have the power of the pen, right? We're not regulators, so we just have to create a marketplace that people really see is of value and want to participate in and want to meet those standards that we're setting on this voluntary basis. But I think it will affect the pricing. I mean, hopefully, the more integrity you have in the market, the better the pricing in the market, the more people will want to deal with, with us or deal with markets that are adhering to our standards.
Evan, did you have a comment?
Thank you. If I may, obviously the regionalization of the markets now is based on differentiated approaches to, climate issues, whether it be carbon emissions directly or development of renewable energy. And you have, different regions that are approaching this in a different way, different nations that are approaching this in a different way, although they're all driving, ultimately towards the same goal, ultimately of, decarbonization of the economy. The market has, the market has dealt really well with this, regionalization in these differentiated market and in these different liquidity pools by, creating structures that, can trade off basis and other mechanisms like that. And the exchanges have been really active in terms of, listing things across platforms that, multiple markets, allowing the players to, almost consolidate the liquidity themselves by the venue in which they trade. Just wanted to add that point. Thanks.
Appreciate all that. Thank you.
Anything else from our commissioners? If not, we'll move to the next panel, which is our fourth and final panel of the day. We are going to hear a CFTC staff presentation on the derivatives market's response to the extreme weather event in Texas this past February. We will hear from Raul Varma, Associate Director and the Market Intelligence Branch of the Division of Market Oversight, and Bill Heitner, an Associate Director in the Risk Surveillance Branch of the Division of Clearing and Risk. Raul?
Excuse me, Raul. Excuse me, Dina. Before we proceed to the final panel, I just wanted to clarify procedurally, maybe Abigail, could you tell us procedurally where we are? Matt Picardi had a proposal for further action, and what procedurally, where do we stand on that, and what would be the next step in Matt's proposal?
Sure. So we are going to we'll get a transcript for the end of this meeting, and then we will circulate the transcript to all of the EEMAC membership. We will then schedule our next meeting where we will hold a vote and take a vote from the members, because the EEMAC members, the 9 EEMAC members, have voting privileges for the EEMAC charter. If the vote is to approve the recommendation to the Commission that the Commission form a subcommittee for the EEMAC, we will then follow with paperwork with the Commission, as well as solicit requests for membership on that subcommittee from the EEMAC members, EEMAC membership, EEMAC associate members, and if there's any space available, we will solicit from the public at large for potential subcommittee members. And then once the committee is formed, then the committee could begin its work in creating a report.
And from the time of the transcript to the formal consideration and a vote, the members could discuss amongst themselves, either informally or in another meeting, in terms of fashioning the proposal so that everybody can, so that it's what the committee can achieve a consensus on it. So there will be that opportunity, correct, for members to speak amongst themselves and review it.
Yeah, but not to have the membership discuss across the membership, but the members can take the information from the transcript back to their respective firms and form a view.
Right. Okay. And then the commission eventually would have. You mentioned it's published in the Federal Register, and the commission eventually would have to approve it. Correct.
Correct.
Yeah. Okay. Thank you, Abigail. Sorry for the clarification there. So go ahead, Raul.
Thank you, Dana. Thank you, Abigail, and Commissioner Berkowitz for this opportunity. As we said in the introduction, as Dana said, my name is Rahul Varma. I'm an Associate Director with the Division of Market Oversight. And today, myself, and Bill Heitner, Associate Director in the Division of Clearing and Risk, will provide an overview of what happened in February in the Southwest, and the big Storm Uri, and how it affected the energy markets, natural gas and electricity in particular, and what effect it had on the futures markets. I will provide an overview of the events and the physical side of things, and Bill will wrap it up to discuss the specifics on how it affected the CFTC markets and what actions we took. Next slide, please. Just to be clear, the views that we express here are views of CFTC staff and do not necessarily represent the views of the CFTC, the chairman, or the commissioners, or the Division of Market Oversight, or the Division of Clearing and Risk. Consistent with Section 8, our presentation is a high-level presentation on overall market developments and market issues. We will not be discussing anything specific about an individual trader or trading behavior by any specific group of traders even. Next slide, please. So while the focus of today's discussion is on the storm and the effects on the energy market, today we want to start off by acknowledging that this was a huge storm, and that effect had a significant impact on life and property. More than 100 people are reported to have lost their lives during this storm. And the total damages, the insured damages are estimated at around $30 billion. But I've seen some estimates that total losses were as high as $295 billion. This is a significant impact. So what happened? So basically, for about a week, between the 12th to 13th of February through the 19th, the U.S., especially the Southwest, and by that I mean Texas, Oklahoma, Louisiana, New Mexico, and Arkansas, experienced severe weather, extreme cold. And that's what we see in the map, where we are comparing the temperatures over this 1 week with the 5-year average. And we can see that in a large part of Texas, temperatures, for example, were 30 degrees below the 5-year average. It's quite significant. The other thing that set this storm apart was the geographical extent. It covered a large area, and at one point of time or the other, there were 170 million Americans who were under some sort of a weather alert. And at its peak, 73% of the lower 48 were blanketed in snow. And all of these factors play into the effect that it had on the markets. Next slide, please. Okay, so I'm going to start off by discussing what happened in the natural gas markets to begin with. And if you go to the next slide, so we have extreme cold weather. What this means is there was a sharp increase in demand. And as we see on the charts, and this demand increase was both for heating as well as for electricity generation. And as we see in these charts, we're looking at the Southwest. We're comparing 2021 in the red bars with the demand level for 2020 in the blue bars, and we see over this period a very sharp increase. And we can see, and overall for this week, demand was up by more than 50% in the Southwest region. And this, in fact, pushed up the demand for the lower 48 totally by about 24% overall. This is pretty significant for a 1-week period. I don't have it on this chart, but one of the things that we observe is that as soon as the storm passed, the demand level just fell down back to the quote-unquote normal levels. The other thing to note is that affected the markets was that at the same time that demand was going up, there were significant well freeze-offs in the Permian region, and natural gas production fell. That is shown on the chart on the right-hand side, where again we compare 2021 with 2020. A few observations here. At its peak, the system lost about 22 BCF a day. That's roughly 24-25% of the national production. The second thing is that it wasn't an immediate effect on supply. So there's a rolling effect as more and more wells froze off. And finally, we observed in the production side as well that once the storm passed, production levels recovered quite quickly back to the normal levels. So now we have a situation where we have high demand, low supply. How do we meet the difference?
Well, the difference was met from storage withdrawals. And there was more than 300 BCF of storage withdrawal for that 1 week. This was the second highest level ever reported by EIA, and only the second time ever, again, that it was more than 300 BCF for any 1 week. Let's move on to the next slide. So now we have high demand, low supply, storage is being used almost to the maximum. And what do we see? We see high prices. Well, logically, this makes sense. And directionally, it's consistent with what we are seeing in the real marketplace, that prices would go up. We're not making any comments on the actual levels of the prices. So what we have on the map here is different parts of the country, different trading points. We show the average price for that 1 week, and as well as the peak price, the highest traded price in the market. I want to make a few observations here. Before the storm, prices were averaging around $3 an MMBTU. So any prices that you see over here, think of about $3 as a starting point. The second thing, because of the nature of the storm and the size of the storm, you can see that there was a huge impact all over the country. Second, these are prices for spot gas, for daily gas, for next day gas. Because this was a short-lived, immediate event, this affected the short-term prices, and as we'll see, not the long-term prices so much. So what were the prices? I'll give you a couple of points here. The Houston Ship Channel, again, starting from around $3, goes up to $200, nearly $200 on average for the week, and a peak transaction of $400. If you look at Oklahoma, the average was $463 spot gas, next day gas, and more than $1,000 for the peak transaction that were reported. In fact, these are the highest prices reported for record prices for next day spot gas, and trading platforms had to accommodate and make changes in their systems to allow for 4 digits. So this was pretty spectacular event when we look at the impact on the prices. But turn your attention a little bit to the Henry Hub node, which, as we all know, is a central point against which the future is delivered, etc. And what we see over there is that average prices reached $10. Again, quite significant if you think about it, that starts at $3, but not nearly to the level further away in the system. And the peak transaction was at $24. So the fact that Henry Hub goes up, but not by the same extent as other places further away, what this tells us is that despite the supply constraint, the pipeline capacity was running all out. So the pipelines were running full, and so we would see further bigger impact elsewhere in the system, further away from the main production centers, if you will. Finally, we look at the natural gas futures also, which is shown on the right-hand side for the same time period. In fact, a few days before, the highlighted area is the period of the storm. And what we see here is that prices, again, going from around $3, they jump up to about $3.22 at the peak, and then they fall back down. Now, this is about 15%. The reason the futures prices did not show the same impact was that these were futures for March delivery. And so the delivery period did not begin for another 2 weeks. Let's put all of this together. And again, what this tells us is that the market was looking at this as a short-lived event. Now, another factor to keep in mind is that March is considered the traditional end of the winter season. So there was a low probability at this point for further demand shocks to the system. So the futures really did not have as much of an impact, did not see as much of an impact as the cash market did. Next slide, please. So now I'm going to turn my attention to the electricity market with a particular focus on Texas. Next slide again, please. Thank you. So let's get a few basic facts about the Texas market out of the way. The Texas electricity grid is relatively physically isolated from the rest of the United States. Not completely isolated, but relatively speaking it is. The grid is operated by Electricity Reliability Council of Texas, or ERCOT, and it is regulated by Public Utility Commission of Texas, which is a state regulator, if you will. The second thing that comes into play here, and you'll see some effects of this, it's an energy-only market. There really isn't a capacity market like we see in other ISOs and RTOs. And approximately half of the generation in Texas is from natural gas. So during this period of the storm, we had a significant level of equipment failure due to inadequate weatherization, which means parts of the system, whether it be a wind plant, a nuclear plant, many different types of generation, they stopped working because some part of the system froze up. In fact, just a quick comment on that. Recently, Governor Abbott signed a piece of legislation requiring generators and some pipeline operators to improve the weatherization of the system. So as a result of this, so you have high potential demand, and we have supply falling off because of weatherization. The second thing that then happens is that ERCOT as a system operator implemented load shedding to prevent system collapse. And really the way that we can think about it is this, that there are the reserve margins that are left in the system. The cushion that you have between the actual demand and what the system can generate, when it begins to fall very low, the system operator gets concerned that any small spike in demand levels can literally make the entire system collapse. To prevent that, they engage in load shedding. We've seen reports that said that ERCOT came from within 5 minutes of complete system shutdown. Essentially, that could have meant blackout over much of Texas. As a result of all of this, there were periods of time when the net generation, the actual generation of electricity, was just about 50% of the installed capacity or the generation capacity that was available during the peak of the storm. All of this is shown in the chart on the right-hand side. But I'll focus on two lines for now, and the dark red line that shows what the projected demand was. That's the demand forecast short while, just before the storm. This is what the profile they were planning, they were forecasting the demand would be. And if you look at the thin blue line, that is the generation capacity that's available. So one could get comfortable that yes, if the generation works, they would have been able to meet the demand. However, because of the weatherization issues and system failures across the grid, what was actually generated is shown in the dark blue line. And that's a significant gap from the actual demand forecast, and that's what leads to all of the issues related to load shedding, et cetera, and all of the issues that we saw in Texas. Next page, please. Next slide. Okay. So, again, the same thing that we see in the natural gas side, we see it in the electricity markets also. I'm showing two charts here. One is for ERCOT, North real-time prices, and the other is for the Southwest Power Pool South, let's call it Oklahoma and Southern Oklahoma and parts of the Texas Panhandle, real-time prices. So you have high demand, supply shortfall, high prices of natural gas. Put all of these together, it's not surprising. It is to be expected that prices will go up, and that's exactly what we see. Now, there's a subtlety that I ought to mention here. Looking at demand makes sense for parts of the system, for example, in SPP. Looking at actual demand in ERCOT may not be the most meaningful measure because there was a supply shortfall, so actual demand can only be, essentially speaking, the same as what was generated. So there you have to think about potential demand, or in fact, more precisely, you have to think about in terms of reserve capacity. What is available, extra available to be generated? So regardless, what we see is that in both the systems, prices jump up very high. These charts are on the same scale, and we can see that in ERCOT, prices jumped up to about $9,000 a megawatt hour. For reference, let's think in terms of $5, $10 immediately before and after the storm. So they jump up from levels of a few dollars all the way up to $9,000. This happened several times. They briefly touched in February the 13th, again on the 15th, and then almost steadily from the 16th through the 19th, they stayed at $9,000 in ERCOT. In Oklahoma, more precisely in SPP South Hub, we see prices increase as well. They increased up to, again, starting from a few dollars all the way up to about 5,000 briefly, and then they came back down, touched 3,000, and they came down again then. The difference between 9,000 and 5,000, of course, there are local differences in the demand and the generation and the price of natural gas, et cetera. But another factor to consider is that for ERCOT, it's an energy-only market, as we discussed. And these high prices are meant to compensate generators for recovering their variable costs as well as the fixed costs. Now, one of the things that I would mention right at this point is that in ERCOT, there were some retail customers who have retail power contracts that are linked to the wholesale prices. Not many, but quite a few did. And that fact also becomes relevant as we look at what happens afterwards. So first, on the next slide, let's take a look at how these markets intersect with the futures market. So first of all, there is a very active market in ERCOT futures. These are both daily contracts and monthly contracts. We are going to pay particular attention to the daily contracts. And so these daily contracts, they trade up to the physical day. So for example, I'm just picking a date out here. On the 15th of February, I could have traded contracts that settle against the February 15th prices. So these prices, these futures contracts, all cash settle to ERCOT prices. So there is a direct one-for-one correlation with whatever price ERCOT quotes, that's the price to which the futures settle. And as I said, because of the nature of the contracts, that there's a day of contract, it's a one-for-one correlation between what happens, a dollar for dollar. And what we see over here is, in the daily contract, leading up to the period of the storm, so not during the storm, but leading up to the period of the storm, we see a sharp increase in both trading volumes and open interest. This is on the left-hand panel, where the red line shows the open interest and the blue bars show the trading volume. And roughly speaking, both of these about tripled. And when we dissect it further, what we see is traders taking position for the period of time during which the storm was anticipated. So, for example, and this is just, I'm just giving it as an example to simplify our discussions here. Somebody could be trading on the 10th of February, which is a few days before the storm, and taking positions for the 15th of February or the 16th of February, which was expected to be right in the middle of the storm. So if you think about it, what the futures markets in the daily futures markets were doing is exactly how any other futures markets would work. In terms of, people have certain expectations and they expect those expectations in the market. Normally, however, we think in terms of futures being a month away, 2 months, 3 months, whatever way. Here we're talking about a few days, but exactly the same construct. So in that sense, these futures markets provided the same service and they continue to provide the service for which futures markets are designed. Just very quickly, I want to mention, if you look at the bars on the right-hand side, the futures markets open interest is dominated by commercials. 90% on the long side and 80+% on the short side are traders who are identified as commercial in our systems. Excuse me, next slide, please. So now we come to the crux of the matter in terms of price adjustments, repricing. We've all heard about that, the discussions, the debates, the newsprints about repricing and how that might have affected the futures. So by this time, we've established that there is a direct one-for-one correlation between our daily markets in particular and the prices. So we were paying keen attention to what was going on in this time period. So the chart on the right-hand side is the same chart we've seen before for ERCOT, with the prices going up and down as we discussed, and the highlighted areas of the periods of interest to us from a repricing perspective. So the first blue bar is roughly a period from the beginning of the 15th of February to about 5:30 p.m. And this is of interest because of what happened on the 15th and 16th of February. So February the 15th, at around 5:30 p.m., roughly speaking, there was an emergency meeting by the Public Utility Commission of Texas, in which they directed ERCOT to do two things, broadly speaking. One is they said to ERCOT that set the prices to a cap of $9,000 during periods of load shedding. So this is important for us to understand that during periods of load shedding, and which means that the system does not have enough reserve capacity to serve all the load that might be out there, and those time periods set the prices to a system cap of $9,000. The idea here being, let's attract more generation into the mix if we can. So that was point one that they did. The second directive that they essentially instructed ERCOT to do was to make this change retroactive to the morning of the February the 15th. So roughly from 1 a.m. in the morning till about 5:30 p.m., whatever the prices had been, they were reset to $9,000 a megawatt hour. Next day, on the 16th of February at 1 p.m., in another emergency meeting, PUCT rescinded the retroactive portion of these of the price change of the order from the previous day. As a result of this rescinding, prices from 1 a.m. to 5:30 p.m. were restored to the original levels, roughly $6,000 on average. The forward price cap of $9,000 continues. All right. So now let's move forward in time, and so the prices are at $9,000. And remember, at this time period, there are lots of issues going on the ground in terms of just making sure that there is availability. And PUCT was also not only looking at the wholesale market, but they're looking at the retail market also. They're looking at, making sure electricity is available for emergency use, et cetera, et cetera. There's lots of things going on over here. At some point of time, there started being a lot of discussion around repricing. And the essential push for this came from the notion that we mentioned before about consumers who had contracts, who had retail contracts linked to wholesale prices. They started facing massive bills, for their home electricity consumption. Reports of tens of thousands of dollars worth of bills showing up on their doorstep. Because of this, there was tremendous pressure by the Texas legislature to retroactively change the prices. That was the mechanism that they chose that caught everybody's imagination to begin with. And this resulted in a very strong debate. Now, on the other side of the debate were arguments being made about market integrity and finality of markets. And once a market is settled, it should be allowed to settle at that price, et cetera. Then on the 4th of March, ERCOT's independent market monitor, Potomac Economics, issued a report. And essentially what they said was that for a period of time, from about the beginning of the 18th of February till about February 19th, 9 a.m., the $9,000 price cap was done in error. Because at that time, the system did not qualify for emergency action. They were not engaged in load shedding. This refired the whole debate about whether to reprice or not. And this debate continued for till about early March, so well after the storm had gone and prices had come down to standard levels, to normal levels. And Potomac Economics' initial estimate of impact was about $16 billion. I think later they revised it downwards because of inter-affiliate transactions, et cetera. Now, over time, the Texas officials eventually abandoned their efforts at repricing. So that's the story. Now, Bill is going to talk about exactly what happened on the CFTC side, but I will start off by saying a couple of points of interest. When the first repricing happened, of course it affected futures markets because, they were right in the middle of it. However, the prices got fixed while the contracts had not been settled as yet. So the futures contracts that are most affected by those have a 5-year settlement window, and so they haven't gone through final settlement as yet. ERCOT hadn't issued the final invoices as yet. Whereas when we look at the second period of the debate, the period of interest was February 19th, up to the February the 19th. However, the discussion and debate was going on till March. And by this time, ERCOT eventually, along the way, they issued the final invoices. Futures markets went into settlement. So that meant a completely different way in which we had to think about it. Now I'm going to turn it over to Bill Heitner to talk about the issues that CFTC faced, the actions it took, et cetera. Bill?
Thank you, Raul. Next slide, please. My name is Bill Heitner. I'm an Associate Director in the Risk Surveillance Branch of the Division of Clearing and Risk. The Risk Surveillance Branch is responsible for identifying risks in the cleared futures and swaps markets and ensuring that those risks are properly managed. We're going to discuss the potential impact of ERCOT electricity repricing and how DCR monitored these markets. As Raul mentioned, the PUCT and Texas officials discussed the possibility of retroactively repricing ERCOT electricity. Repricing has potential to affect futures markets as many of the most active futures contracts cash settle posted ERCOT prices. The notional value of contracts that could have been affected was several $billion. To further complicate matters, these futures contracts had gone through final settlement while the debate on repricing was still ongoing. At this point, any change to the settlement price would have resulted in post-settlement cash calls and payments. Exchanges have a process for repricing futures contracts post-settlement. These changes are relatively small and result in immaterial variation payments. The repricing being discussed in Texas would have affected a large number of futures contracts, and the price change would have been in the hundreds or even thousands of dollars per contract. DCR estimated the size of the potential payments and determined that several clearing members would have had to make fairly large payments, but not greater than payments they make on a regular basis. The efforts to reprice ERCOT electricity were eventually abandoned, so there was no impact from repricing on clearing members. Next slide, please. While the debate on repricing was ongoing, staff closely monitored developments at the PUCT and the state of Texas. Staff held regular discussions with DCOs, FCMs, and DCMs to understand their views and concerns. DCR monitors margins, positions, and cash flows on a daily basis to identify risks in the clearing system. DCR identified clearing members and customers with exposure to repricing futures, verified that DCOs were collecting from clearing members on time, and contacted clearing members to ensure they had adequate capital and liquidity and were collecting from customers. Throughout this period, futures markets operated as expected, and there were no problems in clearing or settlement. This concludes our presentation, and we're happy to take questions.
And Bill, just in conclusion, one thing that I would say is that overall, while there was a lot of stress on the system overall, in general, we can say that the futures market system, including the market, the clearing, et cetera, they all worked as a design. And we monitored the market, as Bill pointed out, to make sure that all of that was working fine. And they served the purpose for which they're designed. Thank you.
I have not seen any indication that our associate members have any comments or questions. Abigail, is that correct?
I don't see any associate members. We do have two members, beginning with Dimitri Caruso.
Yes, Dimitri, please go ahead. I know you've got a tight time frame here. We can't hear you.
Can you hear me now?
Yes, please go ahead. Now we lost you again, Dimitri. I'm sorry.
How about now? Oh, wonderful. I need to have everything unmuted. Okay. Less of a question, more of a comment. Just wanted to thank the CFTC during that time. We were in regular contact, and it was helpful and thoughtful for us to be able to share what we were seeing and hear the CFTC's perspective, so we welcomed their regular outreach to us. We want to affirm the statements made just now about how the market performed. We were quite pleased with our risk model performance. We didn't need to make any parameter adjustments to our market margin models. They worked seamlessly throughout that period. And to get a little technical, when you're monitoring the performance of a margin model, you look at what's called your breach activity, the number of times where variation margin or the profit and loss on a portfolio exceeds the margin requirement. Despite the hectic activity we saw throughout that week in ERCOT, we only had 1 day of breaches, and our overall margin model, again, without any parameter changes, was well over 99.7. I think it was more like 99.8% during that time. So we were quite pleased with how the model performed and how our market made it through. And to be clear, that was quite a volatile period, but we are designed, we were launched to serve the power market and are quite pleased, again, with how that performed. The only other comment I would offer is that, we work together with our clearing member partners in providing risk management solutions to the marketplace. Clearing members are a critical piece, critical tier. They guarantee the performance of the market participants. As you can imagine, some clearing members have taken a pause just with regards to that market volatility and are questioning whether they want to continue to support power in ERCOT in particular. And we would just offer, the vast majority of our clearing members are fully supportive and continue to be quite pleased, again, with how this market continued and want to continue to offer this service. But we just want to continue to emphasize that this whole day has been primarily focused on carbon markets. And from our perspective, when we think of ESG and the broader environmental movement, it all kind of begins with electricity. Electrifying everything is the buzzword with how we will get to our climate objectives. And you can't really be about E in environmental if you're not about E in electricity. We need to see robust, continued support of electricity markets to see the plants built that will help us get to the future we're all trying to achieve here. So we just want to continue to this few clearing members who are concerned. These kind of periodic bursts of volatility. Of course, we saw it earlier in 2014 during the polar vortex that affected the East Coast. The market survived. The market did well. Not a single clearing member defaulted. It was well managed. And we just want to remind clearing members that in their commitment to ESG policies, they need to remember that the E also stands for electricity. Thank you for allowing me to speak and for comments today.
Thank you, Tyson. I think you had a comment you wanted to offer. Tyson, we can't hear you. Tyson, we're still not able to hear you. Does someone else have another comment?
Are you able to hear me now?
Yeah,
go
ahead.
Sorry for that technical snafu. Thank you, Dina. I just want to quickly thank Raul and William for their excellent presentation. I'm really glad that it appears that the futures market worked as designed. We unfortunately can't say the same for the spot market. Those extremely high prices came at a time of serious market dysfunction, and we actually sent comments to the Federal Energy Regulatory Commission. They have some statutory authority to step in and change some aspects of the way that spot prices are reported, and we have asked FERC to make some changes as part of an open rulemaking over there at the Commission. But I just want to commend CFTC staff because on your end, it looks like the market worked as designed. So thank you very much.
Thank you.
Thank you.
Did anyone else have a comment? Sean, I see you have turned on your monitor. Would you like to offer a comment?
I again, as Tyson said, commend the CFTC staff for the great analysis in this human tragedy that occurred in Texas. This is as we migrate to electrifying everything, this is going to be a common occurrence. And the grid, as you electrify, particularly for heating-related peaking needs, the grid is going to be blacking out on an increasing basis. So the question that I have is, has anyone in the staff heard of pricing of resiliency into any contracts? Because resiliency of the grid, particularly in peaking, thank God parts of the country have natural gas in order to supply the peak. But there are large, particularly as we deploy significant renewables, resiliency in the grid is going to be an ever-increasing problem. Is there any talk of pricing, adding resiliency in a pricing mechanism to any of these trades?
I think, if I may just say, I think that would be more a question for FERC, since our futures contracts, derive from the physical market. Particularly in this case, as we said, our futures contracts settle to whatever the price is produced by the RTO.
I think that makes sense, and I applaud Tyson for asking FERC these hard questions. Unless the contract specification is done in a way that keys in resiliency from whoever that is, you're not going to get it priced. And if you're not going to get it priced, then you have the perverse cash market incentive to create chaos, whether intentional or, oh, gee, we were supposed to pay attention to that. Those are my just general concerns. So Tyson, if you need assistance with that, certainly I'd be happy to work with you on that.
Sean, there is one. It's not priced into the contract itself. This is Tribune Land from ICE. You might, but there is, at least in Texas, there is ancillary services, and that is an all-encompassing term for what you're talking about, which is the cost of keeping the grid up and running. And in fact, during this time period, it actually went over $9,000. I think it might have capped out at $24,000. So there might be contracts like that that are separate from the underlying contract that might address your concern. It's a good point, though.
That's terrific. Is that something you could share with the group?
Sure. Yeah, I'll dig up the definition and post it here in the chat.
Abigail, I don't see any other members or associate members who are asking to speak. Is there anything else before we move to the commissioners?
I don't see any other questions from members or associate members, so yes, we can head to the closing remarks now.
Or I think we need to ask if the commissioners have any questions on that panel before we go to closing remarks.
Apologies.
Okay. All right. Do any commissioners have a comment or a question for the panel? No? Okay. Well, with that, we will move to closing remarks. I want to thank everyone for participating today. I know we ran a little late, which to me just signifies that there is much to talk about in all of the topics that we covered today. So thank everyone for hanging in for the long day here. And with that, I just want to comment that we'll look forward to our next meeting, which I think, as Commissioner Burkett said at the outset of today's meeting, we're hopeful that the next one can be in person and we can all be in the same room again. But that date will be to be determined, and we'll look to Abigail for further information and polling about when that date might be scheduled. So with that, Abigail, I'll turn it back over to you.
Thank you, Dina. I now recognize Acting Chairman Benham to give his closing remarks.
Thanks, Abigail, first for that introduction, and then, of course, thanks for all your work. Dina, thank you for your work as chair. Excellent. Commissioner Berkovich, tremendous. effort here and leadership, and to all the members, a really great conversation, as evidenced by the fact that we went over, but really great question and answer periods about these issues, which are difficult. And there's so many elements that I think we need to continue discussing, and I think this committee will continue to do it. The Commission will, and really looking forward to more engagement with all of you. So hope everyone's doing well. Thanks to everyone, and I will echo Dina's remarks that I hope we can be together the next time we meet in the next few months. Thank you.
Thank you. I now recognize Commissioner Stump to give her closing remarks.
Thank you, Abigail, and thanks to everyone who helped organize the meeting. I'll be very brief. I thought the discussions relative to the various developments in the carbon markets were fascinating and really important to the work we have to do at the Commission, both with regard to the contracts we currently have that we oversee and the potential for additional new contracts that may rely upon information from these underlying primary markets. So thank you all for putting together such a marvelous group of presenters. With regard to the last panel, I did want to say to Raul and Bill and to everyone at the agency who has endured the past year, I think all of the commissioners would agree that we've had a number of what I can only call nail-biting days at the agency during the course of the past year. And to those of you who manage these markets and contribute to the infrastructure from the clearing members to the clearing houses to the exchanges, I think it's really a testament to our system that while it was uncomfortable on a number of different days, none of us signed up for comfortable jobs. We knew when we signed up for these jobs there were going to be days like this. We just happened to have a lot of them in 2020. And I'm not trying to minimize the underlying concerns. As a Texan myself, I had many family members who were directly impacted. But I do want to commend the derivatives market participants and infrastructure providers and the Commission and the staff for the way in which the entire situation was handled. Thank you.
Thank you, Commissioner Stump. I now recognize Commissioner Quintens to give closing remarks.
Thank you, Abigail. No official closing remarks from me, but I just, again, would like to thank Commissioner Berkowitz for his great leadership of this, not only the wonderful meeting, but the advisory committee. To you, Abigail, to Dina, all the presenters that I thought did a fantastic job and put a lot of time and effort and original thought into some very complicated issues and laid them out for all of us to understand in a very clear and straightforward way. So thanks again. Appreciate the time.
Thank you. And I'll recognize Commissioner Berkowitz to give his closing remarks.
Thank you, and I thank my colleagues. Thank you, Commissioner Quintens and Commissioner Stump, for your great support of this committee, and of course, Chairman Benham, who, as I noted earlier, really has been a leader on the climate change issues for a number of years now. The groundbreaking market risk subcommittee report on climate change really will continue to inform and guide our actions as we go forward, and today's effort really builds off that. So again, I thank you, Chairman Benham. Obviously, Dina, Abigail, and Lucy, thank you all very much for putting this together. Dina, you did a yeoman's job today over the past 6 hours. I think since I've been here, this is really a very packed EEMAC meeting. I don't know if we've gone this long before, but certainly the subject matter compelled it. And Abigail and Lucy for putting this together and all the hard work behind the scenes to organize the panels and really help facilitate these excellent presentations. And of course, the presenters, our friends who participated from Europe, Hans Bergman and Gordon Bennett, into the evening their time. We thank you very much. Rajinder Sahota from California and Secretary of Grumbles from my home state here of Maryland. Thank you for contributing to today's effort. The success of the CFTC and these advisory committees, and this is really the value, we really depend on input from market participants, fellow regulators, stakeholders, public interest groups, we can only do our job to the extent that we're informed of what's going on. We're a relatively small agency, and so we really depend on information coming to us. And I thank you all, and I thank also everybody on the third panel, the market participants and regulators and other perspectives for the information. I think as in order to make progress on this issue, which is going to be a long-term issue across all sorts of market participants and across the globe, really it needs to be a collaborative effort. And I think our little microcosm today, this meeting, is exemplary of the type of collaboration and people from different perspectives coming together and discussing and seeing how we can make progress. So again, I thank everybody. I look forward to working with the committee. We will facilitate the consideration of the proposal. Obviously, it's for the members to decide what to do, but to the extent that we can support those efforts and facilitate that, we will continue to do so. So again, thank you, everybody, and we'll look forward to being together again, hopefully in person in the fall. So thank you. Gail, unmute, please. Elliot.
Thank you, Commissioner Records. As an amendment to the roll call earlier in the meeting, I'm stating for the record that EEMAC members Tribute Bland, Demetria Carusos, and Jackie Roberts, as well as associate members Susan Bergel, Sean Cota, Daniel Dunley-Levy, Paul Hughes, and Delia Patterson have been confirmed separately that they are in attendance for this meeting. Thank you to all of the EEMAC members, associate members, and guest panelists for your participation at today's meeting. Please stay well and keep an eye out for our survey for dates for the next EEMAC meeting in 2021. This meeting is now adjourned. Thank you.